Good morning, ladies and gentlemen, and welcome to day 2 of What and Where to Invest 2022. The show must go on. While uncertainties and disruptions may still linger in the world, at FSM1.com, we believe investing is for the long term. It is not about timing the market, it's about time in the market that investors should pay attention to. In order to help you invest globally and profitably, we have an exciting and insightful lineup of presentations today featuring ideas and sectors that will be beneficial for your portfolios. In addition to these presentations, we've also lined up some exciting activities which you can take part in today. Show your hand and try your luck in our lucky draw. Today, we will find out who are the 8 lucky showgoers who will each walk away with a $100 FSM1 cash account credits. We'll also find out who are the 3 grand prize winners who will receive $1,000 FSM1 cash account credits each today. You can also gain more chances to win the lucky draw simply by attending the event on both days, visiting sponsor pages, joining our daily quiz, and sharing the event via social media. Each time you do these things, you add to your tally of chances. Do ensure you always use the same ID and email address when logging in. Now, show off your knowledge and participate in our daily quiz. We will have 6 winners each day walking away with a $100 cash account credits. Take note of what is shared throughout the event, as these will help you in answering the questions. On top of that, by remembering what was shared, it will also be useful for your portfolio. All prizes for these activities have been sponsored by our partners, and we'd like to take this opportunity to thank CSOP Asset Management, East Spring Investments and Nickel Asset Management, BlackRock, Franklin Templeton, JP Morgan, UOB Asset Management, Allianz Global Investors, BNY Mellon Investment Management, Neuberger Berman, and Schroders for making this event possible. As we gear up for the start of the sessions today, let's kick things off with a poll. To participate in the poll, firstly, click on Agenda and Activities on the menu on the left-hand side. Under Agenda, look for Poll, red light, green light. Then click Join Poll. The poll window will be displayed on the right. If everyone is ready, let's see what questions we have for today. The poll is titled Red Light, Green Light. There will be no warm-up questions for this round. There will be no right or wrong answers for this question. We'll begin the poll very shortly. Alright, let's go on to question number 1. The question is, China equities and China tech stocks dropped sharply in 2021. In 2022, you choose red light, stop investing and or sell, or will you choose amber light, wait till the coast is clear before investing? There is also green light, the option to buy more to average down, or will you choose the last option, no light, not interested at all? The question is, China equities and China tech stocks drop sharply. What will you do in 2022? Let's check out the results. The majority, 51.28%, chose green light, buy more to average down. It seems only a small percentage, 7.69%, chose red light to stop investing and or sell. And it seems no one chose no light, not interested at all. I guess it's why you have come down to our event today. Let's move on to question number 2. Sustainable investing, including ESG investing, impact investing, etc., has been gaining prominence in recent years. In 2022, you are still not convinced? That will be red light. We'll wait some more before investing. That will be amber light. Or you believe it's the best time to start or add. That is green light. With sustainable investing gaining prominence in recent years, what will you do in 2022? Once again, there are no right or wrong answers. The majority chose green light. They believe that sustainable investing, having gained prominence, is the best time to start or add. With only about a third of you chose Amber Light to wait some more before investing, and a small majority, slightly below 10%, chose that the red light option, that you're still not convinced. Interesting, we've got quite a good varied results over here. Let's check out our third question. Interest rates are expected to rise in 2022 alongside escalating inflation. With regard to fixed income products, you, red light, stop investing and or sell. Amber light, wait for uncertainties to be over. Green light, believe fixed income still has a place in investment portfolios. And no light, have never invested in them. With regard to fixed income products, will you choose red, amber, green, or no light? Alright, let's see. Slightly below 15% chose red light to stop investing and or sell. About a third of you chose amber light to wait, and close to half of our audiences out there have chosen green light, that they believe fixed income still has a place in investment portfolios. And a very small majority, about 6%, chose no light. Let's move on to question number 4. When it comes to cryptocurrencies, NFTs, and other new forms of financial products, what will you do? Is it red light? Stay away at all costs. Amber light? Wait for them to be more mature. Green light? Believe they are the future of investing, or you've already invested. Or could it be the last option, no light? You're indifferent about these new forms of financial products. Once again, there are 4 options for this question, and there are no right or wrong answers. Wow, interesting. The results are quite widespread. We have about close to 30% choosing red and amber light to either stay or to wait. Whereas even though it's a majority, it's quite close to the rest of the answers. Only 35.71% to be exact, chose green light, who believe it's the future or they've already invested. And there's actually 10% who chose no light. Alright, this is the last poll question for this morning. Dollar cost averaging is a time-tested strategy. You, however, prefer lump sum investing and timing markets, that will be red light. If you choose amber light, you prefer to wait for the best entry price. Green light, already set up your own DCA. And lastly, no light, you have not started investing. This is a very interesting question. DCA is a time-tested strategy, but what will you do? Wow, it seems that more than half of our audiences have actually set up their own DCA. They believe in this strategy. And about 15% chose red light. They prefer lump sum investing and timing markets. Close to 30% prefer to wait for the best entry price. And we have a very small number, close to 4%, who have not started DCA. Alright, this is the end of our poll questions. Thank you to all of you who have participated. I hope you had fun. Now, let's begin our very first segment of the day, covering the key investment themes to watch in 2022 and how you should position your portfolios. Here to tell us more is Yo Wei Ren, Senior Portfolio Manager, Portfolio Management and Equities from iFast Singapore.
Good morning, everyone, and thank you for joining us at What and Where to Invest 2022. My name is Wei Ren, Senior Portfolio Manager at iFast, and today I'd like to talk about some of the key investment themes that you should watch in 2022 and how you should position your portfolios for the year ahead. Now, 2021 has been a very eventful year. The year was once again dominated by the COVID-19 pandemic, as new waves of Delta infections swept across the world and also forced countries to implement lockdowns and social distancing measures. And more recently, the discovery of Omicron added to fears that the ongoing economic recovery would be derailed. But despite the setbacks in our fight against COVID-19, global equities continued to hit record highs in 2021, thanks to high vaccination rates as well as unprecedented stimulus measures. But not all markets did equally well in 2021. as we can see very clearly from this chart, the market rally was actually quite uneven across the world. On one hand, we have developed markets like the US and Europe leading the way in 2021 thanks to their high vaccination rates and generous stimulus measures. And on the other hand, we have markets like China that ended 2021 with very steep losses. And China in particular was on a different path compared to the rest of the world. China persisted with its COVID-0 strategy, and they also avoided the use of large-scale stimulus like the US. And more importantly, China cracked down on its technology firms. And that has left many businesses and investors very fearful over the future of China's tech sector. And some of them are even wondering whether China's equity market is even investable in the first place. So it should come as no surprise that China ended 2021 as one of the worst performing equity markets. So 2021, quite an eventful year, but with COVID-19 now persisting into its third year. Getting our asset allocation decisions right in 2022 will also not be easy. So over the next few slides, I'll be highlighting several key investment themes that you should look out for this year, their investment implications, and also how you should position your portfolios for the year ahead. Now, it's impossible to talk about 2022 without first talking about inflation. The Federal Reserve has for some time characterized last year's higher inflation to be a transitory issue. But after several months of higher prices, there is increasing evidence that inflation appears to be sticking around and could last well into 2022. And it was only in December last year when the Fed finally stopped using the word transitory to describe inflation. And in fact, they are now projecting 3 interest rate hikes in 2022 to help bring down inflation. So rate hikes this year are more or less a foregone conclusion. And this also means that 2022 is likely going to be quite a tricky year for bond investors because fixed income as an asset class, it tends to be sensitive to interest rate movements and they can be vulnerable to price declines when interest rates move up. What about equities? Will the Fed rate hikes this year cause a huge market crash? Well, not necessarily, because if you look back in history, there is evidence that equity markets can continue to do well even in a rising interest rate environment. Now, for example, if you look at the rate hike cycle from 2004 to 2006, the Fed hiked rates for 17 consecutive times during this period. But you can also see that over these 3 years, the S&P 500 still managed to deliver very favorable returns. In fact, they delivered an annualized return of more than 10%. And similarly, if you look at the rate hike cycle from 2016 to 2018, the S&P 500 also managed to deliver an annualized return of more than 9% during this period. So there is no need for you to panic. There is no need for you to reduce your equity exposure to prepare for Fed rate hikes this year, because equity markets can have the potential to do well even in a rising interest rate environment. So what are the investment implications for our portfolios? At the asset class level, we do think that equities are perhaps the better place to be in, and we recommend investors to be overweight equities relative to bonds for 2022. In a rising interest rate environment, fixed income assets will likely be more vulnerable, especially the longer dated bonds. And on top of that, in terms of valuations, equities are also more attractive relative to fixed income. If you look within the equity space, the US equity market is probably the only market that is considered to be very expensive. But outside of the US, there are still plenty of opportunities within the equity space. Now, fixed income is a different story. We are of the opinion that valuations in the fixed income space are starting to get expensive across the board. And even though there are still selected opportunities within fixed income, they offer very limited value to investors. And given that we're quite likely to see a continued economic recovery in 2022, then this environment should also be supportive of equity performance this year. Within equities, we are underweight the US, and that's largely because US equities, they look extremely expensive at this point, both in terms of absolute valuations and also relative to other markets. Earnings growth is likely to have peaked in the third quarter last year, and with the market already pricing in a lot of positives, that also means that our downside risk for US equities have also increased. Now, to be very clear, we're not expecting a huge sell-off in US equities in 2022. But what we're trying to say is that investors should expect lower returns from US equities this year. And given that there are other more attractive regions to play the continued economic recovery, we recommend investors to underweight the US equity markets in their portfolios. Europe could be a more attractive market to play the recovery compared to the US, given its higher rates of vaccination and more supportive policies relative to the US. And despite the strong performance of European equities in 2021, the valuations of Europe is still at reasonable level, especially when compared to the S&P 500. And on top of that, European equities, they have long been seen as a value market that is heavily weighted to banks and the other old economy industries. So a continued global economic recovery could be supportive of European equities. Japan is also starting to look interesting. In fact, Japan is one of our most favored markets for 2022. We think it has the potential to play catch-up with its global peers this year. The Japanese equity market delivered quite a disappointing performance in 2021, and it lagged behind the US and Europe by quite a wide margin. And that's largely because of its slow vaccine rollout in 2021. But the situation has changed. Japan's vaccination rate has since accelerated sharply, and it has now overtaken even the US and the UK. And this paves the way for a more sustained economic reopening and a recovery of Japan's domestic consumer spending. Policy in Japan is also likely to be supportive. The stimulus package that was recently announced by the government should be a tailwind for the economy this year. And Japan does not have an inflation problem. If you look at this chart, the core inflation in the US is currently hovering at about 5% as of November 2021. But look at Japan. Japan's core inflation was actually in negative territory over the past few months. And this also means that the risk of Japan tightening its monetary policy is almost non-existent at this point. Most importantly, the market valuations of Japanese equities remain attractive, again when you compare it to the US equity market. In short, we think that the stars are well aligned for Japanese equities in 2022, so we recommend investors to be overweight Japan in their portfolios. Outside of developed markets, there is also another market that we are particularly bullish on, and that's China. While China is unlikely to engage in large-scale policy easing in 2022, we believe that its growth slowdown is currently at a point that policymakers can no longer ignore. So moving forward, we can expect to see some policy fine-tuning and incremental loosening by the Chinese government. In fact, the PBOC has already delivered some supportive policy fine-tuning for the property sector by ensuring that the healthier developers have continued access to bank lending and mortgage approvals. The central bank has also been cutting its reserve requirement ratio in order to support the slowing economy. With China now focusing on stabilizing the economy and keeping its growth within a reasonable range in 2022, we expect China to roll out more supportive policies in the year ahead. We also expect to see an easing of regulatory pressures on China's tech sector. Now, the big tech companies, they have had a very challenging year in 2021, but these companies, they have been increasingly aligning themselves with government goals and investing in key strategic areas like cloud computing and semiconductors. And with the Chinese government now focusing on economic stability, and also 2022 being a politically sensitive year for President Xi Jinping, we think that drastic changes to the regulatory environment is a scenario that is quite unlikely. So we think regulatory pressures could ease this year, and China's technology sector could see a strong turnaround in 2022. And most importantly, the valuations of China's equity market are at rock bottom levels. Investors have already priced in quite a fair amount of negative news. So from a valuation perspective, we do think that the Chinese equity market is very attractive at this point. Now, what about fixed income? How should bond investors position their fixed income portfolios in a year ahead? With rate hikes coming in 2022, we think that global investment-grade bonds, they are likely going to be very vulnerable, especially the developed market government bonds, given that they are very sensitive to interest rate movements and their valuations are also quite expensive as well. High-yield bonds offer higher yields compared to investment-grade bonds, and they are, of course, more attractive on a relative basis. But having said that, the valuations of global high-yield bonds are also quite excessive at this point, which is why we also keep our underweight position in global high-yield bonds. We are also underweight the emerging market bond segment, which is also offering quite limited value at this point. But more importantly, emerging market bonds come with high duration, and this makes them very vulnerable to price declines when interest rates eventually increase. So which other fixed income segments should you invest your money in? Now, we think investors should go for short duration bonds, which tends to be less sensitive to interest rate movements. And another segment that we're particularly bullish on is Asian high-yield bonds. After the significant correction in 2021 due to China's crackdown on property developers, the Asian high-yield segment is currently offering investors a yield of more than 10%, which is the highest level in the fixed income space right now. The credit spreads of Asian high-yield bonds have also widened very substantially, suggesting that attractive value is starting to emerge. In fact, if you look at the current credit spreads of Asian high-yield bonds, they seem to suggest a mass default across the Chinese property sector, which is a scenario that we think is highly unlikely, as credit fundamentals in general have improved in the sector. Of course, we do not rule out further defaults in the sector, especially amongst the smaller property developers, but we do believe that default risk should be manageable in the year ahead. On the policy front, we think that the worst of the crackdown is probably behind us, as the Chinese government has recently shifted its policy stance to more pro-growth policies. The government has already delivered some supportive policy fine-tuning for the property sector by ensuring that the healthier developers have continued access to bank lending and mortgage approvals. So we maintain our overweight position in Asian high-yield bonds. We think that a lot of negatives have already been priced in, and the current valuations of Asian high-yield bonds more than compensate for the risk that investors are taking in this sector. And here's a quick summary of what I've shared today. For 2022, we think that investors should be overweight equities relative to bonds. Within equities, we are overweight Japan, as we think that Japan has the potential to play catch-up with its global peers this year. We are also particularly bullish on China, given its rock-bottom valuations and the recent shift in policy to a more pro-growth stance by the Chinese government. Within fixed income, we think investors should go for short-duration bonds, and we also think that Asian high-yield bonds are offering attractive value. But of course, at this point, the emergence of Omicron has added one additional layer of uncertainty to our asset allocation decisions. It is still too early to draw any conclusions, given the lack of information about Omicron, but we stick to what we know when making asset allocation decisions. And what we do know about Omicron is that governments have acted very fast and aggressively to contain the latest variant. When Omicron was first discovered, many countries imposed travel bans on Southern Africa within a single day. And this was important because it bought time for health systems to prepare for the new variant. The situation was very different for Delta. Countries took weeks to impose travel bans after Delta was first detected. And by the time Delta has been identified by the WHO as a variant of concern, it had already spread to many parts of the world. Vaccines, of course, still remain our primary defense against the virus. And on this front, there is some good news. Most developed economies have high vaccination rates. The vaccine makers have also said that they will be able to tweak their vaccines to fight Omicron. And there are also early indications that Omicron may be less deadly than initially thought. Now, it is still too early to make any conclusions, but important to still monitor how the situation evolves. But for now, based on what we know, we remain cautiously optimistic on the global outlook. If there is one lesson that we can all learn from Omicron, it is that our fight with COVID-19 is far from over. And this means that market volatility is likely going to remain high, at least in the short term, and that the best way to navigate this uncertain environment is to have a diversified investment portfolio. And if you're not sure how to build a diversified portfolio, then our FSM managed portfolios is certainly an option that you can consider investing in. It helps you to build, monitor, and rebalance your portfolios on your behalf. So it is designed for easy and effortless investing without the stress, especially if you don't have the time to manage your own investment portfolios. And most importantly, you don't need to commit a huge sum of money. All you need is just $500 a month, and you can gain access to a diversified portfolio of not just international equities, but international bonds as well. And with that, I've come to the end of my presentation today. We still have a lot of programs lined up for the rest of the day, so please stay tuned. And right now, I'll hand the time back to Gladys.
Thank you, Aaron, for that insightful overview. We will now begin our next segment on bonds, and we reckon it's not their time to die. Last year, Evergrande's liquidity crisis stole headlines across various news outlets. The real estate developer's debt crisis shed light on bigger issues such as China's property market woes. So what were some of the key learning points from Evergrande? Let's welcome Jackson Chan, Assistant Manager, Fixed Income Research at iFAST Hong Kong, and Dexter Tan, Senior Fixed Income Analyst, Bond Supermart, iFAST Singapore, to tell us more.
Hello everyone, welcome and a good morning to all. I'm Dexter from FSM1 iFAST Research. So for the next couple of minutes, we'll be discussing a hot trending topic within the fixed income space, and that is China Evergrande Group. So I think some of you know China Evergrande Group made the headlines last year, as it was really one of the biggest key events of the year. The company had more than $300 billion of liabilities, and they had some difficulty in paying its debt. So China Evergrande Group is actually one of the largest, if not the largest, developers in China in terms of contracted sales since 2018. As of June last year, it recorded about 550 billion renminbi of debt and about 950 billion renminbi of payables. So the company employs many people, and they have $356 billion of total assets. And this is really comparable to some big companies that have collapsed in the past. So maybe just to give you some context, in 2008, Lehman Brothers actually went bankrupt, and it had about $691 billion of assets. And then there's Washington Mutual, who had about $327 billion of assets when it failed. And then likewise, General Motors also had $82 billion of assets when it filed for bankruptcy in 2009. So I think prior to this, we actually asked some of you, the public, to send in some of their questions on Facebook, and later we'll be addressing these questions, which I have here just by my side. So later, Jackson and I will be addressing these questions. So today I have with me Mr. Jackson Chan, which is a manager from fixed income at iFAST Hong Kong. So Jackson is the resident expert in Chinese real estate developers at iFAST, has been regularly following up on the different issuers within the Chinese real estate bond space. So Jackson, what happened to China Evergrande Group last year? Maybe can you just tell us what are the recent developments?
Sure, no problem. So first of all, thanks for the introduction. So yeah, I'm going to take you through the recent developments for China Evergrande. So actually, Evergrande has been a highly leveraged developer for so many years, and it is also regarded as a red light developer which fails to meet the free red light requirement in many years. So we saw that Evergrande deteriorating liquidity coupled with a relentless negative news have actually shaken the market faith since last June. And we also saw that the company's bond yield have skyrocketed and cut off all its financing channels. So if we look into the bond yield right now, let's take the 2025 bond yield as an example. We saw the actual bond yield already reached over 100%. and the bond price is dropped to around $10 level. So recently, there is several developments for China Evergrande. So in early December, Evergrande announced that it is formulating a restructuring plan and established a risk management committee. So, and we think that because the risk management committee has some senior management from other state-owned enterprise. So we think that the officials or the government is taking a proactive stance on this Evergrande issue, and it also indicates a possibility of SOEs taking over its assets. So we should monitor the upcoming key deadlines for the USD bonds, which including the day on this month, 28th of this month, which is the last day of its grace period for the USD bond coupons. And the next bond maturity will be in March of this year. So Evergrande has to repay its $2 billion USD bond principal in March. So currently, we think the group is likely to enter a debt restructuring process, and it will propose any exchange offer soon.
Yeah, I think that's a great summary of what has happened. So, yeah, maybe I'll just move on and let's have maybe see what we have here in the questions within the boxes. So I think some of you has asked, and then, so maybe Jackson, I think some of us are wondering, do you think that there is a crisis happening in the Chinese real estate sector right now? So, and whether do you think that China Evergrande is the key reason that triggered the sector downturn?
Okay, so yeah, I think to answer your question about whether there is a crisis now, we can look into the situation in terms of the default rate. So according to our calculation, the actual default rate of the Chinese real estate bond is already at 14% right now, which is around 30.5 billion US dollars. So if we also include those technical defaults and the defaults on other debt obligations, including the wealth management product and also the trust loans, and then the default rate will reach 26%, which the amount will also reach 57 billion US dollars. So I think that it is not surprising if we see the actual default rate to exceed 30% eventually. So which this default rate is even higher than the global high yield bond default rate back into the 2008 financial crisis. So we can definitely say that the sector is in a crisis now. So you also asked about whether China Evergrande is the key reason to trigger the downturn. And first of all, we have to understand that the Chinese property developers are highly leveraged for so many years. So the first default cases in 2021 actually Sichuan Languang and the China Fortune Land. And we also saw the sector sales has massively dropped because of the tightened mortgage holder. Market also fears about the policy crackdown on different sectors, which we saw that it happens on the tech sector, the healthcare sector, the education sector, and of course, the real estate sector is also a victim. So I would say that Evergrande just further triggered the fear of investor and even the local governments. So and we saw that the pre-sales cash account is being monitored and locked, and therefore many developers their own cash cannot be used freely. So I would say Evergrande is not the only reason that triggered the downturn, but it is definitely accelerating the downturn.
Yeah, okay. So maybe I'll just take another question from the box. Okay, so do you think that the sector has bottomed out, and really what are the key signs that are telling you that this sector has really bottomed?
Okay, so actually, we saw that the fundamental factors of the sector was severely impaired, and the government has and recently the government has finally collected sufficient grants to take actions. So we can take reference back to the 2013 and 2015 cycle, which the Chinese real estate sector also experienced a downturn at that point. And we saw that the fundamental the figures are very similar to this cycle. So and in that cycle, actually, the government has loosened their regulations and tried to stimulate the Chinese housing market. And for this time, we also see similar situation right now. So we saw loosening regulation from the government, such as speeding up the mortgage approval, lowering the mortgage rate, and allowing the developers to refinance through the interbank channels. So, and we also expect there is some possible move in the future, including the government to lower the MLF and even the loan prime rate. So, and they may even open up more onshore financing channels and ask the SOE to buy the projects from the distressed developers. Yeah, but even with the relaxed measures, we think that it still takes time to deliver them and may not provide an immediate relief for these developers, which is currently facing a liquidity crunch. So, in conclusion, I think that more defaults are still coming, and we expected that the default rate will still go up. Yeah, but we also expected that from the industry level, the sector sales is going to bottom out very soon. Maybe even has already bottomed out, because we saw that in December, the sector sales is already rebounding. So yeah, and we think that the 2022, I mean the whole year, the national residential sales will decline a little bit, but may not be as worse as many people think. So we expect the decline will be less than 10%.
Okay. Yeah, thanks for your perspective, Jackson. So maybe I'll just move on to the next question. So do you think that investors should avoid investing in the Chinese real estate bonds right now?
Okay. So yeah, I think many investors want to know about this question. And actually, we have to understand the facts first. So the average yield of the single B-rated Chinese real estate bonds, I mean the USD bonds, is spiking up to around 50% now. So yeah, 50%. So 50% is a very astonishing number. So for even if we talk about the double B-rated bonds, the double B-rated bonds are yielding at around 17%. So yeah, we understand that the yields of these bonds are very high, and it looks quite scary to investors. So I think that it is very reasonable to stay and remain prudent, and at this point. And because we understand that the short-term bond price will remain extremely volatile. So yeah, but on the other hand, in the middle of difficulty lies opportunity. So we believe that the aggressive investor should keep a lookout for certain short-lived opportunities that may arise for some double B rated or even investment grade bonds. So yeah, and meanwhile, we also think that to diversify REITs, or if investors want to diversify the REITs and look for a chance for rebound, they can also look into some kind of Asian high yield bond fund, because this kind of investment product has also declined a lot. But yeah, it is also a decent choice to look for a rebound. Yeah, but for conservative investor, I think that the best strategy right now is still to adopt a wait and see approach, and try to make decision after observing if the industry sales starts to pick up.
Yeah, I think it makes sense. It makes sense to take a wait and see approach, and then looking at Asian high yield bonds. Yeah, so maybe I'll just move on to the next question. So is there an impact on the Singapore corporate bond market, and whether there will be any consequences of a slowdown in China on the local market? So maybe I'll just answer this question. Yeah, so there's going to be of course there's going to be an impact on the Singapore's economy if China slows down materially. And that is because China is one of the biggest, largest trading partners. GDP growth may slow and it will show up in the performance of companies. In fact, I can say that most countries around the world will in fact be affected by China if it slows down. I mean, a lot of Chinese consumers buy a lot of products from overseas, so invariably these economies will be affected. So in the US, the Federal Reserve has actually said that financial stresses in China could actually strain global financial markets through a deterioration of risk sentiment. So this year, because of the rate high expectations, we're not that optimistic on Sing dollar bonds compared to last year. Of course, monetary policy was more accommodative last year, and that's because policy makers were also more focused on the downside risk. Growth has picked up actually in the second half of last year, and inflationary pressures have somewhat led more central banks to hike rates. So overall, I think the Sing dollar market has weathered through 2021 quite well. So in spite of our less optimistic outlook for this year, we observe that some companies still have resilient balance sheets in Singapore and credit conditions are still healthy. So maybe can I just ask one last question for Jackson? I mean, Jackson, can you just tell us, summarize what are the key lessons that investors should learn from this Evergrande saga?
Okay, so yeah, I think first of all, we should all learn that there is no too big to fail in the market. So Evergrande is obviously the largest developer in China. Yeah, but still, we cannot just put the money in it because simply believing that it is too big to fail. But on the other hand, we also have to understand that some companies have very complicated debt structure, and sometimes it is really hard to look through the mist. So and in this Evergrande saga, I mean, not actually only Evergrande, we also saw a lot of developers to collapse recently. So from this whole sector crisis, we saw that many traditional credit matrix are not appropriate to analyze their credit profile anymore. Yeah, because these developers, they try to hide their debts intentionally through some kind of off-balance sheet items, and also very complicated borrowing methods, which may not be recorded in the book. So yeah, we have to, I think from now on, actually, we have to assess deeply into the off-balance sheet credit indicators, including the projects related to joint venture and associates. So these are the actual items that we are looking into right now, and we try to look whether a developer has intentionally hiding their debts in some kind of associate projects. So I think this crisis has completely changed the analysis framework for the Chinese developers in future. And we also believe that the sector landscape is going to change a lot as well. So we expect that the investor confidence will take a long time to restore, especially for the offshore investor side. So and we hope that the developers will also increase their transparency of their financials afterwards.
Okay, great. I think that's very awesome. I mean, that's very insightful indeed. I think all of us will become better investors in future. So to everyone else, thanks for joining us. Stay tuned for the next session where Adrian from CSOP Asset Management will be speaking on why you should embrace Chinese government bonds in your portfolio.
And Dexter. Next up, we have Mr. Adrian Chiu, Vice President, Sales and Product Strategy from CSOP Asset Management, as he shares about the qualities of Chinese government bonds and why investors should embrace them within their investment portfolio. Let's welcome Adrian.
Good day, everyone. Thank you for joining us today, and we're here to discuss about Chinese government bonds and why you as an investor should include them via our ETF into your portfolio. Now, before we dive into the webinar, I'll probably talk about the China macro outlook. Right, for China, we'll continue to see the pressure on growth and on the labor market likely to increase in year 2022. Now, the number of university graduates entering the workforce will reach a record high of 10 million this year. and headwinds from the continued property market slump will be a drag on the China growth sector, as this sector accounts for about 10% of the GDP contribution. Now, on the export side, in 2021, the robust exports has been a key driver for China growth, but may gradually lose their momentum and be less supportive in 2022. Now, besides the demand shift from goods to services consumption, we will see the recovery of other key exporters such as the ASEAN and India the recovery of those countries and region will come in to compete with China in terms of the global export markets. In the short term, domestically, industrial production may be affected due to the strict energy controls as well. Now, some of the key events that we should, as an investor, should look out for this year are the National Financial Work Conference, or NFWC, held once every 5 years, right? The National People Congress to approve the fiscal budget in March this year as well, and the 20th CPC National Congress, which is scheduled for second half of this year. So we believe that amidst of all these events, macro policies will likely to remain very supportive ahead of all these events, and to ensure that the Congress take place amidst in a very positive economical and financial environment. Now, with the expectation and the growing of GDP growth, we believe that the government is to step up their efforts to support growth in the coming months. Stimulus measures should not only boost domestic demand to offset the growth drag in the property market, but also to redirect a medium and long-term capital towards the high-tech and the green project. So the central bank is likely to maintain their dovish stance right now in the early part of this year, and will become neutral once they observe a firm recovery within China itself. And the general consensus of the GDP for China is to be at target at 5.2 for this year. So this boosts a case of a rate cut which would benefit the China fixed income market, especially the Chinese government bonds. So what other qualities do Chinese government bonds offer? They offer investors attractive yield and strong credit rating. Now, China bond market is a market that's too big to be ignored, as it's the second largest fixed income market with the size of US 18 trillion onshore after US, right? And with foreign investors holding just 3.5% of the onshore market, hence there is a huge potential for future investment inflows to support and to boost the price of Chinese bond markets. Now, in the low growth environment right now that we're in, it's rather difficult to search for yield. However, the 10-year Chinese government bonds, or we call it CGB for short, give investors a yield about 2.8% with a strong credit rating of A+. Now, at A+, the Chinese government bonds, or CGB, have the same credit rating as Japan and even better than Italy. Now, having said that, the CGBs are backed by Chinese governments and has never defaulted before. Now, if you were to look at the risk return profile and the co-relationship with other major bonds globally, Chinese government bonds provide very strong risk return profile and diversification benefits when you compare it to these major government bonds. And if you compare on the yield to maturity, the duration risk, the annual return for the last 10 years, the FTSE Chinese government bond index has displayed a better performance against other developed government bonds. Hence, in terms of risk-return ratio, the Chinese government bonds have a ratio of more than 1. Also, the CGBs or Chinese government bonds has a low co-relationship with other major government bonds as well. Therefore, offer investors good diversification benefits. Right, so what are the key main drivers for Chinese government bonds investments? They are price returns, coupon returns, and FX returns. Now, with the resiliencies of the renminbi combined with the relatively high coupons, strong credit rating, this will continue to support Chinese government bonds in the long run. Now, last year in 2021, the FTSE Chinese Government Bond Index achieved a total return close to 8%, and we at CSOP are positive on all three main drivers in the short term and in the long run. So how do you gain access to this asset class? And you could do so through our exchange traded fund listed on SGX. So with our index, with our ETF, CSOP, Chinese Government Bond Index ETF, it eliminates complex approval processes and efficiencies, right? Both institutional investors and individual investors can trade and invest in onshore Chinese government bonds with ease and with price transparency. Also, with our ETF, it helps you to achieve cost and capital efficiency with a single trade at a low total expense ratio of 0.25, allowing you to be invested into a basket of Chinese government bonds. Now, since inception, our ETF performance has been tracking very closely to the index, which demonstrates our ability and our executional services with the onshore Chinese bond market. Now, having said that, what are some of the information of our ETF is that we are listed on Singapore Stock Exchange with two currencies, with one with the ticker code of CYC, which is denominated in Sing dollars, and we also have the US dollars with the ticker code of CYB. They are both fungible, which means that you could buy into the Sing class and sell into the US dollars class. Right? We are committed to give out dividends semi-annually in June and in December. Now, this is an EIP or excluded investment product, which means that you do not have to declare your educational qualification or trading experience to invest into this ETF. Now, having said that, if you were to invest into the ETF, what we do if you would do a regular savings plan on these Chinese government bonds, assuming if you would deposit every month $100 into this ETF since the starting of Jan in 2017 and to withdraw in December 2021, you could see that over the long run, the cumulative return of these regular savings plans, right, over 60 months have a cumulative return of 16.5% with an annualized return of 3.1. So this is actually a very good comparison to the low interest rate and the low performance right now. So in our back testing, we also found that the Straits Times Index and the CGB also display a very negative quotientship with the Singapore stocks. Hence, they also possess diversification benefits with equities. So if you were to, by allocating our Chinese government bonds into your portfolio, can provide a regular income, yet reduce the portfolio volatility. Now, according to our data, the reference allocation is about 80-20 into Chinese government bonds and equity respectively. So some of the key takeaways is that China is actually in a different growth and policy cycles versus major peers in the world right now. China onshore bond markets benefits with a supportive measure, renminbi to remain resilient due to the strong trade surplus, with the ongoing index inclusion which will continue to bring inflows. Now, Chinese government bonds offers attractive coupon yields at a very strong credit rating. The low quotientship with both other major government bonds and equities provide investors diversification benefits and yet reduce portfolio volatility. So CYC, CYB, these are some of the ticker code you should take note of. They offers you as an investors an easy access to the onshore bond market. And with that, I'll hand over back to the MC. Thank you.
Thank you, Adrian. We'll now proceed to our next session where our fixed income research team will take you through our bonds playbook and some of the opportunities investors should look out for post-COVID. Taking the stage is Sarah Chia, Business Development Manager, Bond Supermart from IFAS Singapore, Dexter Tan, Senior Fixed Income Analyst, Bond Supermart from IFAS Singapore, and Lim Ting Chong, Fixed Income Analyst, Bond Supermart from IFAS Singapore.
Hello and good morning, everyone. Thank you for joining us today. As we move into a brand new year, a lot of us are relooking at our portfolios to realign them with the current markets and look out for new opportunities. Today, I have the privilege of speaking with Dexter and Ting Chong, who will be sharing with us their best ideas for the first half of 2022. Well, Dexter, could you take us through your idea first?
Yeah, sure. Thanks, Sarah. So, one of the ideas that I like for 2022, I think Jackson has mentioned Asian high yield just now, and of course Chinese government bonds. And one of the ideas that I like for this year is agricultural commodities. Yeah. So some of you may know we are seeing rising food prices, and rising food prices have somewhat shifted the attention on global agricultural production and supply chains in the past year. There are many supplies of commodities in this space that are actually at their tightest levels in years, which would likely keep food prices at a high elevated level. So there are a number of critical issues that are affecting food commodities at this point. Agriculture prices have actually risen quite significantly since the last spike in 2020. And that highlights the fact that actually prices are likely to be an ongoing concern. Consumers will see higher grocery bills driven by more expensive proteins, crop prices. And the food companies, the food packagers are likely to pass this input costs to consumers because they want to maintain a certain margin for their business. So within the agricultural commodity space, there are different commodities. So right here, what you see is wheat. So wheat prices, as seen in the chart, is actually going up, and this is a chart from 1959 to around 2022. So it's a long period of time. In wheat, there's actually a drought in Canada and the US that has led to a sharp drop in inventory levels. Supply is actually not keeping up with demand. Prices for wheat flour and baking products are actually going up, and this would actually, we could possibly see more costly breads and cakes. So Russia, which is the world's leading exporter of wheat, is said to be imposing a quota on wheat exports this year. And they're also thinking of imposing a tax on exports, which would cause wheat prices to rise further. So there are also other major exporters like Argentina, who are also implementing similar export restrictions. So moving on, here we have soybean and corn futures, and for these two agricultural products, the La Nina weather pattern has actually affected the conditions in South America, and what they're seeing right now is that there's some below normal rainfall, and due to a delay in this rainfall, the weather is actually drier than usual, and these parts of Brazil are actually feeling the heat stress, and there's actually a drought, and that's affecting the harvest yield for crops. So hot and dry conditions are actually also affecting different parts of Argentina, and corn production is expected to fall. So regarding coffee, likewise, coffee is also approaching near their 10-year highs, and it's actually the largest sugar-producing region in South Central Brazil is witnessing a drought. So overall, there's a drought in South America, and that is affecting the production of these Arabica beans. So more closer to home, here we have a chart of palm oil futures. Palm oil futures are actually going up due to the recent floods in Malaysia. I think some of us have read the news. Floods in Malaysia has affected the harvesting of palm oil, the processing, the transportation. So across the supply chain of palm oil, and I think vegetable oil in general has also seen a drop in demand, increasing demand but lower production gains. So there's also this adoption of biofuel. So biofuel, whereby you're extracting fuel from agricultural to produce fuel, is also driving the driving the prices for vegetable oil upwards. So vegetable oil is also used as a food formulation for many products, and this could somewhat add a upward pressure to the consumer goods that are being consumed.
Well, Dexter, I get why, with rising food prices, we're going to see higher sales numbers for commodity firms. But you also listed reasons as to why these food prices are going up. We're seeing a shortage in supplies. We have changes in weather patterns that are threatening to disrupt these supplies even further. To me, these sound like pretty big risks to the commodities firms as well.
Yeah, you're right. I think it poses some risks to the commodity firms. But ultimately, because of their higher raw input prices, they would still have to pass these costs to the end consumers.
I see. Well, okay. Thank you for that explanation, Dexter. Could you take us through who are you keen on, within this agricultural space?
Yeah, sure. So I think because of the higher agricultural commodity outlook, the more positive outlook on these higher agricultural prices, we like Olam International. So Olam International, I think I've been highlighting this Sing dollar issuer for a number of times.
That's okay. It just shows conviction. It shows conviction, Dexter.
It's actually one of the global supplier of raw and processed agricultural commodities. It's one of the largest listed companies in the Singapore Stock Exchange by market cap. Temasek actually has a large percentage in this company, and then Mitsubishi Corporation also has a 17% stake. So I think looking at its recent performance, comparing the first half to the first half of last year, sales volume has increased. Revenue has also gone up by 33%. Earnings before interest and taxes, which is important to bondholders, which is also up by 51%. So PATMI, which is profit after tax, minority interest, has also improved by 26%, and operational PATMI, which is excluding the non-recurring items, has also gone up by more than 100%. So overall, very positive for this company. Performance was very good in the first half. Gearing was high, but I think there's adequate sources of liquidity that's available to the company. Looking at the banking lines, there's more than amount of liquidity that is sufficient to cover its short-term and long-term borrowings. So net debt to equity is about 160, but on an adjusted basis, it will fall to about 56%. So that is pretty comfortable gearing. So within the company's different bonds, we like this Olam 5.375% perpetual note. So as of a couple of days ago, it's trading about 100.4, and the yield to call is about 5.26%. So I think that's attractive yield for bond investors. Yes.
Dexter, is this bond available on Bond Express as well?
Yeah, it's actually available on Bond Express.
Okay.
You can actually buy the bond in denominations as low as like $5,000. Yeah.
That's perfect. Perfect for investors who are looking to better diversify their portfolio. Right. That's great. Well, okay, so we just heard Dexter's idea on commodities. Well, Ting Chong, what about you? What are you most bullish on in the coming 6 months?
In the coming 6 months, I'm quite bullish on industrial REITs.
Okay, well, that's really interesting because there's been so much news about it in the previous months, right? Something about ESR acquiring ARA as well?
So in this industrial REIT space, I think it's very interesting. There's a lot of acquisitions going on. So take, for example, ESR acquiring ARA.
Yeah.
So this acquisition will make them the biggest real estate manager in the Asia Pacific.
Oh, okay. Well, is that who you are presenting on today?
No, I'll be presenting on 2 other issuers.
Okay. Well, maybe before we get to that, I have a question. So I think a lot of Singaporeans are already familiar with REITs, but just for the benefit of anyone who isn't, could you give us a quick explanation as to what they are? For example, how are they different from property developers?
Yeah, so REITs, the main focus for REITs, their main focus is to invest in income-generating real estate properties, such as, take for example, hospitality, offices, and also retail malls where they can get rental income, and this will benefit unit holders of the REITs. Whereas for property developers, they can invest in other business segments that is totally unrelated to real estate, maybe marine and offshore, for example. So for REITs, their main focus is really into generating income for its unit holders.
Okay, well, thank you for helping us define that. So could you share with us who are you interested in today and why?
Yeah, so before I start, we'll take a look into the demand for industrial space. So demand for industrial space in Singapore continued to pick up even with COVID-19. So from the chart, total manufacturing index in Singapore have been increasing at a steady pace throughout the years. So in the third quarter of 2021, Singapore's economy expanded by 7.1% year on year. And in the same quarter, information and communications grew by 10.4%, transportation and storage by 8.2%, and manufacturing by 7.2%. And we can see that industries that require industrial space contribute a large percentage of Singapore's economy, and therefore increasing the need for these spaces as our economy continues to grow. Industrial REITs were resilient throughout the pandemic, providing stable rental yields throughout 2020 and 2021. Rental prices for these spaces were stable during COVID-19. It dipped slightly during 2020, but eventually rebounded back to pre-pandemic levels. And we think the industrial space will continue to perform well going into 2022. E-commerce will also be one of the main drivers for these logistics and warehouse spaces as more users start using these services. According to a report by Google, Temasek, and Bain, e-commerce in Singapore is expected to grow at a CAGR of 16% from 2021 to 2025. And the pandemic brought about many new users to e-commerce as COVID-related lockdowns prevented people from doing their shopping in malls. Thus, demand for warehouses and logistics spaces will be fueled mainly by the growth of e-commerce. And we think this provides stability and resilience to any pandemic-related lockdowns or restrictions.
Teng Chung, before you continue, I see where you're going with the growth of e-commerce and how that would create a lot of demand for such spaces. I'm just trying to understand the potential downside though. So far for these industrial REITs, can you help me understand what is their tenant base typically like? I'm playing the devil's advocate here, as you saw with Dexter just now. I'm just trying to understand how could they be potentially negatively impacted if, say, e-commerce for whatever reason just doesn't take off?
Yeah, so the managers of the REITs, industrial REITs, they invest in properties such as business parks and warehouses. And these spaces can be not only leased to e-commerce tenants, but also to other manufacturing tenants and also other industries that require this space. And the REITs usually will diversify their tenant base as to provide a more stable and resilient portfolio of properties. So, for example, if e-commerce doesn't take off, other tenants will still provide stability to its properties.
Okay, perfect. Well, are you ready to share with us who your issuers are?
Yes. So my first issuer would be Mapletree Logistics Trust. So for the 6 months ended financials, gross revenue for MLT increased 24.4% year on year. And the growth in revenue is mainly due to higher revenues from existing properties and from acquisitions completed in the current financial year. Net property income grew by 21.4% to 288 million. So recently, MLT acquired several properties in Malaysia, South Korea, and Singapore, and also Australia. And most of these were already leased to tenants ranging from Decathlon and also to one of South Korea's largest online fashion platforms. Taking a look at the tenant base, MLT has a diversified tenant base of 753 customers, and most of which are made up of consumer-related sectors that are essential to our daily lives. For example, consumer staples make up 18% of gross revenue, while food and beverage products make up 22% of gross revenue. And these sectors are essential and will continuously perform well, even if there are further lockdowns. MLT has cash and cash of 275 million and additional 674 million of available credit facilities. Total debt of 4.1 billion and an average debt duration of 3.6 years. Its interest coverage ratio is also fair at 4.3 times. And it has a gearing of 38.2%. So MLT's unused credit lines of 674 million is enough to refinance its 110 million of debt due in the current financial year. Taking a look at our bond picks, MLT has two notes, the 3.65% perps and the 3.725% perps. And we choose the 3.65% perps over the 3.725% perps due to a shorter call date and only a yield difference of 10 basis points. And the notes are rated BBB plus by Fitch, and these are of investment grade quality. And we think that this note is suitable for stable income seekers who are seeking for a resilient REIT that could provide a stable income. The next idea is AIM's APAC REIT. So our gross revenues grew to 65 million in the 6 months ended financial year, representing a 13% increase year on year, while net property income for the company grew by 19.4%. The increase in gross revenue was attributed to rental contributions from their acquisitions. Comparing the tenant base, majority of its tenant base is made of logistics and is driven by the resilient e-commerce and logistics sectors. And as compared to MLT, AA REIT's properties are more geared towards e-commerce, while MLT's tenant base is more towards consumer-related businesses. And as I said previously, e-commerce will be a driver to industrial REITs and is expected to grow during and after the pandemic, providing stability during these trying times. Taking a look at the credit profile, AA REIT has a cash and cash equivalents of 108 million and additional credit facilities of 151 million. And then the REIT managed to refinance most of its debt in FY 2022 and FY 2023. And as such, the refinancing of its secured debt facilities will enable the REIT to have sufficient undrawn committed facilities to repay the fixed rate notes due in March 2022. It has a total debt of 467 million and an average debt duration of 2.1 years. And its interest coverage ratio is slightly lower, but it's still fair at 3.3 times, and a gearing of 24.7%. And among the AA REIT notes, we like the 5.375 perps with a yield to call of 4.75%, and it's callable in the 1st of September 2026. I think it has a good credit profile with little to no debt expiring within the next 2 years. And taking a look at its tenant pool, its large tenant pool in logistics will benefit from the rise in e-commerce and continue to provide good and stable rental income for the REIT.
Well, Teng Cheong, I like the companies that you shared with us today, but I noticed that you recommended 2 bonds, and both of these are perpetual bonds. I know some investors out there, they might like something with more, a more fixed maturity. So are there any of those bonds that you could share with us?
Yeah, so for MLT, they only issue perpetual notes. So yeah.
Okay.
Yeah.
That's too bad then.
So while AA REIT, its notes, there's one maturing in 2022 and one in 2024. However, on a more relative valuation point of view, we don't think the fixed rates notes are attractive. So that's why I'm choosing the perpetuals instead. However, I think both issuers that I've highlighted have good and strong credit profiles, and we are confident that they will recall their notes in their call dates. Okay,
well, fantastic. Dexter and Teng Cheong have kindly compiled the bonds from the ideas today on this slide. So go ahead, take a picture or a screenshot to take note of it so you can, read up on it or invest if you wish. You can find articles on it available on the fsm1.com website. If you have more questions on fixed income, stay tuned for the Q&A segment at 4:30 p.m. Alternatively, join us on our upcoming Bond Picks webinar on 25th January, 7 p.m. as we discuss other bond recommendations of first half 2022 with you. For details of this webinar, you can check out the fsm1.com website where we have a banner up that will lead you straight to it.
Thank you, team. Let's move on to our next segment of today with 5 great investing ideas to help you invest like the IT crowd. In the first session, Heather Lim, equity analyst, portfolio management and equities at iFAST Singapore, will share about the outlook of China's tech sector and why we think a recovery is on the horizon after a difficult year as a series of regulatory crackdowns from the government set share prices tumbling. Please welcome Heather.
Hi everyone, I'm Heather from the research team, and today I'll be presenting to you guys on our outlook on China's digital economy. So first, the main point that I want to drive across today is that while 2021 was a tough year for Chinese tech stocks, fundamentals have remained strong as the pandemic-driven adoption of technology has accelerated, ensuring that the revenue and earnings of tech companies have continued. Going into 2022, we are positive on China tech as we see signs of easing regulatory pressures and also expect further digitalization driven by technological advancement, which the Chinese government is committed to. So over the past year, a series of regulatory crackdown was imposed by the government on big tech companies in China, and this sent shudders across the stock market. And all this began in late 2020 with the cancellation of Ant Group's IPO. And then regulations continued to heighten through 2021. So just highlighting some examples from the chart. In April 2021, Alibaba was slapped by regulators with a record fine of USD 2.8 billion for violating antitrust law for its use of the 2-choose-1 exclusivity contracts on merchants. And then in July, the government banned Tencent Music from owning exclusive rights in the online music industry. And also in the private education sector, sweeping reforms were also announced, including requiring all private education institutions in China to register as non-profit entities. These institutions also will not be able to pursue IPOs or take in foreign capital. So these are just some of the few regulations imposed which has weighed on the Chinese tech sector. So even though 2021 was a tough year for Chinese tech stocks, fundamentals of the company's revenue and earnings have remained strong as seen in the figure on the right, with the continued revenue growth as pandemic accelerated the adoption of technology. So now let's take a look at two of the segments in which I will demonstrate how the fundamentals of the companies have remained strong and why we believe that it will continue to grow. So firstly, looking at the e-commerce area, sales have continued to grow with the total national online retail sales from January to October 2021 reaching a total of 10 billion yuan, which is a year-on-year increase of 17.4%. And this strength of online retail sales continued into November, where we see that the Singles Day 11/11 sales were strong for JD and Alibaba. Both of them delivered sales growth of 29% and 8.5% year-on-year respectively. So e-commerce has grown significantly, but we still see that there is room for growth. For example, in the Chinese e-commerce grocery market, it remains at a low penetration of 5%, as compared to a 40% penetration in the consumer electronics market. And this just goes to show that there is still significant growth opportunities. On the cross-border e-commerce opportunities, the Chinese e-commerce companies are aggressively gaining market share abroad, where Shein, a big and upcoming brand, has grown in popularity overseas, and Shein has surpassed H&M and Zara in sales in the United States. Also, companies like Alibaba and JD.com continue to expand their cross-border e-commerce strategies, including building up their global logistics capabilities. And all these points us to see that there is going to be a continued sustained growth of China's e-commerce industry. Secondly, looking at the cloud industry now, the cloud industry in China has grown in 2021, and this signals a continued momentum in the digital shift. In both first quarter and second quarter 2021, cloud infrastructure services spend in China grew strongly by roughly 55% year-on-year. So compared with other countries, China is the second largest cloud market, and China's investment in cloud has grown, accounting for 14% of global investment in 2021, which is up from 12% a year ago in 2020. Furthermore, with China's continued push for artificial intelligence, Internet of Things, and autonomous vehicles, the cloud, being a crucial foundation of these technologies, will benefit. So we see that the entire cloud market is expected to grow at a CAGR of 31% till 2023, as seen in the chart. And also, for example, most recently in early December, Baidu obtained a permit to collect its fares for its Apollo robotaxi business, which is a driverless taxi business. And all these just demonstrates to us that the trajectory of technological development in China is continuing, and this leads us to believe that as more of such technologies grow in adoption, it will be a growth driver to the cloud industry. So just to reiterate this point, fundamentals for China's tech stocks have continued to do well across 2021, as seen in the examples of the e-commerce and cloud industry as elaborated earlier. So now moving on, adding to the positivity of the continued growth in 2021 is the fact that regulators' intention is not to stifle the growth of tech companies, but rather regulators want to safeguard consumer interests and also ensure sustainable growth of the sector. So first, regulations safeguard consumers and merchants, as well as promote fair market practices, and all these are crucial for the successful long-term sustainable growth of the tech industry. So taking a look, over the past few years, China's big tech companies have grown significantly and have gained influence over consumers and businesses and the economy. And it is to a point where it's nearly impossible for consumers or small businesses to navigate daily life outside of the tech ecosystems, which are operated by the likes of Tencent and Alibaba through their massive apps as WeChat. So, yet despite this dominance, little regulation has been imposed on these technology giants, and this has allowed for the unfair treatment of customers and merchants. For example, the anti-competitive two-choose-one practice forces online merchants to choose only one platform as their exclusive distribution channel, and this benefits the e-commerce platforms the most. If left unchecked, power will remain in the hands of these internet platforms, which will continue to allow such unfair market practices. Furthermore, with the power contained within a handful of big tech companies, the lack of competition will be impeding the innovation of the industry. As such, a healthy dose of regulation on the sector is perhaps justified and not entirely unreasonable. So to just sum up this point, economic regulation has always been a part of healthy functioning markets, and we believe that the government will not hinder the digital economy, but instead the regulations act as a recentering of the foundations of the industry, which will poise China for further sustainable long-term growth. Moreover, I would like to highlight and reiterate that rather than intending to hinder the growth of the tech sector, the government remains fully committed to digitalization and innovation, which we see in their ambitious 5-year plan. So what is the 5-year plan? The 5-year plan is a grand strategic blueprint of China for the next half-decade, which investors across the world all watch, as it is the closest glimpse of the future ahead and the plans ahead by the government. So by 2025, the government aims to have the digital economy account for about 10% of China's newly added economic output, and they also aim to become a leading innovative country by 2035. The government has laid out multiple goals, including being technologically self-sufficient and also to be the world's technology leader. And this is even more so as tensions with the United States continue. So, the digital yuan is one of the government projects that gives us a glimpse of China's ongoing digitalization. This digital yuan rollout will make China the first major economy to introduce a sovereign digital currency, and we expect the digital yuan to further accelerate digitalization. The digital yuan will further unlock growth for the digital economy as it opens up access to people without bank accounts, and it also does not need internet access, and it also will be easily accessible to foreigners. So why is that so important? First, it has been a problem getting China's rural and lower tier cities into the digital economy as they lack access to the banking system and also the internet. So here the digital yuan solves these two issues, and hence it will open the doors to e-commerce and also other e-services for the 30% of China's population who lack internet access. Another issue is that foreigners who visit China also encounter problems with using their international bank cards. Moreover, many stores and apps in China do not accept cash, but instead accept smart payments like WeChat Pay or Alipay. However, most international bank cards are not accepted on these platforms, and so here is where the digital currency, which is as easily accessible to foreigners, will come in to solve the situation. So in both cases of the rural citizens and foreigners, the digital currency opens access to previously cut off from China's digital economy consumers, and hence it opened the total market opportunity for the digital economy. So this is just one of the projects that the Chinese government is committed to, and it demonstrates that the trajectory of tech development for China continues to look promising. So on to the next point is that there are also recent signs that regulatory pressures are easing with the roundup of investigations for companies, and also as we head into 2022, which is a politically important year. So first, what we see is that companies have made the necessary rectifications, and also pending investigations on the tech companies have been given the final verdict. This fits within the timeline given by the Ministry of Industry and Information Technology of a 6-month review of internet companies in China. And this review commenced on 23rd July 2021, and so should end sometime in January 2022. Over 68 companies also, including Baidu, Alibaba, Tencent, ByteDance, Sino Weibo, and iQIYI, have completed rectification as required and are in compliance currently with the new regulatory framework. Moreover, 2022 is an important year where the Chinese Communist Party will host its 20th National Party Congress in November. And this will determine whether or not President Xi continues to another presidential term. So in such a political year, Chinese policymakers tend to prefer social and economic stability and will likely want to demonstrate significant achievements for China's citizens. Thus, it will make perfect sense for the party to wrap up regulatory crackdowns and display how it has benefited citizens. For example, in the case of education, regulators have made the moves on private education and it eases the financial burden of education. And education is a high amount of urban household income, which is up to 25%. And another example also is the case of implementing the regulation of the minimum wage requirement for China's 200 million gig economy workers. So hence, with most rectifications done and investigations coming to a close, and 2022 being an important political year, it is likely that government will wrap up its regulatory investigations soon. Most recently, another concern by investors is the delisting of US-listed Chinese stocks. And we think that the fears have been overblown for various reasons, including firstly, the China Securities Regulation Commission has reinforced their support for US listings, stating that Chinese companies should be free to choose where to list as long as they abide by the laws of both jurisdictions. Secondly, even in the case of a delisting, companies have plenty of options to list their stocks, such as China's Shanghai Stock Exchange Star Market and also the Hong Kong Stock Exchange, where they can list their shares. Thirdly, besides, the first delisting will earliest take place 3 years from now, as the United States rules state that foreign companies may only be delisted should they fail to comply with audit requirements for 3 consecutive years. And in the 3 years, a lot of things can potentially happen, such as a scenario of the US and China reaching a compromise of listing requirements. Nevertheless, downside risks persist. So in the near term, the delisting news has already and will likely to continue to dull investor sentiment, which could affect valuations as investors will probably lower the multiple that they would be willing to pay for the shares. Apart from valuations, companies may also have to bear additional costs to provide exit options for US shareholders, or in the case of converting shares. Exit options include buying back shares at an agreed upon price. And a share buyback means that the company will have to fork out a sum of cash which could have otherwise been invested back into the business. Otherwise, for companies with dual listings, they can elect to convert its ADRs into Hong Kong listed shares. However, doing so may give rise to logistical issues such as transfer fees and other associated costs. So finally, to recap the key points. First, we see that despite a tough year for Chinese tech stocks, with tech stock prices plummeting, fundamentals of companies have remained strong, including both continued revenue and earnings resilience. Secondly, we see that regulators do not intend to stifle the growth of tech companies, but instead, regulation is part of all healthy functioning markets. Third is that we also see the Chinese government is committed to spur digitalization and innovation with tangible projects such as the digital yuan. Finally, we see signs of easing regulatory pressures, and hence all these leads us to our positive outlook for China digital economy in 2022. As of 14 Jan 2022, the price of the iShares Hang Seng Tech ETF, which is our recommended ETF for exposure to the China digital economy, has been battered down to a price of 12 Hong Kong dollars. And this will give investors an attractive upside potential of close to 80% to our target price of 21.50 Hong Kong dollars. And this is based on our 2023 earnings estimate. So thank you all, and that's all I have for you today.
Thank you, Heather. Now, you may have heard of 5G, but what exactly is 5G and why is this next generation connectivity so revolutionary? In this next presentation by Chua Hui Ting, Vice President of Asian Distribution at Neuberger Berman, she shares about the attractive opportunity that is investing in 5G.
Hi, hope everyone had a great start to the year. I think what we are doing here today has shown how important connectivity has become as we move a lot of our activities online, ranging from banking, shopping, networking, and of course, participating in events like this. This trend will continue. There is no turning back. Thus, connectivity and 5G is going to be a significant part of our lives moving forward. My name is Hui Ting, and I'm from the Business Development team in Neuberger Berman, Singapore. Pleasure to be here to share more about what is 5G, what is so transformative about it, and also to introduce Neuberger Berman 5G Connectivity Fund. Before I start the presentation proper, I would like to provide the disclaimer that this presentation provides factual information about Neuberger Berman 5G Connectivity Fund, and no advice will be given about what action you should take. Nothing contained herein constitutes investment advice and does not have regard to your specific investment objectives, financial situation, or particular needs. You should seek relevant professional advice before making any investment decision. So if you need further advice, do reach out to FSM or your advisor. We have heard a lot about 5G, especially in recent period. People, companies, countries are so excited about 5G. Why is that so? Essentially, it's because of how 5G allows communication to be transformed. Thinking through the evolution of connectivity, we've been through the 1G and 2G era, which was really about human to human. So it's basically putting a phone in your pocket so that you can speak to the other party on the line. 3G and 4G is about putting an internet in your pocket. So it's about human to human, human to machine, where you can do a lot of things on your smartphones, like surfing the net, sending emails. But when we get to 5G and eventually 6G, the most important thing will be machine-to-machine communications. It will be about things talking to things, cars talking to the servers at Audi, for example. It's about machine communicating so that they can make life easier for human. And this is going to be a game changer in how the world works. Services that we used to see as futuristics, such as connected healthcare, connected vehicles, have arrived because of 5G. And on this slide, you'll be able to see that every time we've been through a technological innovation in telecommunication, the economy becomes bigger, it creates winners, and obviously it creates losers as well. Some of you may have remembered the Nokia 3310, the Motorola flip phone, and the BlackBerry was so popular back then. Obviously, they are less relevant right now. And in the 4G era, the FANG stocks have really benefited from the faster speed and have been dominating our lives. As we move on to the new world of 5G, which is the world of Internet of Things, you are going to have a new set of winners, and that's what we are trying to capture with our 5G strategy. So what exactly is 5G? 5G is not just about our mobile phone, it's about connectivity, it's about innovations. 5G is the 5th generation wireless cellular network, a key building block that connects and enables a new wave of innovations including robotics, artificial intelligence, connected vehicles, and Internet of Things. These new innovations will transform the global economy and our day-to-day lives. 5G is central to all of this, Without 5G, these innovations cannot move forward. This slide shows the three main characteristics which differentiates 5G versus our current 4G. We'll say it's ultra-fast, it's instantaneous, and it enables massive connectivity. Firstly, we are able to connect 100 times more devices as compared to today. It is estimated that we can have 7 trillion Internet of Things devices that will be connected to the 5G network. Secondly, higher speed. We are able to download and upload at a speed 100 times faster than the current 4G network. Thirdly, which is also the most important thing about 5G, a much faster response. It will allow a response time of less than 0.001 seconds. Things are instantaneous. We no longer have a click and wait problem. With this, there are a lot of exciting innovations and applications that can be developed. Many mission-critical applications such as remote surgery, autonomous car, they cannot tolerate any single delays because imagine if there's a delay, somebody's lives will be in jeopardy. So the robustness of 5G will be a game changer over the next decade. Because of the key characteristics, the potential impact of 5G is very wide. It won't be just about mobile phones. It's not just about the technology sector. It can change industries and society. On this slide are some examples of what 5G is able to transform. For example, connected factories and warehouses can implement real-time automation to improve efficiency. We spoke about how 5G will digitally transform multiple industries, and that is why 5G is so important right now, and it has become the center of a lot of geopolitics today. Some of you may have heard of this phrase, data is the new oil and 5G is the pipeline. And that is why there is a global race to build 5G network around the world. Many countries like the US, Europe, and China are all offering stimulus to increase investment in 5G and Internet of Things because after COVID-19, 5G is no longer a good to have, but a must-have. And even in Singapore, it has been announced that 5G will cover half of the Singapore by end of 2022, this year, and island-wide by 2025. Trials of 5G applications are already underway at PSA to improve port operations. It is a strategic asset to boost future economic growth and right now a national priority. This global race has begun, which is a good thing because whenever there is a race, nobody slows down. 5G itself is actually a very interesting investment theme that offers a very long runway. Now, we are currently still at the early phase of Stage 1 5G development. In Stage 1, it involves upgrading of existing public network from 4G to 5G. Telecom operators around the world are rolling out 5G coverage more broadly. Consumers will be upgrading their mobile plans and devices from 4G to 5G. Phase 2 development will probably start in 3 to 5 years' time, and it will be much bigger. It will not be just about the public network, but will be extended to private enterprise. Today, large companies like Bosch, Siemens, Amazon, they are already developing their own 5G private network, which will be different from the public network that we use. It will be optimized, secured, dedicated to their own businesses. This is why 5G is so different from other technology because it extends beyond just the monthly telephone bills of consumer. It's not just the tech sector that is benefiting from this enhanced connectivity. It will impact many, many different industries. With this broad investment team, what is our investment universe then? We focus on companies, sectors that enables or benefit from future connectivity, and it can be categorized in 3 buckets. Firstly, network infrastructure. Secondly, Internet of Things devices. And thirdly, services and applications. Within network infrastructure, we need to upgrade the base stations from 4G to 5G. We need more data centers, network equipment, upgrading of optical networking. These are still ongoing. We are still in the early stages for many countries. As we move on, we are likely to see proliferation of connected devices. As we speak, we are already seeing more 5G smartphone models being launched. Pricing will be made even more affordable. And not only that, there will be also other types of Internet of Things devices such as smart refrigerators, 5G medical sensors, sensors used in factories, etc. These will create demand for more sophisticated components, processors, display screen to power up all these devices. And finally, 5G will enable innovative applications and services, and new verticals such as connected healthcare, smart cities, etc. will emerge. We are seeing a lot of new opportunities in cloud software, cybersecurity, a lot of emerging applications such as live streaming, e-commerce, social application, of course, the metaverse, which is now seen as a 5G killer application. So what we are looking out for is beyond smartphone, beyond telecom, but a much broader investment theme. As mentioned, 5G is a long cycle theme and the market continues to evolve. Active management is key to identify winners and losers. In the initial phase of 5G deployment, the strategy will likely have higher exposure to network infrastructure, and as the market gets more mature with more devices being made available, we would expect to see the strategy having higher exposure to applications and services. New businesses are likely to emerge also in the later stage of 5G development. The composition of our portfolio will change based on the evolving opportunities, which is why you need active management in such a strategy. Active management also allows us to tap into opportunities arising from certain events, for example, the geopolitical tension between US and China. This is not something new. We have been battle tested and have navigated this before. There has always been two ecosystems when it comes to the technology space. A Western ecosystem where you have Google, Facebook, Amazon, WhatsApp, and the China ecosystem where there is Baidu, Alibaba, WeChat. We have been actively positioning our portfolio and take advantage of the ecosystem split as the geopolitical tensions evolve. The key is to identify winners, the local champions in both the China and the Western ecosystem. We also look for companies, for example, those in Taiwan and Japan, that can benefit from both of the two ecosystems. So we are in the age of digital and technology, and we are just at the beginning. Fortunately, but not by coincidence, Neuberger Berman has the capability to launch an investment strategy that is focused on 5G. Neuberger Berman 5G Connectivity Fund is a forward-looking, all-cap thematic equity strategy focusing on the key enablers and beneficiaries of 5G. We typically hold 40 to 60 names. Currently, we have 48 in the portfolio. This is an all-cap strategy. We tend to have 30 to 50% in small mid companies as we look for differentiated names with higher growth. We are benchmark agnostic, but we do reference the MSCI All Country World Benchmark, which is basically a global equity index, just as a reference to measure performance. This slide provides an overview to our portfolio. I think there are three key points that I would like to point out on our portfolio. Firstly, our portfolio is beyond just the technology sector. In fact, the overlap with a typical tech fund or a tech benchmark is pretty low, around 25%. Looking at the top right-hand corner, outside of IT, we have exposure to sectors such as healthcare. When COVID happens, it accelerated a lot of digitalization across industries, including the healthcare sector. The demand for remote patient monitoring, automated systems to dispense medication, etc., provides more opportunities for us to take advantage of. And more broadly within our sector breakdown, our biggest exposure right now is within the semiconductor space, in which we have over 43%. We are seeing strong positive tailwind in this space. Second point to highlight, the names that we hold are very differentiated as we try to uncover the hidden gems of 5G. As you can see from the top left-hand table, this is our top 10 holdings. We do not have large exposure to the mega cap FANG stocks, which is typical of a tech fund. So we offer complementary exposure to the existing equity holding, tech funds or index that you may already have in your portfolio. Lastly, this is a truly global fund. On the bottom right chart, it shows our geographical exposure, close to 30% in Asia, 12% in Europe, and 58% in the US. So we seek out opportunities based on bottom-up analysis, regardless of where the company is listed. In terms of performance, this slide shows our return as of end November. 1 month performance is positive 1.13%, which outperformed the benchmark, which was down over 2% for that month. The return since inception of the retail share class, which started in May 2020, is about 60%. So last year, full year's performance has been a little bit more challenging. Full year return of 2021 was about 5% positive. We have not been able to keep up with the broad market, mainly due to three reasons. Firstly, the growth to value rotation, which impacted our portfolio. Secondly, our underweight to mega cap technology stocks, which held up better during times of volatility. And thirdly, because of the regulatory changes in China, which impact the Chinese internet companies in our portfolio. We have made some adjustment and took advantage of the market volatility. We are currently very comfortable in our current positioning. Neuberger Berman is the first and probably still the only active manager to offer an equity fund dedicated to the 5G team. We started managing the strategy back in December 2017. Today, we are managing over 8 billion of assets in the strategy and over 2 billion in the fund. On the bottom left, this is our portfolio management team. The lead portfolio manager, YT Boon, he was an engineer prior to becoming an investment professional. He has over 10 years of experience as a chip designer, previously working in various tech firms such as Huawei, Broadcom, ARM. So we have the technical knowledge, have the right contact, understand the supply chain and 5G evolution because a number of our investment team members have the technical experience apart from the investment experience. The team is also backed by our global equity research team of more than 40 investment professionals. This is very important because as the use of 5G expands, so does the 5G universe. And the team needs to capture investment opportunities that is beyond just the technology sector. So we believe we are well positioned to identify the true winners. They are poised to capitalize on the 5G megatrend. This slide provides some basic information about the fund. We offer both US dollar and Sing dollar hedge share classes. This is a fund with global exposure, focusing on companies that are involved or will benefit from the next generation connectivity. We allow cash and SRS investment. Just to highlight that we are not just a 5G fund, we are the next generation connectivity fund. So as we come to the end of the life cycle of 5G, we will still be investing into the next generation 6G technology and players. Moving on, this slide provides a key summary of our key themes and outlook. We are cautious about the component supply chain as well as the China internet regulatory hurdles. As mentioned earlier, one of the detractors of the fund last year was our exposure to Chinese internet companies. We have been very flexible and shifted our allocation away from Chinese internet and repositioned ourselves into sector which are more structurally supported. And since then, we can see our shorter performance starting to pick up. So what are the tailwinds we are looking forward to this year? There are three main themes. Firstly, in the network and data infrastructure, we are really seeing acceleration in the 5G network rollout, especially in US and Europe. Asia traditionally was ahead of the game. US, Europe was behind, but now they have picked up pace, especially in the second half of last year. So we are positioned into a lot of key enablers and beneficiaries there. Secondly, we believe that the stronger for longer semiconductor thesis is a global theme. The need for increased connectivity and digitalization has led to increased demand for semiconductor chips, while tight supplies result in higher pricing power. Semiconductors are increasingly viewed as structural and a strategic asset, and we continue to have outsized exposure to tap into this multi-year growth story. Last but not least, we are very positive on the next generation or the killer applications of 5G, which include cloud digital transformation and also a very exciting new world of metaverse. Some of the names that we have in the portfolio are already seeing strong momentum because metaverse is really starting to take stage. In the interest of time, I'm just going to cover or elaborate on one theme, which is a very hot topic these days, the metaverse. We actually have been positioning into a lot of these metaverse-related companies over the last 6 to 7 months. Its development roadmap is very similar to the 5G plan. We are only at the very initial stage where we are building out the infrastructure and devices such as the VR headsets, wearables, and pre-metaverse applications mainly exist in the form of video games and virtual concerts. As the ecosystem expands, we will have content and software that allows us to immerse in the 3D virtual world. Constructing a fully integrative 3D metaverse will be a multi-year project, and 5G plays a crucial role as we need super fast mobile network with low latency to transfer huge amount of data and to connect multiple devices. Investment into the pre-metaverse virtual world is already happening. Here you can see some of the early stage applications such as gaming, where people play the red light, green light games as seen in the Squid Game. There are live concerts where performers like Travis Scott showed up as their own avatar. So maybe in future, all of us will be in our own avatar attending events like this. And in real estate, you have 3D virtual tours, which some of us may have tried. Given the restrictions during COVID lockdown, you no longer need to be physically physically present to view the property first, you can have a taste of what it's like with the 3D virtual home tours before you actually go down to the site. So we are already starting to see a metaverse developing in a number of ways. Metaverse is becoming the next 5G killer application. Beyond just gaming and social application, Metaverse will enter enterprise and transform corporate and workplace interaction. As more opportunities and products will emerge as more activities go virtual, 5G and Metaverse has very similar key enablers, and we have been already positioning into some of these areas. So we are at the early stage of these long-term structural opportunities as more countries globally are starting to build up their 5G network. We are excited about the trends we are seeing today. 5G is real and is here now, and we hope this is an interesting idea for you. So if you require more information, do reach out to FSM. Thank you for your time, and I will now pass on the time to the MC.
Thank you, Hui Ting. Let's now turn our attention to investment opportunities in next generation healthcare. With aging populations and increasing healthcare demand, spending on healthcare is set to increase. At the same time, rising innovation in digital health such as remote patient monitoring, genetic therapy, and advances in treating serious illnesses is providing investment opportunities. Here with us to tell us more is Ben Day, Director and Product Strategist of the Global Emerging Markets Equities team from BlackRock's Fundamental Equity Group.
Hello, everyone. Thanks for your time today to come to this event. My name is Ben Bei. I'm the product strategist of the thematic strategy within BlackRock. It is my great pleasure today to come here to share our thoughts and the view and our latest portfolio about healthcare and the next generation healthcare. If moving to the next slide, I think in the next like 10, 20 minutes, I will share our view like why the investor should consider investing into the next generation healthcare companies, why they are unique, and why it is a good opportunity to invest in this moment. Moving to the next slide, we all know that healthcare has very many long-term secular growth drivers, including like an aging population and economic development in the emerging markets. So aging population, we all know it is a long-term trend. We are seeing that in the different countries in the world, not only in the developed markets, but also in some emerging markets as well, like in China. And we know that there will be more and more elderly in the society going forward, and that is an irreversible trend in our view. While compared to the younger generations, the elderly in the society will spend like 3 times more into the healthcare spending, including the healthcare services and the healthcare products that actually present that there are going to be more and more healthcare demand to healthcare companies, given the aging population trend. That is a very big long-term support to healthcare companies. The other one is healthcare spending in the emerging markets. We all know that compared to the developed markets, which typically will spend like 10, 20% of their income into the healthcare services and products, while the healthcare spending in the emerging markets relatively lag behind. So like India and China, they are spending actually about 3 to 5% of their income, or in terms of the country's GDP, into the healthcare spending. But we all know, along with the household or countries, their income growth kind of increase. That actually, when people get richer, they are more willing to spend more and more into their health. So actually, we believe this kind of ratio will increase along with the economic development in the emerging markets. And given the emerging markets like India and China, they are huge populated countries. We actually see very huge catalyst from the increase of the healthcare spending from these countries as well, which actually boosts the growth in the longer term for healthcare. Moving to the next slide, which come to the key focus for today's presentation about innovation within healthcare. If you look at the financial statements of the healthcare companies, majority of the companies, their growth are not from the traditional products, but actually are from the latest innovative products. And that is why actually we are seeing healthcare companies spending tons of money into the R&D. So if you look at the chart here, we are showing that the number of clinical trials worldwide, we can see it is a significant growth in past like 10, 20 years about number of the clinical trials. And with that, actually, we can see the good result of this kind of R&D spending, that in past 3 years, FDA approval of drugs reached actually a historical high level. So actually, we are seeing very good harvest from this R&D spending, and that actually boosts the growth for healthcare companies. And we are seeing more and more applications of such new innovative products. On top of drugs, we are actually seeing innovation in other areas as well. For example, devices. We list out here about the rise of robotic assisted surgery, which actually can help the human doctors to perform the surgeries actually better than stand them by human doctors by their own. So actually, we can see more and more surgeries with assisted by robots. And going forward, we are seeing more applications for this technology in our view. And we are also seeing the reduced cost in many of the technology in past a couple of years due to the technology improvement. For example, the reducing genomic sequencing, gene sequencing cost, which is actually very important nowadays. For example, that when we are treating a patient of COVID, then actually the doctors need to know like which variant of the COVID is for this patient. Then actually gene sequencing is very important. Gene sequencing is also useful to help like the government to trace the source of the COVID as well. So overall, we can see the lower cost of this technology, which actually help in terms of the broader applications or usage for this technology. And we all expect that innovation will continue to drive the healthcare growth for many emerging healthcare companies. Moving next to the slide, then people will wonder that investing in the large caps can also invest in innovative products, because actually a lot of large caps, they offer new products as well. However, it is a mismatch in terms of the portion of the contribution to the innovation versus their current market cap and the valuation. So if you look at this chart, the top 25 healthcare companies, they are taking about like 40% of the total market cap in the healthcare space, but they are only contributing about 25% of the innovation. While there are more than 1,500 companies left there, only like 60% of the market cap in the space, but are contributing about 75% of the total innovation. So actually, there are hundreds of the companies not discovered or focused by investors in the moment, but they are actually contributing into the innovation. They have very strong research capability and with very potential products. So actually, our portfolio, Next Gen Health portfolio, actually want to discover the emerging healthcare companies, not within the mega cap space, but actually in the small and the mid cap space, but with a lot of innovation. That is a key philosophy and a target for our next generation healthcare fund. Moving to the next slide. So I will raise some examples. What are the next generation healthcare themes we like in the moment and we invest in our portfolio? One of them is digitalization of the healthcare, which actually we are seeing more and more usage of like the telemedicine or online doctor after the COVID breakout in 2 years ago. Actually, more and more people are more getting used to visit their doctor online due to the cost efficient and the cost effective. So actually, we expect this trend will continue even after COVID, and this telemedicine applications will actually be broadened even post-COVID. The other one is like remote patient monitoring, which actually will be super effective for the doctors to monitor the situation of their patients. So actually, this kind of devices, in our view, will be more broadly used as well in the future. Last one is connected wearables. So it's wearable devices. I think everyone have some wearable devices with them now. Actually, not only about the iPhone watch, etc., but more actually could it be like biosensors or hearing aids to some patients, which actually can improve the life of the patients for certain disease significantly by this kind of innovative products. The next slide is about the oncology treatment. So we are actually put a lot of focus of our portfolio to the next generation of oncology therapies. There are actually different technologies we are feeling very optimistic about, including antibody drug conjugate like or TKI or bi-specific antibodies. So basically, the technique rationale is about, for example, putting a signal into the cancer cells and later the drugs can target the cancer cells specifically rather than do harm to the healthy cells, which actually reduce the side effect of oncology or cancer therapies, or actually curb the reproduction or the spread of the cancer cells, etc. We are seeing existing products using these kind of technologies already, But in future, like 3 to 5 years, we're actually expecting to see more and more drugs actually using this kind of technologies to treat more type of cancers globally. On the next slide, it is about the genetic medicine. So in the future, ultimately, if we can reach the status of the gene editing, then theoretically we can treat all the diseases, because actually we can edit about the disease genes in the human bodies. At this stage, we are actually more focusing on the gene therapies and the gene silencing, which actually we are seeing applications already. I'll take one example is the RNA technology, which we all see the very broad usage for the mRNA vaccines for COVID globally nowadays. But actually that is only a very small part, a very initial part use of the RNA technology, because that is only like a vaccine to trigger the antibody reactions. However, we are seeing even broader applications for RNAi and for the gene silencing part that actually can be used for the treatment of certain disease. And we are seeing some pioneers in this area already. So actually, we are seeing different themes of the next generation healthcare, which actually we are seeing a very broad market and the potentials. And we like to invest in those themes in our portfolio. Next slide. So I'm going to talk a little bit about the investment team. The investment team actually is composed by one lead PM and 7 dedicated analysts. So the lead PM, Irene, actually has been very experienced healthcare investor. She has been working with like healthcare industry for quite many years, including the research, scientific research, and also investment experience for about 20 years. And she is supported by the 7 dedicated analysts. So within the 8-man team, you can see actually we have like 4 PhDs and 1 medical doctor. So the whole team actually is very scientific background driven, which is very important for healthcare investment in our view, because actually by starting those innovative healthcare companies, in many occasions, we need to talk to the scientists in the labs or in the academic areas, and we need to read the academic paper and the clinical trial results paper, etc. That all actually need a scientific background to understand. So basically, actually in our view, the very strong expertise in healthcare science actually can enable us to do better research and better investment into healthcare. Moving to the next slide, it is some key characteristic about the healthcare strategy. On top of the scientific background, we do very strong and rigorous research and due diligence to the companies we hold. We talk to their not only the management, we talk to their physicians and talk to their life scientists to understand better about the company. We talk to the frontline doctors on a constant basis to understand the use and also the feedbacks about certain products. And we also go to academic events, including those forums, to understand the latest innovation and development of healthcare technology. Our portfolio is benchmark agnostic. We don't have a performance benchmark, and we actually invest across the different subsectors within healthcare. So some of the healthcare companies are actually within like biotechnology. When investors are thinking about the growth part of the healthcare, they think about the biotechnology, but actually it is only one part of that. Actually, we see growth opportunities in all the subsectors, including like the healthcare services, like the decentralized healthcare I just mentioned, and also the devices as well. We are actually using a flexible and diversified approach to construct our portfolio. So our portfolio holdings will be more than 100 to mitigate the single stock risk. But actually, the other reason behind that is actually we see many growth opportunities within healthcare that we can invest into. So we have a very big investable space to support our diversified approach as well. Yeah, moving to the next slide. So yeah, this is an illustration of our diversified approach. We typically will hold more than 100 holdings in our portfolio, and the weight of the top holdings will be like 2 to 3%, and many of the holdings will be 1% or even below. The reason behind, as I mentioned, it is mainly to help mitigating the single stock risk, because by definition, actually emerging healthcare companies, because they are actually at the early stage or relatively smaller market cap, they will be volatile, and there will be some uncertainties about their fundamental trend So actually, by investing into a relatively big group of such companies, can mitigate the single stock risk. And actually, as long as the healthcare innovation keep continue, we believe the portfolio ultimately will be benefited by this long-term trend. And next slide. Yeah. I'll talk a little bit about our current positioning. So as I mentioned, we invest in across different subsectors within healthcare. So medical devices is actually our top allocated subsector in the moment, followed by biotech. And we also have like Think Digital in healthcare services providers, including the decentralized healthcare, like telemedicine, etc. And we only invest about 3.5% into the pharma. So that is actually because the pharmaceutical subsector is the least innovative relatively compared to the other subsectors. Regional exposure, actually, we invest heavily into the developed markets because actually in terms of the research capability, DMs, including the US and Europe, will still be dominating or leading in the healthcare space in our view. And if you look at the table we show up here, so actually the long-term growth of this portfolio is very strong, but the PE actually is relatively attractive in our view. So our portfolio PE overall is like 20-something times. It is actually reasonable valuation in our view that is comparable to the MSCI World or like S&P 500. And the other number I'd like to highlight here is about the overlap with the MSCI World Healthcare. It is only 13%. So it is a very minimal overlap with large caps. So MSCI World Healthcare basically is composed by the mega caps, large caps from the healthcare space. And we understand many investors may already have some exposure to that. Well, we can ensure that by investing in the next generation healthcare fund, they will not face a lot of overlap because actually this fund is meant to invest in the emerging healthcare companies with a smaller and big cap that actually for individual investor will typically difficult to tap on. But we provided this kind of exposure for those investors. The next slide, please. Yeah, here actually we put some comparison of this next generation healthcare fund versus when our traditional healthcare fund is more like large cap focused. So you can see that the weighted average market cap shows a very notable difference for this next smaller market cap nature of next gen health fund. And also in terms of the single stock sizing, you can see actually we control the top holdings into 2 to 3% versus like 5 to 6 or even 6 to 7% for the traditional healthcare portfolio. Next slide, please. On top, besides that, actually, I'd like to share a little bit about some BlackRock thematic strategy in a platform as well, including this technology strategy. So similar to next generation healthcare fund, our technology strategy also showed some tilt towards the growth segment. So we have two products in the moment, including the world technology and the next generation technology, but they are share the same feature, that is have the tilt toward the growth. And we are benchmark agnostic. We try to provide the long-term capital appreciations for our investors. And both the funds will adopt the diversified approach as well, to like holdings more than 100. And our tax strategy is also very well known in the market, very reputable due to the very strong experience of the investor, especially the PM, and also highly ranked in terms of the long-term like the performance ranking, analyst rating, and different awards, etc. So it is a very highly recognized technology strategies in the market. The next slide actually showed some comparison of the world technology, the large cap focused, or the next generation technology, which is similar to next generation health, that purely invest in the emerging technology companies. So we can also see the similar comparison that the weighted average market cap for the next gen tech is much smaller, and we actually control the sizing for top holdings to only like around 2%. So actually, that actually can provide some emerging tech or smaller market cap tech exposure to individual investors. Lastly, I want to share some of the latest insights about world financials. Go to the next slide. We understand that some investors do concern about the inflation and the potential rate hikes, the rising expectation of the Fed tightening in the moment, that I actually feel a little bit concerned about the like a growth segment. Despite we actually believe in longer term, it is fundamental to drive the performance of the stocks rather than the macro conditions or the or the interest rates. But if the investors do concern about the near-term volatility and they want to tap like the inflation or interest rate hike beneficiaries, then financials should be one of their consideration, because financials is a very few sector that actually can benefit from the higher interest rate. And our World Financials fund actually is a very differentiated portfolio run by a very experienced PM as well. It is relatively concentrated, but we are consistently with a high active share to be benchmark agnostic and try to get more alpha for our investors. So this could be a potential fund for those investors seeking for inflation or interest rate hike beneficiaries. With that, I will stop here and hand back to the MC. Thank you for your time.
Thank you, Ben. We're now at a great turning point for mobility innovation, and today, Paul Liu, CEO and Head of the Intermediary Distribution for Southeast Asia, BNY Mellon Singapore, is here to share how we can seize investment opportunities in a new era of smart mobility, particularly in the areas of connectivity, autonomous driving, sharing, and electrification. Please welcome Paul Liu.
Welcome back, everyone. In this segment, I would like to invite you to take a time machine, right, built by BNY Mellon Investment Manager. We take a look at the transportation, land transportation, mobility, right, in a little bit history, and most importantly, the future. What is mobility innovation? What do we have in the future on transportation, land transportation in particular, right? So let's hop on, buckle up, and get ready to travel on your time journey. Now, before we go on, I just like to introduce BNY Mellon a little bit. BNY Mellon is the world's largest asset manager, custodian bank, right? And we manage more than 45 trillion assets under custody and administration, right? BNY Mellon Investment Manager, right, is the fully owned subsidiary of BNY Mellon Corporation. So we are also one of the largest in the world with 2.3, 2.4 asset under management, right? So now let's go to the time machine that we have. And in this time machine, right, you will be able to find out that the future vehicle, the dashboard that you have seen in current days, is more or less becoming a command center. Okay, so you have a lot of features, a lot of interactions, a lot of connectivities going forward that in this new mobility that you'll see. So let's go back to perhaps travel back to about 200 years ago, where we know that humans have been using a lot of say in the past animals or elephants, horses to carry us around, to transport us around, and then until maybe the early 1800th century, we use horses, especially in the West, horses and buggy, right, to ferry people around. But at that time, they have their own problem, the environment problem, because of all the droppings of horses, right? So fast forward to maybe early 19th century, where we have machines, we have invented machines. First we use steam engine, and then later on we use internal combustion engine, modern vehicles that we have seen today, right? So with all these things, we revolutionize the whole industry. We have seen new business coming up that is fringing around this, surrounding around this mobility. We have workshops, we have car wash, we have accessories and all those things, petrol stations that is built around this mobility. So this is the first turning point that we've seen, right, in the modern industry. And then now fast forward to today, and maybe going to the future. And I'm not talking about too far away in the future. We are talking about maybe 2-3 years from now, right? This is something that you will see very differently. Now, going forward, as I mentioned, our vehicles will be a command center.
and this command center is connected to everywhere. Okay, let me give you a little bit of the numbers going forward that it is that will be a future challenge that we have. Now we will have about 10 billion population by 2050. Okay? Currently we have about 7.5 billion, and going forward we will have a lot of vehicles on the world road, which is about 2 billion, right, by 2035. Right now we have about 1.2 billion vehicles worldwide. Now, so all these things, all this build up will create a lot of congestion, right? And not to mention the safety issue. Well, unfortunately, every year we have about 1.35 million people died because of traffic accident, right? So all these things will be a big issue, big challenge for us going forward. And not to mention about the pollutions, right? When you have continue to have 1.4 almost 2 billion cars on the road, the emission problem that we have will be tremendous, will be ridiculous, right? So all these things will need to be addressed, right? And not only that, we also will see, because partly due to COVID, right? The demographic is changing. The cities are becoming more and more packed. I think going forward there will be 70% of the world's population gather in big cities, right? And at the same time, we also seen maybe in a big environment, big urban cities, we have people moving to the suburb, right? Because of they don't need to be physically working in the big city, so they'll be moving. So the dynamic, the demographic will be changing differently, or very different from what we've seen today, right? So these are the changes that we see in the future, and how do we address all this problem? Now, for example, we can use a lot of connectivity, a lot of technologies to help us to solve the congestion problem, to help us to better plan for the road, and this is what we call the connect to everything. Okay, this is we will be connected. The vehicle, it's the future vehicle, will be connected to vehicle to pedestrian. Through handphone, the vehicles will be smart enough to detect whether is that a pedestrian crossing in front. A vehicle will be able to connect to network, right? We will be able to see what kind of perhaps commercial in front of us, or we want to go to a restaurant, and then there will be pop-up display in our car to tell us that there's a restaurant that you like in front of it, and where do you park, right? On the other hand, there will also be vehicle connecting to vehicles. We will be able to avoid certain perhaps collisions, and avoid if we are not paying attention. So all this will be connected, and then the vehicle itself will be able to give us either alert or even activate the safety features, right? The auto stop, the blind spot, all those that we are already seeing in the current prototype modern cars that they are going to build. And we also have the vehicle to infrastructure, right? All these things will allow the authority, the transportation authority, to look at the traffic with big data to better manage the road condition, to how do we divert away all the traffic jams and all those issues that we'll be facing in the future. So this is what we are seeing. The connectivity is very important. Now, how do we get all these things solved? Of course, 5Gs, of course, edge technologies, edge computing, cloud computing. And how do we prevent people from hacking into all the system, the cyber securities? So all these things are more than just EV, more than just 5Gs. So it's a full value chain and supply chain of mobility in the future, right? So we also can look at perhaps automation, right? Self-drive vehicle, right? We will see that with the self-drive vehicle, we are developing a lot of all those technologies that is to help cars become more safe in the future, and also to help the driver. For example, we will have softwares, we will have applications, right, that will be able to detect the face expression of a driver. If I'm falling off sleep, I'm dozing off, I'm got distracted by something else, the computer, the vehicle will be able to detect that and give me some sort of alarm, or even activate all those anti-collision. And this is what we call the advanced driver assistance system, right? Which is actually underdeveloped right now. We are, some of the cars are already using part of some of all this technology. So all this will be available, will be in place to help us to be safer, right? So this is actually what we can see or we can expect going forward. So lots of all this being developed around the future car. Now, and also we also can see that because of the changes in the whole demographic, right? Today we will be maybe buying a car and then we use it for all purposes, right? We go for shopping, we go vacation, we leisure, all sort of usage in one car. Now going forward, there could be this ride sharing application or trend that we may not even need to own a car. We can have many cars to use on a short-term lease or rent for as long as you want, and then you can use it for different occasions. For example, I want to go for vacation. I am going to want to drive a recreation vehicle. I can rent or I can lease RV that I can use for a couple of weeks, or I want to go during a weekend with my significant partner for a getaway, so I can rent convertible, right? So we can enjoy, and of course then there will be some daily commuting, ferry children, ferry elderlies, and all these things will be different tomorrow in the future. Well, we no longer need to own a car. We can spare us with all the maintenance, insurance, all those problems of the side effect of owning a car, and with just all this ride sharing features that we can find in the future. And of course, we also lastly looking at electrification. Cars that I'm sure you already know or suspect that cars going forward will no longer be running on fuel, petroleum, right? Because of all the pollution. Now, China is a very good example. China market is currently developing EVs, right? And because of the pollutions that they have, right? We remember back in just a few years back, the pollution, Beijing, the big cities are tremendous, it's ridiculous, right? And so one of the ways to tackle this is to develop EV. These are clean energies. Now, of course, EV has another issue. EV, when you run on battery, electric cars, you can maybe run for a shorter distance, right? Well, perhaps in Singapore, not much of a problem, but in the big countries like maybe in Australia, Canada, US, and even Europe, right? Intercontinental traveling, the EVs will not be able to take you too far because you need to stop somewhere to charge, and it takes a long time to charge, right? So going forward, we will have we are really looking at hydrogen as a form of fuel, right? Hydrogen is lighter than air, right? And it can be filled up easily, and it can and by the way, if you have big truck that you need to carry loads of goods, right, on the road, it will be very heavy because of the battery size will be so big that the vehicle will become very, very heavy, and sometimes you're not allowed to be on the road because there is actually a weight limit on many highways. So we will use hydrogen as a form of fuel going forward for longer distance, for ferrying around goods and people even, right? So this is something that also in the future where it's included in the whole value chain, the whole supply chain of mobility, right? So this is to be even more ambitious. Hydrogen could be considered using in even air transport, of course in sea transport, on trains, on motorcycle, of course, and of course buses that can ferry people around. So everybody, welcome to the future. the future is now. So in BNY Mellon, we look at all these features, all this that we have seen, which the technologies are already here. It is already available. The only thing is to put them in place, which is the more challenging. Like, how do we build infrastructures that we have receive all these big data and manage and try to reduce the congestion, try to link between cars, right? And also not being able to hacked by the hackers. And you know, hacking a vehicle is a very serious thing, because it can drive you somewhere else and you cannot have control. It's not like playing with a radio, right? So all this, we see it as a whole value chain and supply chain, and that's why we're saying that the future of mobility is not just EV, where you will be hearing, our esteemed colleague talking about that in more details, and not just 5G as well, right? Which I think you have heard from our other esteemed colleague talking about 5G, how all this can be used. So in terms of mobility, we make use of all these technologies, right? This is the 4 categories that BNY Mellon Investment Manager are looking at. From connectivity, C, to autonomous, A, which is self-drive, to S, sharing, ride sharing, right? And E, electrification, which is the EV vehicle. So this is the whole area that we are looking at, and this is the really excite us so much, that because we want all those people that are able to come into the market right now, they will be the leader for tomorrow. So this is our job to identify some of all these new technology companies, and also how and all those other fringe or other site or other companies that can come together to create what we have seen, what we will be seeing in the future of transportation. Okay, so this is actually very exciting for us. This is actually something that I think we can solve a lot of problems going forward, that no longer you will see a lot of congestions, no longer you cannot find parking, right? All this can be solved, right? And then most importantly, we can reduce a lot of fatal accidents with all these safety features that we can have in the vehicle, right? And reduce the fatality to almost 90%. This is actually the target. And also going forward, the transportation, the delivery, right, can be used, self-drive or autonomous vehicle to ferry around. And then so we can, of course, this will be disruptive, right? A lot of the industry, a lot of the sectors, some factories or businesses will be affected. Okay, but it comes along another opportunities for many new business, many technologies that comes along, and this we see the whole disruptive future of mobility, right? On our daily lives, as well as on our way of living, on our behaviors, on our habits, and also, most importantly, the ESG part of it. The vehicle in the future will be able to preserve or save the earth a lot better than what we have currently, right? I cannot imagine 2 billion vehicles on the road by 2035, right? The kind of emission. So that's why we have seen in China, they are doing all these things. They are promoting, they are building EVs, challenging Tesla, challenging US, and in Europe as well. They are also very big in this area. So this is the future. I hope you enjoyed the ride, and take a look at the BNY Mellon Investment Manager Mobility Innovation Fund, and you'll be able to get excited as well.
Thank you, Paul. For the last presentation in this segment, we turn our attention to semiconductors. Most of us will remember the ongoing semiconductor shortage reaching the headlines and wreaking havoc on the world's supply chain for gadgets and cars. While chip makers are benefiting from higher prices, massive investment plans by chip makers and governments across the world could lead to overcapacity in the future. To help us examine the state of the global semiconductor industry and explore the investment opportunities within, please welcome Tan Jun, Senior Equity Analyst of Portfolio Management and Equities at iFAST Singapore.
Good afternoon, everyone. My name is Jun. I'm an equity analyst here at iFAST, and for this segment, I will be sharing our outlook for the semiconductor industry for 2022. So for many years now, semiconductors are one of the key sectors which we follow closely here at iFAST, and with some of the recent developments going on, we thought that today would be a good time to give everyone an update. So without further ado, let's get to it. So as most of you may already know, semiconductor stocks have been on a tear over the past few quarters as the cyclical upswing continues. And as of December 2021, the VanEck Vector Semiconductor ETF, which is an ETF that tracks 25 of the largest and most liquid semiconductor companies, have rebounded by more than 200% since March 2020, as investors kept pouring money into the sector, betting that chip makers will continue to perform well. So investors' optimism surrounding chip stocks comes as the global semiconductor industry continued to break record high sales over the recent months. And in the latest data available for the month of October, semiconductor sales reached a new record high of $49 billion. And in terms of quarterly numbers, semiconductor sales grew by 29.5% year on year in the third quarter of 2021, up from 25.6% in the second quarter of 2021. So heavy demand coupled with supply chain disruptions as well as greater price increases contributed to chip sales this quarter. So this in turn resulted in strong earnings growth, which fueled investors' optimism on the sector. And with such strong sales momentum over the past few quarters, chip makers, they have of course been overwhelmed by the sudden surge in demand for chips, resulting in the shortage that we are experiencing today. So this current shortage, it is mainly driven by the unusually large demand over the past 2 years as the stay-at-home economy spurred a huge increase in the sale of consumer electronics, from everything such as your laptops to game consoles and to everything else. And on the corporate side, many businesses, they have also stepped up their digital transformation efforts in the wake of the pandemic, increasing the adoption of technologies such as cloud-based services to facilitate remote working. And in a broader sense, the adoption of new technologies such as artificial intelligence and electric vehicles also contributed to the heightened demand for semiconductors. And across the board, chips manufactured using mature nodes, which are the older chips, this is where the shortage is the most severe at the moment, saw the largest price increase of roughly 25 to 40% over the past few quarters, while the most advanced chips saw their prices rise by roughly 10% over the same period. So naturally, chip makers have benefited from the rising prices during this period at the expense of other industries. And the auto industry is without a doubt one of the biggest victims of the chip shortage, as many automakers such as GM, Ford and more were all forced to curtail production throughout the year due to the lack of components. And while the near-term boost in profits for chip makers is certainly welcome, we think that investors should note that the auto industry only accounts for a tiny fraction of global semiconductor sales. Therefore, we think that investors may have overestimated the positive impact of the heightened demand for automotive chips on share prices. And during this period of high demand, semiconductor companies, they also face the risk of double ordering. So double ordering is the practice of placing multiple orders for the same part from one or more vendors. So this practice, it tends to pick up during times where demand is high and supply is low, as anxious customers panic buy for fear that they may not be able to get what they need in the future. So double ordering, it can result in artificially inflated demand, causing chip makers to overproduce. So when demand eventually normalizes, these customers, they may be stuck with an excess amount of chips, which leads to smaller or worse cancelled orders in the future. And should this scenario materialize, it could definitely hurt semiconductor companies. And lead times, which is the duration between placing an order and taking delivery for the part, is an industry measure that is used to gauge demand. And as of December, semiconductor lead times have stretched to more than 25 weeks, close to double the average of 13 weeks before the pandemic arrived. So although rising lead times may in part be due to supply chain issues, there is a good chance that customers today are stockpiling over fears that they may not be able to get what they need in the future. But as we head into 2022, there are signs that the shortages are already starting to peak. In the latest measurement in December showed that lead times only increased by 3.2% over the previous month, which is a much slower pace compared to an average increase of 4.9% between January and November 2021. But even as the situation shows signs of improving, the industry is still facing tremendous pressure by stakeholders and clients to meet the growing demand for semiconductors. And in an effort to alleviate the shortage of chips, semiconductor companies, they have been furiously investing to build capacity or have announced plans to increase their capex spending. So earlier this year, TSMC announced that it intends to spend $100 billion over the next 3 years to increase capacity to support manufacturing as well as the research and development of advanced semiconductor technologies. Meanwhile, its competitor Intel is budgeting for a capex of between 25 to 28 billion US dollars in 2022, which is substantially above the 20 billion it is projected to spend in 2021. So other chip makers that have guided for significant increases in capex includes memory maker Micron, as well as TSMC's competitor UMC. So in total, worldwide semiconductor capex is expected to surge by more than 40% in 2021 and reach a new high of 152 billion US dollars, which is up from 109 billion dollars in 2020. So what is worrying is that it is not just chip makers that are investing heavily. Several countries are also looking to shore up the domestic production of semiconductors after the events that have transpired over the past 2 years. So the US government, for instance, is looking to introduce the Creating Helpful Incentives to Produce Semiconductors Act, otherwise referred to as the CHIPS Act. So the CHIPS Act will see the US set aside $52 billion to invest in semiconductor manufacturing incentives and research initiatives over the next few years. So it aims to sustain America's leadership in chip technology and also to attract more companies to locate their manufacturing facilities in the US, which accounts for just a meager 12% of global semiconductor manufacturing capacity today, compared to roughly 30% a couple of decades ago. And over in Europe, policymakers are also contemplating a similar act to double the region's semiconductor output by 2030. And on the other hand, China, which is the biggest geopolitical rival of the US, is also accelerating its efforts to build up its own semiconductor industry after a series of sanctions by the US hobbled its semiconductor and electronics manufacturing industry. So citing national security issues, the US actually placed a number of Chinese companies on the entity list, effectively cutting off their access to US suppliers. So SMIC and Huawei are among those which have been heavily affected. And in response to these sanctions, China has actually implemented several supportive policies to build up its semiconductor capabilities. So such policies include the creation of a national fund, as well as making significant adjustments to its tax policies, allowing chip makers to pay lower taxes, or in some cases even be tax exempt should they meet certain requirements. And according to China's Made in 2025 plan, the country aims to produce 70% of all the chips that it consumes by 2025. And with such a sudden and sharp increase in capex, we fear that chip makers and governments alike are becoming overly optimistic, which could set the stage for a severe down cycle once demand tapers off and supply chain issues are resolved. So the semiconductor industry, it is notoriously cyclical, which we can tell by the fluctuating sales growth numbers as we have seen earlier. And when times are good, such as now, manufacturers, they tend to overestimate demand, which leads to higher than normal production levels and capacity expansion activity, which could result in supply-demand imbalances. And even though demand has been pretty robust throughout 2021 and for the second half of 2020, we think that it should begin to normalize in 2022 as new capacity gradually comes online. So while the sudden and sharp increase in demand that we have seen over the past 2 years may be explained by supply chain disruptions and the growing adoption of digital technology in the wake of the pandemic, such high levels of growth are generally unsustainable over a prolonged period of time. And furthermore, the demand that we are seeing today may be artificially inflated due to double ordering, as I have explained earlier, and this actually adds to the risk that it may not be sustainable. And when demand eventually normalizes, this large increase in capex will start to take a toll on the industry as it grapples with an inventory buildup and an overcapacity. So when this happens, what chipmakers will do is they will have to lower prices and cut down on production as they work through the excess inventory, causing sales growth to fall. And this actually marks the start of a new down cycle in the industry. So right now, there is a potential glut brewing in the $120 billion memory market, which accounts for roughly 30% of total chip sales in 2020. So in the memory market, DRAM prices have actually tumbled by more than 40% since January and will likely fall further in 2022 as supply growth is expected to outpace demand. So several chip makers, they are already sounding the alarm warning bells, projecting that DRAM sales growth in 2022 will likely be weaker compared to 2021, owing to higher inventory levels and a slowdown in procurement activity across most of the major segments, such as personal computers, mobiles, and servers. Moving on, with share prices still hovering near record high levels, the valuations of semiconductor companies remain stretched. And as of early January, the industry is currently trading at about 21 times 2023 estimated earnings, suggesting that it is slightly overvalued at this point in time. And with earnings growth expected to remain tepid, we have decided to maintain our 2.5 stars neutral rating for the semiconductor industry. So while we have no doubt that the future of the semiconductor industry remains bright, driven by secular growth trends such as 5G, the Internet of Things, electric vehicles, and more, the industry is still affected by short-term factors such as supply-demand imbalances, which gives rise to its cyclical nature. And from what we observe, we feel that the semiconductor industry may be on a cusp of a new down cycle, led by a massive increase in capex spending and a level of demand that does not look to be sustainable in the long run. So considering that most of the good news has already been priced in, we think that at this juncture, the semiconductor industry, it carries more downside risk than upside potential. And for investors who have been following our call since 2019, I think that you will likely have made some decent profits already. And as such, we recommend that investors start considering to take some profits off the table and wait for a better opportunity to enter this sector. And with that said, we will continue to keep a close eye on the semiconductor industry and provide updates should there be any significant developments. Once again, my name is Terjun. Thank you all for joining us today, and I'll hand the time over to our MC.
Thank you, Terjun. And that wraps up this morning's segment on investing like the IT crowd. We will now head for a lunch break and resume at 1:55 p.m. right here, so don't go away. There will be more presentations to come as well as we discuss financials, the prospect of interest rate hikes, and investing for our planet. If you have any questions regarding the presentations today, please leave them in the Q&A section and we'll have our speakers address these questions later on today. Also, do note that you can receive 3,000 rewards points simply by opening a new FSM1 account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is WAWTI2022. Also, from now till December, FSM1.com is offering 0% processing fees on ETF RSP. You can pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. Also, take this chance to accumulate chances for the lucky draw where 8 lucky showgoers will each walk away with $100 FSM1 cash account credits. We will also have 3 grand prize winners who will receive $1,000 FSM1 cash account credits each today. Gain more chances to win the lucky draw by attending the event on both days, visiting sponsor pages, joining our daily quiz, and sharing the event via social media. Each time you do those things, you add to your tally of chances. Do ensure you always use the same ID and email address when logging in. Now be sure to join us again for even more insightful presentations starting at 1:55 p.m. We'll see you later.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
Here's my investment resume.
歡迎你嚟到我嘅 YouTube channel.
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune into iFast TV if you want to hear all these different programs in the different languages and dialects.
I must have been in my early 20s when I started investing.
Started working in a stockbroking firm as an investment analyst.
Later, I really find that investment was my passion, so
I just went to buy my first stock, and that was how I started.
Investing is never about punting. It is about taking a long-term view.
It's always about the evolution because market do change, and as an investor, we need to be adaptive.
Well, firstly is earnings potential of the company.
Understand the business model of the company.
The uniqueness of the product and the instrument.
The investment must support who I am, my life decisions.
Hi, I'm Wee Kyung.
I'm Alvin. My name is Christopher.
I'm Lim Chang Chun.
I'm Kenny.
Here is my investment resume.
Welcome back, everyone. I hope you've had a great lunch break. Before we begin, I'd like to draw your attention to the promotions FSM1.com is running. Receive 3,000 rewards points by opening a new FSM1 account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is WAWTI2022. From now till December, FSM1.com is also offering 0% processing fees on ETF RSP. You can pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. Now don't forget also to accumulate chances for the lucky draw, where 8 lucky showgoers will each walk away with $100 FSM1 cash account credits. And 3 grand prize winners will each receive $1,000 FSM1 cash account credits today. You can also gain more chances to win the lucky draw by attending the event on both days, visiting sponsor pages, joining our daily quiz, and sharing the event via social media. Each time you do these things, you add to your tally of chances. Now do ensure you always use the same ID and email address when logging in. Now let's kick off this segment on money hikes and all the money in the world. While the global financial sector has had a great run in 2021, Chinese financial stocks have largely lagged behind their international peers. In this fireside chat, Mo Hon Ming, Director of FinTech Media and co-founder of iFast Singapore, sits down with Ferlin Tan, Senior Equity Analyst of Portfolio Management and Equities at iFast Singapore, to discuss the overlooked Chinese financial sector and why they believe it is one of the most attractive investment opportunities globally.
Hello, everyone. When we're investing in stocks, we want to buy low and sell high. So when are stocks low? Okay, there are a few situations. One is when there's a crisis, like during COVID in March of 2020. There was another situation in December of 2018 when the US and China had a trade war. Another situation could be when it's at the bottom of a cycle. Okay, so some of our colleagues have shared with you some of these ideas. You want to buy at the bottom of the cycle and then ride the cycle on the way up. The third situation is when the market sometimes have just forgotten about a certain sector. They've ignored it for a time, and meanwhile the stocks in that sector have continue to increase in their revenues and earnings. So I think one such sector is Chinese financials. So let's take a look at that today. Here we have a chart that shows the blue line is the S&P Global financials. You see that that's going up. And then the red line is more or less flattish through the last couple of years. So why is that the case? So of particular interest to us today are the Chinese banks. Okay, so the big 4 banks in China, namely you have Bank of China, you have Agricultural Bank of China, China Construction Bank, and ICBC. These banks we see are actually trading at very attractive valuation, especially when compared to their global peers. So here you have a chart that shows the bank's price to book ratio of the US banks and Singapore banks. And then the red line is the Chinese big 4 banks, and it's trading at much lower level in price to book ratio than the others. So we have Ferlin, who's been covering this sector for iFast. And so the first question for you, Ferlin, is what is price to book ratio, and why is it important to investors?
Okay, thanks, Hong Ming. So maybe to the basics, book value is essentially the difference between a company's asset and liabilities, and also what we commonly hear as equity value. So for a bank, they are a kind of a balance sheet driven kind of company, which means that they derive most of their value from their book value, and their earnings are dependent on what's on their books. So for instance, the banks, they take in customer deposits, which are part of their liabilities, and they extend out loans, which will be part of their assets. And whatever profit that's derived from such banking activities are then parked under their equity value. So in a way, we believe that a bank's book value is a good indicator of what is the bank worth. And on top of that, when it comes to accounting for banks and other similar financial institutions, their assets and liabilities are usually marked to market, which means that if you look at their latest quarterly or annual report, you do not need much subjective adjustments, which is also why, like you have mentioned, we like to look at price to book value for banks. And if you have realized, most of the time when we conduct analysis on banks and or similar financial institutions, we usually use the price to book ratio as the valuation methodology.
Okay, so that's what price to book ratio is. So I guess the next question is, why is it so low when compared to the other banks?
Yeah. Okay, so for I guess just now we mentioned that how the bank's book value are always marked to market. So technically, it should be trading at its book value, right? And obviously, the big four banks, that's not the case for them. And in our opinion, we believe that one of the biggest reasons could be that they believe that the Chinese banks' future profitability, as measured by their return on equity, is going to be disappointing relative to their cost of equity. Or in some cases, they believe that the bank's book value is overstated.
Okay, so banks' book value could be overstated, and there's a worry that the earnings might not come in as strongly. But at 0.4 times book value, it does seem like, are people overly pessimistic?
Well, okay, so we understand that, of course, there's this concern when people are overly pessimistic because, you know, the Chinese big four banks, they are usually asked to conduct national service where they have to lend out money to certain industries or companies where under normal circumstances, probably a profit-driven private bank will not do so. And while we do not exactly know the breakdown of their loans, what we do know is that over the last couple of years, the big four Chinese banks, they have been increasing their provisions against the bad debt, and especially during the COVID-19 pandemic as well as the recent property sector crisis. And so in the upcoming second half 21 interim report, we are likely to see higher non-performing loans as well as higher provisions against bad debt. But despite so, the Chinese banks are still very well capitalized. So, and if you take the Huarong case earlier last year as an example, you can see that the Chinese government is now comfortable to let these big companies to go almost out of business. And this is a scenario that is probably unthinkable just a few years ago. So we think that this is a sign that the government is now confident enough of their banking sector, and they are confident that they are able to withstand such strong economic shocks for the banks. So I think that this is something that perhaps the investors can pay attention to instead.
Okay, so that's price to book. Let's move on to another number, the dividend rate. Maybe you can start by explaining what that is and how that's important.
Okay, so dividend rate is a function, dividend is a function of two things. It's the dividend per share as well as the current share price. And when a company is offering high dividend yield, this would mean that perhaps the dividend per share is high now and the current share price is low. So in the case of the Chinese big four banks, they are offering at about, I think, 7 to 8%. And what this means to investors is that, let's say you are, it means that you will receive approximately $800 worth of dividends if you invest $10,000 today. And of course, assuming the dividend per share doesn't change.
So it's almost 8% dividend. And how often do they pay that?
Okay, so for Chinese banks, they're a little bit different from the US and Singapore banks where they pay their dividend on a quarterly basis. For the Chinese banks, they only pay out once every year.
Oh, okay, once a year. But this 8%, has it been growing? Is it sustainable? Can they continue to pay at this rate?
So as a matter of fact, the dividends, they have been rising over the last couple of years. And during this period, the dividend payout ratio is also low at about 30%. So if we use the dividend payout ratio as a measure of sustainability and coupled with rising profits, we are inclined to believe that the Chinese Big Four banks' dividends are indeed sustainable.
Okay, so that looks like a very impressive chart. So they've been increasing the amount of dividends that they've been paying. So I suppose that they are only able to do that if their profitability has been increasing as well. So maybe can you tell us more about their revenue and profits?
Sure. Okay, so for the revenue and earnings over the last couple of years for the Chinese Big Four banks, they have been rather stable. And we are also positive on the outlook of their revenue and earnings going forward, since China is on track to become the world's largest economy, and we believe that the Chinese Big Four banks will be one of the main beneficiaries, especially from the loan perspective, since loan growth is usually a function of GDP. So speaking about loan growth, I think right now there are a lot of concerns about the outlook of the Chinese banks' loan growth, especially because of this property sector crisis. So while right now I think I guess investors need not to be so overly concerned about the loan growth as well as the asset quality of the Big Four banks, because even though the Big Four banks, they derive a fair bit amount of their loans from property-related sector, most of which are actually in the form of mortgage loans. Which means to say, we also know that in China, if you were to purchase a home, you will probably need to fork out huge amount for the initial deposits, which we believe this greatly reduces the risk faced by the mortgage lenders, which are the Chinese Big Four banks in this case. And as for the remaining property-related loans to property developers are usually collateralized. So according to Bloomberg, about 70% on average of the bank's loans, they are secured with collateral, pledges, and guarantees. And finally, whatever slack that was left behind by the property-related sectors, we believe that this can be picked up by other sectors such as manufacturing and infrastructure. So in China's 14th five-year plan, the Chinese government announced that it will be building 30 new airports and thousands of kilometers of new railways and highways in the next 5 years. And on top of that, during the same 14th five-year plan, the Chinese government announced that it aims to build China to become a manufacturing powerhouse, where they will be upgrading their current industrial and supply chains. And we believe that all of these will support the loan growth for the Chinese banks going forward, which should help to support the overall Chinese banks' revenue and earnings.
Okay, so there's lots to look forward to in terms of how the revenue and earnings can grow. But in terms of the price to earnings ratio as of now, I think we're looking at something like only 5 times PE. Can you comment on that?
So for PE ratio, it is essentially the current share price in relation to their earnings, and which is basically what the market is willing to pay today based on their current or future earnings. So, but whatever I've mentioned earlier, the banks, they are balance sheet driven kind of companies. So usually we prefer to use the price to book value as the main indicator to look at. But of course, if you look at the PE ratio of the Chinese Big Four banks and compare it with the international banks like the US banks and Singapore banks, I think it can give you an indicator as to how the Chinese banks are trading at a very depressed level. And in fact, it gives a good sense that the Chinese banks are indeed very undervalued.
Okay, so we've looked at price to book ratio, which is hovering around 0.4, 0.5. And then we've looked at dividend rate, which is around 8%. And then we've looked at PE ratio of only 5 times. So those are the measures that indicate to us that this sector is really very cheap and largely ignored. Let's go to some macro questions, bigger level questions. So when we say the Chinese banks, we know that they're owned by the Chinese government. How much of a share does the Chinese government have in these banks? And is that a good thing or bad thing?
Okay, so as we were saying just now, the Big Four Chinese banks, they are state-owned. So I think about 40 to 50% of their shares are actually owned by the Ministry of Finance or through other arms of the government. And I think when it comes to that, there are good and bad things. But one of the big concern investors have is the fact that, like I've said earlier, they have to conduct national services and lend money to certain industries and companies to help them tide through the bad times so as to ensure social stability. So if we take reference to the Huarong case again, earlier last year, ICBC and perhaps other banks, other major banks, they were asked specifically to lend money to Huarong to help them tide through the short-term cash flow needs until there's more clarity on the restructuring process. So from this example, it seems that the loan extended out by ICBC and other banks can be viewed as a transitory arrangement. And I think it's highly likely that the banks will have to provision against these loans to such industries, and this inevitably drag down on the bank's profitability. So from this example, you can see that there is this certain risk faced by the state-owned banks, and where it kind of hinders the bank from reaching their full potential because they could have used the money and put it into better use. But on the flip side, because the Chinese government is the major shareholder of the Chinese Big Four banks, this also means that they are probably reliant on the dividends for a certain aspect of their budget. And it is in their interest to ensure sustainable and rising dividends, which I think may be good for investors as well.
Okay. So let's go to the bigger question of globalization. I think China's economy is growing very rapidly. So it's a matter of time before it becomes the #1 economy in the world. And when that happens, I think China will have to open up more. There needs to be greater transparency. And so the Chinese banks have been kind of protected within China. So at a future time when the economy opens up, will the Chinese banks be able to phase up to international competition?
Okay, so basically, opening up the financial market, this is definitely going to introduce more competition within the financial space. But we don't think that all is bad. So for example, investment banking and other securities services right now, they are off limits to the commercial banks because the government wanted to minimize the risk across different parts of the financial system. But today, as they open up their financial market, to better prepare their domestic players against the large foreign players like JP Morgan or Morgan Stanley, they are now looking to break down this wall between the investment banks and the commercial banks. So there was a report stating that they are looking to kickstart the trial where the two candidates are going to be ICBC and China Construction Banks, where they will be allowed to perhaps to service the investment banking side of things. So this clearly means that there will be new revenue streams for the commercial banks, and if this is successful, it will be probably this trial will be opened up to other major banks as well. And I think that this will serve as a long-term re-rating catalyst for the Chinese Big Four banks. And on top of that, just now you mentioned, if you open up the financial market, Chinese financial market can be more transparent. They will grow to become more transparent, and I think this will attract new investments from investors who were previously uncomfortable with how opaque the financial market is in China. So these are all, I feel, while there's a higher competition, there's also this also might lead to more re-rating catalysts for the Big Four banks.
Okay, a lot of very good information so far. So I guess if I just throw you like a general catch-all question, what else is different between the Chinese banks and the global banks?
Okay, for that, this actually circles back to the previous question. I think one of the biggest difference between like international banks like US and Singapore banks versus the Chinese banks is that the US and the Singapore banks, they derive about 30 to 50% of their net revenue from fee income, whereas for Chinese banks, they are still very reliant on net interest income, where they only derive about 10 to 20% from their net fee income. That to us is like one of the biggest differences.
Oh, okay. So it mainly derives its earnings from loans that they make to loans that they make,
Yes.
and not from the fee income from services that they provide.
Yes.
But you were saying just now that it looks as though the Chinese banks will be allowed to conduct these activities in the future.
Yes.
So they would have new revenue streams that will allow them to offer the same services as the global banks, and thereby increasing their earnings from fees.
Yes, that too. Yeah. So we also believe that one of the reasons, like perhaps the US and Singapore banks, they have a higher multiple is because of like how their business model is more diversified. So yeah, so in general, we think that there's actually quite a bit of a long-term re-rating catalyst that the Chinese banks might have in the next few years.
Okay, great. I think we've had a good overview of the entire sector. Maybe let's talk about how we can invest into the market.
Yep. Okay. So for investors who are looking to gain exposure to the Chinese banks, there are currently two options to consider. So on the screen, you can see there's the China AMC Hong Kong Banks ETF that's listed on the Hong Kong Stock Exchange. And the second one is the Global X MSCI China Financials ETF listed on New York Stock Exchange. So on the screen, you can see that we have compiled a list of relevant metrics comparing the differences between the two ETFs. And as you can see, China AMC Hong Kong Banks ETF, it gives you exposure to just the banking industry, and the big four banks make up over 50% of total assets. As for the Global X MSCI China Financials ETF, it gives you exposure to not just the banks, but the entire Chinese financial sector, which includes your insurance companies and other diversified financials like CITIC Securities. But since Chinese financials, as discussed earlier, they are good dividend plays, one glaring disadvantage of the CHIX ETF is the fact that it is subjected to 30% dividend withholding tax, given that it is listed in the US. So its average dividend yield after the withholding tax is about 4.6%, which is lower than the average dividend yield of the China AMC Hong Kong Banks ETF at about 7+%. But of course, it also has its merits. Like I've shared earlier on, it has a more comprehensive representation of the entire China financial sector, as it includes insurance companies and diversified financial services firms, both of which are not represented in the 3143 ETF.
Okay. So I started this segment saying that I think this area has largely been ignored by investors. So one of the maxims of value investors is that if you buy companies of good value, if they're cheap enough and they have certain catalysts for growth, eventually the market will recognize the value and the share price will increase. But of course, when this eventually will be is hard to say. It could be ignored for some time still, but in the meantime, you're comforted by the fact that you're collecting 7 to 8% in dividend. I'll give Ferlin the last word in terms of how do we see, if you can just summarize your view of how we see Chinese banks, and what do you have like a target in mind?
Okay, sure. So to just wrap up everything, I think going forward, regulatory risk is still something that investors should take note of, given how the regulatory landscape remains to be fluid in China, since how it is still undergoing rapid economic development. So perhaps regulators are still trying to think of the most appropriate regulations to impose on the financial institutions in order to promote healthy and sustainable growth. But despite all that, despite the regulatory freeze as well as the extra premium that China Big Four banks have because of their state-owned status, we still see more upside potential than downside risk for the Chinese banks. So we believe that investors who have the risk tolerance and also the patience to wait for a re-rating in the longer term can consider the Chinese Big Four banks to be an attractive industry to be in today.
Okay, so is there like a target that we can look forward to?
Right. So you can find more information on our website, but right now we actually believe that there's room for Chinese Big Four banks to actually almost double, given how it's trading at an all-time low at 0.4 times percent. 0.4 times, yeah.
Okay, and with that, we end our segment, and I hand you back over to the MC.
Thank you.
Thank you, Hon Ming and Ferlin. With the new Omicron variant surfacing and possibly tighter monetary policy in 2022, how should investors manage their portfolios to reflect changing market dynamics? Will inflationary forces become a permanent feature of the new market landscape, and how will fixed income portfolios be impacted? On this panel to discuss their outlook for the new year and what the results could mean for financial markets and bond investors are Sarah Chia Business Development Manager from Bond Supermart IFAS Singapore, Dexter Tan, Senior Fixed Income Analyst, Bond Supermart IFAS Singapore, and Lim Teng Chong, Fixed Income Analyst, Bond Supermart IFAS Singapore, and Cheng Jing Yen, Analyst, Unit Trust Research and IFAS Singapore.
There's been so much talk about inflation now, where it's headed, how do we deal with it? And honestly, it can all be quite a bit to take in. So I guess the best way for us to kick off this session is to try and understand it on a more personal level. Teng Chong, Jing Yan, Dexter, could you share with us a bit more on how inflation has really affected you on a personal level? Maybe Teng Chong, you can start first.
Yeah, sure. I think on a more personal level, housing prices have impacted me the most.
Oh.
So I'm looking to buy a BTO or resale flat.
Oh, congrats!
Thank you. And I think the housing prices have increased over the years. And as a young adult looking to buy a flat, I think it's quite worrying. And and now that I remember, my girlfriend was also complaining to me the other day that McFlurry used to cost $2. And now it's $2.70. Yeah, it's quite a significant increase. And I think inflation affects everyone differently, and the effects can be felt even if you're not an investor.
Jing Yan, how about you? The housing prices also?
Yeah, while inflation affects people differently, it affects us the same for some reason. So I came across some statistics when I was looking for a new place. So apparently private housing prices have gone up about 9%. And resale prices about 15%. So that is quite a big number. Yeah, and outside of housing, I was trying to look for some electronics recently, some upgrades for my own stuff, and also can't find anything that is reasonably priced. Everything is very, very expensive now.
It's unfortunate.
Yeah, I think for myself, I think because of buying food, I think it's quite noticeable that food prices have also gone up. This place whereby I used to buy egg tarts near my office, used to cost about $120, but now it's gone up to $160. And then I think if we take the train or even the MRT, I think the Public Transport Council has said that they've already raised the prices by 4 cents. So maybe my trip used to cost about $164, but now it costs about $167. Yeah.
And it all adds up, right?
Yeah. I mean, everything I think is affected all of us on a personal level.
Yeah. Well, when we look at inflation, we also look at CPI numbers. Teng Chong, could you tell us what are the components of CPI?
Yeah, sure. So the CPI tracks the change in prices of a fixed basket of consumption goods. It's mainly generally used by the general population. So examples are like housing, education, healthcare, and food prices, to name a few. And MAS also monitors a core inflation measure, which excludes accommodation and also private transport, as these are more influenced by supply-side policies rather than demand-induced inflation. So, for example, limiting your amount of COEs issued are likely to cause an increase in car prices rather than demand.
Well, do you guys think that Singaporeans should be concerned about inflation? Dexter, any thoughts on that?
I think Singaporeans should be concerned, especially if inflation continues to rise at an unsustainable rate. So the keyword is really unsustainable.
Okay.
If we continue to see inflation going up at a very high, fast pace, I think, as mentioned earlier, all of us have seen the real effects of inflation, and it's seen to be ranging from food to public transport to even housing prices. And then if you look at it in a local context, business costs has also been rising, and the cost of running a business has gone up, maybe because of labor shortages to hire foreign workers to come into maybe to Singapore to work. It's because of border controls, and then looking at also other like freighting costs to import goods and all that. And then there's also this issue of GST. So not only operating costs, but also GST could be raised this year. And maybe we could also even see a carbon tax, whereby if companies which gives the incentives to decarbonize. So I think you add up everything, the cost of running a business is getting higher. So this cost will be ultimately translated into higher prices of goods, and the effects will be felt by the consumer. So I think, if this continues, then Singaporeans definitely should be concerned.
Yeah, the thing is though that a lot of Singaporean investors or consumers may think, hey, a lot of the crazy inflation numbers, your 6.8%, your 7%, that's all in the US. That's so far away. How would that affect me? Why should I be concerned?
Well, the implication about investing in the US, inflation in the US is that you have to think about how it translates to their monetary policy. So right now, I think many markets or those leading banks are already pricing in 3 to 4 rate hikes this year. So we are looking at monetary tightening over in the US. So to understand how this will affect us here in Singapore, you first have to consider how the MAS controls our monetary policy to make sure that we get our sustained growth, right? So they normally do this through adjusting the band for their exchange rates. And the consequence of this is that you inadvertently lose control of your monetary policy in terms of your interest rates. So by losing control of your interest rates, we are essentially a price taker here. So as the US hikes its interest rates, our interest rates will likely follow, and maybe you will start to see it soon through our reflected through maybe our mortgage interest rates and bank deposit rates maybe.
Right. So as a quick recap on what the Fed is doing, they will be quickening their pace on their asset tapering efforts. They will be reducing their balance sheets, they say. And we anticipate 3 to 4. And just now you were saying, Jamie Dimon was saying possibly even 6 to 7 this year?
Yeah, I think yesterday he said around 6 to 7. So JP Morgan released their Q4 earnings yesterday, and I think Jamie Dimon said maybe even 6 to 7 rate hikes.
That could be a bit frightening. And that's just for this year. We might even see another 3 more next year. So my question is, will the Fed's actions really help us to combat inflation? Will it bring us closer to the targeted inflation band? Do you guys have any thoughts on that?
Yeah, maybe I can speak on that. So theoretically speaking, if they raise interest rates, definitely you have an impact on the economy because you have lesser money in circulation, and that will affect demand, and inflation should moderate. If you look at the Federal Reserves themselves, so they say they want to raise rates, right? But if you look at their forecast, so they actually give economic forecasts, and they project that inflation will moderate this year. So it will moderate to be from 5.6, maybe 5.3% last year to about 2.6% this year. So in Singapore, MAS is also expecting inflation to fall to about 1.5 to about 2.5% this year. So even though we are going to see inflation moderate, I think we still have to be cognizant of other exogenous factors, so things that are driven, that will drive commodity prices, because commodity prices would still affect inflation to a certain extent. So commodity prices can be affected by like geopolitical events or even tensions between countries. Like if certain countries are like big suppliers of commodities, then they, let's say if you have a war there's this tension between Russia and even Ukraine, or some because Russia is a big exporter of commodities, then if there is some event over there, it will also affect the supply of oil, and therefore you'll see higher oil prices. But within the agricultural space also, there's also some weird weather patterns. So there's patterns.
You just shared about that during our earlier panel, right?
Yeah. So which is why I'm bullish on agricultural commodities. Okay. Okay. So those weather patterns will have an effect on prices. So they will definitely. So even though inflation is expected to moderate, we should be cognizant of these exogenous factors.
I think so far we've been talking a lot about how this is going to affect us as consumers. How So the next question is, how is it going to affect us as investors? How would it affect your bonds and your fixed income funds? Maybe with Dexter first, and then we can hear from Xing Yan about the funds.
Yeah, definitely. I mean, if interest rates go up, then because interest rates and bond prices are like inversely related. So when interest rates go up, then bond prices may fall. But I think the impact will be different across different types of bonds. So, for example, long-term bonds will be more affected because long-term bonds are actually more sensitive to interest rates, whereas short-term bonds are less sensitive to interest rates. And then if you look at investment grade or versus high yield, investment grade will definitely, because the investment grades have lower coupons, so investors of investment grade bonds would feel will see lower total returns compared to high yield investors. So I think the bottom line is that when interest rates go up, I think long-term investment grade bonds will have a more negative impact compared to short-term high yield bonds. Yeah.
Okay. Xing, how do you feel? How is it going to affect your fixed income funds?
Well, naturally for funds, as the underlying gets affected, you tend to see the same reaction in terms of the fund prices. But also because they are actively managed, so you get the fund manager's input when it comes to this kind of investment decisions. So fixed income funds generally have been keeping duration low for quite some time because of since rates have been low since 2008, they are kind of preparing for this normalization of the sort of the monetary policy in the US. So because they are already preparing for this, the duration has already been kept low. So we are less likely to see very significant impact in terms of fixed income funds.
I see. Okay, well, I'm not sure if you guys recall, and our listeners as well, but late last year, Temasek, they actually issued a 5-year SGD retail bond with a coupon rate of about 1.8% per annum. Unfortunately, in this space, we don't get a lot of new retail bonds coming up. So this was kind of a big deal. Anyway, I'm bringing this up because I'm thinking of using this as an example to understand how a bond can be attractive under like a couple of scenarios. So maybe Teng Chong, you help me with this. So just to understand, if I have this Temasek 5-year SGD retail bond in my portfolio and the rate hikes happen, generally speaking, what will happen? What can I expect?
Yeah, so I think Dexter has mentioned this just now. Bonds have an inverse relationship to interest rates. So when the cost of borrowing increases and bond prices will fall, and vice versa. So for example, the Temasek 5-year retail bond, we will likely see the bond prices of the bond falling.
Okay, and let's say after all the rate hikes this year, however many may happen, what if they issue another 5-year SGD retail bond, or what could we expect?
Yeah, so we will likely see the bond price, the coupon of the new issue be higher than the existing 5-year retail bond. Yeah, so I think investors have to take note and anticipate of how many rate hikes to come this year and also next year.
Yes.
Yeah.
And so by virtue of that, you're saying that essentially if let's say they issue another 5-year SGD retail bond, the year after that, investors should basically just prepare for it in the same way as well. Yeah.
Yeah, essentially that. And I think investors should take note of the inflation numbers and anticipate for any further rate hikes to come in the future.
Okay. So then my next question is, should investors really be buying bonds in a rate hike cycle? Because clearly that Temasek example I quoted just now, it didn't work out so well.
I don't think we should rule out bonds. I think there's always buying opportunity even during a rate hike cycle. So the example given is an investment grade bond, and they are more susceptible to interest rate risks.
Yeah.
So as their spread mainly depends on interest rate. So bonds with longer duration will also face more volatility when interest rate rises. So I think investors can look into shorter duration during this period to find opportunities that they can capitalize on.
Okay, so we should still be buying bonds.
Yes.
Investors should still continue with that. Okay, then I guess next, if we look at it, then how should investors be positioning their portfolios in a rate hike cycle? Dexter, any thoughts on that?
I think definitely, as I mentioned earlier, we can buy short-term high yield bonds, and then Teng Chong. So there's definitely high opportunities in the rate hike cycle. So, but then No doubt, I mean, if interest rates go up, then there will be some impact on bonds, but I think we shouldn't really like rule out bonds entirely because I'm also challenging the assumption that hikes, there will be interest rate hikes. So we don't know how different asset classes may behave in future, or whether how the markets will behave. Maybe if we see a fall in prices, or it can also some natural disaster or some exogenous event, it may also affect their outlook for interest rates. So we can't really tell, even though expectations is really high right now, but is that asset classes will behave differently. So historically, like maybe if you look at gold and US dollars, even though they also have an inverse relationship, but there are also times whereby these gold and US dollars can also go up at the same time. Yeah, so I think we shouldn't rule out bonds, even though there's going to be interest rate hikes. It's always good to keep a diversified portfolio. So I think that is really key. Yeah, diversification. Yes.
Jingyan, how do you feel about that?
I think Dexter has emphasized the importance of diversification, and I very much agree with what he's saying here. People tend to only realize that their portfolios are not diversified, or they only start to miss it after it's too late and they've lost some money. So have to re-emphasize how important this is. But even then, I think that it is also very important for investors to keep this interest rate risk in mind and to manage the risks. So I think we have mentioned short duration a few times. So keeping duration short should minimize interest rate risk. And while high yield is also another plausible alternative, we would also like to caution investors about undertaking too much high yield into their portfolio, because you're essentially trading off interest rate risk here for credit risk. And as we have seen this year in the Asian high yield space, taking too much credit risk can backfire sometimes as well.
So diversification again.
Yes, so diversification again. So the last thing I would like to point out is that there are opportunities today, because while in many countries are tightening monetary policy and raising interest rates, there is one major economy that is very likely to do the opposite. And of course, that's China. So China has had a very bad year. They face a lot of headwinds, and this has led to slowing growth within the economy. So we are likely to see China ease their monetary policy in order to try to kickstart this growth that in 2022. And in a loose monetary environment has traditionally been very conducive for fixed income assets. And within the space, we like Chinese government bonds for two reasons primarily. Firstly, they have shown resilience. Their prices have remained relatively steady even through the Asian high yield market. And secondly, they've also shown quite low correlations to treasury yields, which we like going into 2022.
Okay, well, thank you so much, guys. So I guess if I were to conclude for everyone here, I think our key takeaways, we probably have three, right? I think, so number one, in Singapore, we're still very interconnected to the world. So rising inflation in major economies is something that it's something that can affect us, and we should care about it, correct? Yeah. Secondly, rate hikes and the effects of it are real, but it doesn't mean that we cut off bonds and fixed income entirely. Investors should still invest in them, but make sure that you embrace and position for the rate hikes. And you can also look out for short duration. You mentioned that, high yielding, and if you're interested, Chinese govies as well. Okay, and thirdly, the last point is to, as always, remember to diversify your portfolio. I'm afraid we are running out of time, and we'll have to move on to the next speaker. But if you have more questions on fixed income, then stay tuned for the Q&A segment at 4:30. Dexter will be there. Alternatively, join us on our upcoming webinar on the 25th of January at 7 p.m, where we can share with you more about our first half 2022 bond picks. Thank you.
Thank you, panelists. An area of investing that has been gaining more attention lately is that of ESG, or sustainable investing. As we kick off this segment of investing for our planet, we start with two key sectors that you ought to look at as the world embraces sustainable investing. Here to discuss these ideas are Falin Tan, Senior Equity Analyst of Portfolio Management and Equities at IFAS Singapore, Yo Hui Shi, Equity Analyst of Portfolio Management and Equities at IFAS Singapore, and Chloe Halim, Equity Analyst of Portfolio Management and Equities at IFAS Singapore.
Hi, good afternoon everyone. Welcome to this session on investing for our planet. So again, I'm Falin and sitting beside me are Hui Shi and Chloe, and we are all from the research team in Singapore. So for the next 20 to 25 minutes, we'll be discussing more about the sustainable investing, and also we'll be diving deeper into two key industries that we believe will benefit as the world embraces the concept of sustainable investing. So sustainable investing, it has been around for a long time, but interest and awareness seems to have accelerated over the last couple of years. So it's a really broad investment approach that incorporates not just financial returns, but also social and environmental objectives. But basically, investors are just not looking at financial returns only anymore. And one of the most direct ways to conduct sustainable investing is to look at environmental sustainability. So we have all heard scientists' warnings about ice caps melting and sea levels rising, but many of us still don't quite grasp the severity of the harm we have brought to our planet. And the rate of our consumption of the Earth's natural resources is also unsustainable. So if continued, we are bound to face some adverse environmental consequences. So we must redefine our way of life and consumption by integrating more responsible and sustainable actions into our daily lives, be it to reduce our energy consumption or make a conscious effort to produce less waste. We need to place environmental sustainability at the core of our society. And many firms have also come to understand this, embracing sustainable business practices. And with technological advancement, sustainable living is becoming more of a reality, marking an abundance of opportunities for investors looking to cash in on this trend. Environmental sustainability is key in today's context because of numerous reasons. So not only the business will not be supported if it doesn't factor into account sustainability, but unsustainable businesses will cease to exist one day. And what is the point, of investing in something that doesn't have a future? So in today's world, there is one particular country that is notorious for its environmental issues, and this is none other than China. So China has experienced outstanding economic growth in recent decades, but that is accompanied by mounting environmental problems as well. And given that the country is expected to continue its growth in the next few decades, this will put further pressure on the environmental issues it is currently facing. But as usual, every problem comes with an opportunity. So in this panel discussion, our speakers, Hui Shi and Chloe, they will be sharing more on two key sectors that investors like yourselves can pay attention to as the world embraces environmental sustainability. And the two sectors will be on China renewables as well as China electric vehicles industry. And with that, maybe Hui Shi, you can share more about the renewable industries with us?
Yes, thanks, Falin. So China's renewable energy is an important sector to look at when we talk about environmental sustainability. And with increasing environmental pressures, renewables, they are at the forefront of the transition to a less carbon-intensive and more sustainable energy. So the renewable energy sector involves many different activities, and such activities, they can be separated into three different phases: manufacturing, development and operation, as well as consumption. And the two crucial phases that I'm highlighting here are manufacturing as well as development and operation. So for instance, before assembling a solar panel, their components must first be manufactured. And such components will include polysilicon, wafers, and cells. And there are also equipment suppliers who will provide manufacturers with the equipment required to manufacture those products. And after the components are assembled to form a solar panel, they are then sold to developers who plan and construct solar farms. At the farms, solar panels, they are linked with electrical components to form a full-fledged system which is connected to the power grid and then consumed by the end users. Supportive government policy is a significant growth driver of the renewable energy sector, and China's pledge to reach carbon emissions peak by 2030 and carbon neutrality by 2060 has driven renewable energy into the spotlight. And without a doubt, in order to achieve such goals, China will need to reduce the reliance on fossil fuels and ramp up the production of renewables. The government's 14th five-year plan indicates that renewables have become increasingly indispensable. So for instance, the share of non-fossil fuels in primary energy consumption will increase to 20% by 2025, which is up from the 16% in 2020. And that also means that renewables will account for around 2/3 of the increase in energy consumption from now until 2025. And to keep up with the demand, renewables will also account for at least 50% of China's total installed power capacity within the same period, which is up from 42% in 2020. Renewable energy, it comes from various sources, including hydropower, nuclear, solar, biomass, as well as hydropower. And while China has promoted the use of renewable energy, certain sources of renewable energy will be more important than others. And taking the center stage of China's clean energy strategy, they are solar and wind. So the Chinese government expects solar and wind to generate about 16.5% of the society's electricity use by 2025, which is up from the 9.7% in 2020. And we believe that this suggests that solar and wind will account for an estimated 7% of primary energy consumption within the same period, which is a material share of the 20% target for non-fossil fuels. And moreover, China has asked developers to accelerate the construction of solar and wind projects, as well as local governments and grid companies to guarantee the grid connection of solar and wind power. And as China has led the way in endorsing solar and wind power globally, it has also started building a 400 gigawatt mega project in the desert. And half of this installed capacity is expected to be constructed by 2025. And what's interesting about this is that it is more than the entire installed capacity of solar and wind in India. And India is already considered as one of the largest clean energy markets in Asia. So solar and wind, they are more scalable as compared to other sources of renewables. In the massive production of solar and wind components, they generate economies of scale, keeping the cost of projects low. And this has also contributed to the rapid growth in installed capacity of solar and wind over the last decade, which is catching up with that of hydropower. And in fact, in the longer term, solar and wind, they are anticipated to overtake hydropower to become the largest sources of renewable energy in China. And meanwhile, hydropower is likely to face a slowdown in growth. So hydropower has been experiencing increasing costs of installation, along with indirect social costs from biodiversity destruction. Additionally, severe droughts have slashed hydropower generation in the past. And we believe that this shows that China cannot be overly reliant on hydropower and should also diversify into other sources of renewable energy. And moving forward, the installed capacity of solar and wind will experience the strongest growth out of the different sources of renewable energy. They are estimated to grow at a compound annual growth rate of around 19% and 16% respectively from 2020 to 2025. And we believe that companies which are involved in the solar and wind supply chain, such as the raw material suppliers to the manufacturers and the developers, they are likely to experience a very strong demand as a result. So the cost of renewable energy is also too attractive to ignore. But don't be too surprised, in China, most sources of renewable energy, they are cheaper than coal. To determine the cost of energy, we consider the levelized cost of energy, also known as the LCOE. So this LCOE is essentially a measure of the lifetime cost of generating energy and is often used to compare across different sources of energy generation. So as shown by the chart here, the LCOE of hydro, solar and onshore wind is below the LCOE of coal. The LCOE for hydropower, while it is the lowest, has remained relatively stable over the past decade, and this is because its development has matured. On the other hand, solar and wind, they are still in the growing stages of development. They have been experiencing declining LCOE thanks to industrial breakthroughs and lower cost of manufacturing and project development. In fact, China's solar and wind have already achieved the fundamental conditions of grid parity, according to the National Development and Reform Commission. So grid parity, it occurs when an alternative energy source can generate power at an LCOE that is less than or equal to that of conventional energy sources such as coal. So on the whole, the ability for solar and wind to stand on their own feet reaffirms their positions as the backbone of China's clean energy strategy. And this also provides greater ease in China's leap to become a carbon neutral nation. So overall, China's renewable energy sector is undergoing a rapid expansion as the country progresses towards the goal of peak carbon emissions by 2030, as well as carbon neutrality by 2060. And in particular, the cost-competitive solar and wind are to form the backbones of China's clean energy evolution. And this will be a boon for companies across the solar and wind supply chain. And as renewable energy becomes increasingly indispensable, we believe that investors should consider an allocation to this sector. And they can do so through the Global X China Clean Energy ETF, which is listed on the Hong Kong Exchange under the ticker 2809. So this ETF, the Global X China Clean Energy ETF, it provides access to Chinese companies with significant exposure to renewable energy and its related supply chain. And by applying a fair PE ratio of 30 times to the estimated 2023 earnings per share, our target price for this ETF is at 239 Hong Kong dollars. So the top 10 holdings comprise many of companies which are involved in the solar supply chain. To give some examples, there's Zhejiang Jinshe Mechanical and Electrical, which supplies equipment to the solar industry. Sungrow Power Supply manufactures power supply equipment for the solar and wind power projects. And Nora Technology Group supplies equipment to the solar cell manufacturers, as well as Tianjin Zhonghuan Semiconductor specializes in the manufacturing of solar wafers. So this ETF is something that investors can consider in order to gain exposure to China's renewable energy sector.
Okay, thank you, Hui Shi. That was very informative. Hopefully everyone now has a slightly better understanding of the China renewables industry. And clearly one crucial aspect of environmental sustainability is all about embracing clean tech. But do you also know that transportation sector is also one of the major culprits contributing to climate change today? So most cars on the road today, they are either petrol or diesel powered vehicles, and it should be unsurprising that the carbon dioxide produced by these cars is causing serious harm to both public health and our climate. And given that transportation is an integral part of our lives, it is therefore imperative for us to seek more sustainable transportation solutions going forward. So Chloe, in light of this situation, perhaps you can share more about the Chinese electric vehicle industry with us?
Sure, we'll be happy to do so. So before going into detail into China's electric vehicle or EV sector, there's actually a need to give some context and reiterate why they are set to play a growing role moving forward. To start off, China is responsible for 27% of the world's greenhouse gas emissions, and this is more than the US and EU combined. But the country has greater plans for the future. The government has actually set a lofty goal of aiming for peak CO2 emissions before 2030 and achieving carbon neutrality before 2060. Becoming carbon neutral means that China will have to reduce its carbon emissions by as much as 90% and offset the rest through natural systems or technologies that absorb more carbon from the atmosphere than they emit. And given that electric vehicles or EVs produce significantly fewer emissions compared to conventional vehicles, they are actually expected to play a growing role in meeting this climate change goal. As such, the Chinese government views the EV sector as one that is strategically important to the country's long-term development. It has identified the sector as one to develop and grow under the Made in China 2025 industrial plan. And to fast-track the sector's growth, the government has invested at least 60 billion to support the EV industry. Of this 60 billion used to jumpstart the EV industry, almost about 37 billion or 62% has actually gone into consumer subsidies. And this is necessary as China wants 20% of all new cars hitting the streets to be EVs by 2025. And this would translate to more than 4 million of such cars on the road. Moreover, by 2035, all new car sales in China must be either full EVs or hybrid. With this in mind, it's no surprise that the EV sales in China is actually set to grow rapidly, driven by the strong domestic demand. So in China, domestic EV sales continue to skyrocket as the demand for emission-friendly automobiles grows. China passenger EV sales rose 160% year-on-year in the first half of 2021 to hit 1.1 million units. So the China Passenger Car Association went on to further estimate that wholesale sales of new EVs in China could reach 2.4 million units this year. And this would actually be an 85% increase from 2020, during which 1.3 million EV units were sold. Moreover, going forward, there's ample room for China's EV market to grow due to the current low penetration rates. So EVs accounted for only 5.7% of the total sales in the Chinese vehicle market in 2020. So this makes their long-term growth potential substantial. It is expected that China's EV sales would grow by more than 40% each year within the next 5 years. Also, when we look at the EV sector, it becomes clear that China is fast winning this EV race. And we say this because the country has achieved immense success in every step of the EV supply chain, such as from the upstream mining of raw materials such as lithium, to battery manufacturing and vehicle production by original equipment manufacturers, also known as OEMs. For instance, China's dominance in the upstream lithium mining segment is evident. So it's one of the top 5 countries in the world in terms of lithium reserves. And lithium is a key raw material component of today's EV rechargeable batteries. Over the recent years, Chinese companies such as Jiangxin Gafil Lithium, encouraged by China's attempts to dominate the lithium market and electrify the country, have actually grown to become a significant player in the lithium mining segment. Today, the company is the 3rd largest lithium compound producer in the world and the leading producer in China. And when we look at battery manufacturing, China is also the world's largest battery manufacturer. It contributed to 64% of the global lithium battery production capacity in 2020. So if current trends continue, most of the world would likely use Chinese batteries. And a clear beneficiary is no other than that of Chinese EV battery giant Contemporary Aperex technology. Contemporary Aperex is the world's #1 battery producer with a 27.3% market share of the global EV battery market, while competitors such as LG Energy Solution as well as Panasonic have a market share of 26.6% and 14.5% respectively. So lastly, when we look at downstream OEMs, which are essentially electric car makers, they have benefited from this highly developed domestic EV value chain arising from China's strength in critical components such as raw materials as well as battery production. So in fact, they're actually rapidly expanding their annual production of electric cars and are on pace to make more than 8 million vehicles by 2028. So now we'll be actually introducing our recommended ETF for exposure to China's EV sector. And this ETF is called the Global X China EV and Battery ETF. The ETF tracks the performance of the Solar Active Chinese Electric Vehicle and Battery Index, and they provide investors with access to companies critical to the development of EVs and batteries in China. It comes with an expense ratio of 0.68%. So we foresee strong earnings growth ahead for China's EV sector due to the underlying structural trend of electrification to meet its environmental goals. And additionally, government support has actually helped to fast-track the sector's growth. Our 2023 target price for this ETF is 268 Hong Kong dollars, and this is based on a fair PE multiple of 45 times. So last but not least, here are the top 10 holdings of the ETF with recognizable names, some of which I have already mentioned briefly just now, such as Contemporary Aperex, BYD, as well as Jiangxin Gafil Lithium. So to sum up, we are actually upbeat on China's EV sector due to its dominance across the supply chain and its alignment with the government's long-term strategic priorities. Not to mention, the sector is also fertile ground for growth, as EVs will likely take up a majority share of Chinese vehicle market over time.
Okay, thank you so much, Chloe. But before we wrap up this segment, perhaps our analyst day, you guys can address just two important questions that I believe most investors will have. So first, we know that both China renewables and EV industries are fast-growing areas to look at, but all investments come with risks, right? So what are some of the risks that you believe investors should take note of when investing in China renewables and China EV sector? Perhaps, Krish, you can go first.
Yeah, so for renewables, at the current stage, some sources like wind and solar, they produce energy at irregular levels. And so the rapid growth of such renewable energy sources could lead to curtailment risk, which occurs when there's an oversupply. So a high curtailment rate is considered as unhealthy, and that could cause the Chinese government to halt the development of some renewable energy projects. Regardless, I think it's worth highlighting that China's curtailment rate for solar and wind has declined significantly over the years to a healthy 3% in 2020, and that is considered as normal. And besides this, another risk to take note of in the near term will be a slower than expected transition towards solar energy, because the price of polysilicon, which is a raw material used in the production of solar panels, has surged in the recent year due to a supply shortage. And if the supply shortage extends beyond expectations, then the development of solar projects could slow down due to rising costs, and this will also delay China's transition towards renewable energy. So these are some of the risks that investors have to take note of for renewables.
Okay, got it. What about the EV sector, Chloe?
So there are two key investment risks to actually take note when it comes to the EV sector. So first and foremost, EV adoption may actually be slower than expected. So while the demand for EVs in China has grown immensely in the recent years, there's actually no guarantee of this continuing demand. And the government's projections are also not guaranteed to happen, as the switch to EVs will not always be so straightforward, with obstacles such as cost considerations as well as the lack of EV charging infrastructure within the countries that could impede its growth. Another key investment risk to actually take note of is that of regulatory policies in China. So China in general is considered to be one of the most regulatory-driven market. And currently, the government is actually now putting a focus on consolidating its 300 EV makers. And they're aiming to actually encourage merger and restructuring efforts to increase market concentration as well as real-in overcapacity. And while this policy could actually benefit China's top EV car makers such as NIO, XPeng, Li Auto, and BYD, as it helps to eliminate smaller competitors, there's always a risk that future policies may not always be so favorable.
Okay, thank you. So another important question I think a lot of investors have is that why were the respective ETFs that you guys introduced, why were they chosen for the exposure to the renewables and EV sector? Or better yet, are there any interesting companies within in this ETF that you guys think is worth highlighting?
Yeah, so for renewables, the Global X China Clean Energy ETF is currently the only ETF that provides a pure play exposure to the sector. But that being said, we believe this ETF, it still provides a good exposure to companies which are important to the renewable energy sector. And besides those companies that I mentioned earlier, an interesting company to highlight from this ETF will be LONGi Green Energy, which is listed on the Shanghai Stock Exchange under the ticker 601012. So LONGi, it is among the top 10 holdings of this ETF with a weightage of about 7%. And LONGi, it is the world's largest manufacturer of solar wafers and modules. And hence the company is a prime beneficiary of the long-term growth of the global solar photovoltaic market.
Okay, Chloe?
So currently, the Global X China EV and Battery ETF is actually the only ETF listed on the market that provides exposure to China's EV sector. So essentially, this ETF provides investors with access to companies that are critical to the development of EVs and batteries in China, and it's actually listed on the Hong Kong Exchange. For instance, when we look at the top holdings of the ETF, in particular companies such as Contemporary Apurex, Jiangxin Graphic Lithium, as well as Eve Energy, they are either only available to institutional professional investors or are traded via the Shanghai or Shenzhen Exchange, and thus they may not be so easily accessible to retail investors. Hence, this ETF actually makes it easy for investors to invest in China's EV space, and is one way to actually get exposure to this fast-growing sector. However, we also know that there's a new ETF. This is called the Nikon AM, Straits Trading MSCI China EVFM ETF, that will only be listed on 20th Jan this year on SGX. So this ETF also provides similar exposure, and also it comes in a SGD share class. So if you're interested to actually know more about this ETF, do keep a lookout, as we might be covering more about this ETF after its listing.
Thank you, Chloe. I'm sure everyone will be very looking forward to this write-up. And to conclude this panel discussion, it's clear that as the world population grows and strains the planet further, we must redefine our way of life and consumption by integrating more responsible and sustainable actions into our daily lives. So we hope that whatever we have shared earlier today would be helpful for investors who are looking for opportunities to ride on this sustainability trend. And that's all we have today. Thank you everyone for joining us.
Thank you, Falin, Hui-Shi, and Chloe. The rapid rise of ESG investing has led to a flurry of questions from investors and professionals alike. Chief amongst them being, does this affect the returns of my portfolio? In this session, we throw this difficult question, amongst others, to our fund house partners from Nikko AM, UOB AM, and East Spring Investments, as we try to clear the air, both figuratively and literally. Please help me welcome Chu Wing Kwong, Group Head of Portfolio Solutions, Senior Managing Director from Nikko Asset Management; Rong Ren Go, Portfolio Manager, Fixed Income from East Spring Investments; Victor Wong Ki Yeo, Senior Director, Head of UOB AM Sustainability Office. Moderating this segment will be Cheng Jing Yan, Analyst, Unit Trust Research from IFA Singapore.
Well, good afternoon to all of you, and thanks for taking the time to join us here today. So perhaps to begin, we could have all of you panelists start by giving a self-introduction to provide some context to what we'll be discussing today. Starting with you, Kyung.
Thank you very much for having me here. I'm Chu Wing Kwong. I'm the Head of Global Portfolio Solutions at Nikko Asset Management. I'm also the Portfolio Manager for the Nikko Impact Investing Multi-Asset Fund. This fund invests globally into the best opportunities in equities and bonds, and to generate sustainable and attractive long-term return while doing good to the environment and the communities we live in.
Hi everyone, my name is Rong Ren. I'm a fixed income portfolio manager at East Spring Investments. I'm also the lead portfolio manager of the Asia Sustainable Bond Fund. This is one of the first ESG-focused bond funds of its kind in Asia. And it also has had a credible as well as longest track record in the region. And what this fund attempts to do is to actually integrate ESG risk considerations into the investment process. And I think the performance of the fund over the past 2 years actually attests to how useful and important that is.
And my name is Victor. I'm the head of the Sustainability Office at UOB Asset Management. And this office was set up to support UOBM's strategic vision of driving sustainability and sustainable investment across our regional offices. And our team, besides implementing the ESG investment process, implementing initiatives in sustainable investing, we also manage a family of funds and mandates across the equity, fixed income, and ETF space.
Okay. So as we all know, 2021 has been an eventful year for ESG, right? With climate change and social issues caused by the pandemic really bringing it into the spotlight. So Wing Kyung, with the United States Climate Change Conference and concluding in November, do you think that the interest in the ESG space is still very firmly on the environmental concerns?
Yes, very much so. Environment will continue to be at the center stage as we accelerate towards sustainability living. But we are also seeing the broadening out of environmental issues that we are concerned with to include biodiversity, oceans, and forests. But at the same time, social, the S in ESG, is getting a lot of prominence in fair treatment of labor, in human empowerment, in universal access to healthcare. Notably, these are all brought about by the global pandemic, where a lot of issues, a lot of awareness were raised on these social challenges.
Okay, so Rongren, maybe this question might be suitable for you because of your focus on the fixed income space. So what are the latest developments? How was 2021 for the ESG fixed income space?
Yeah, so just stepping it back a little bit, back in 2020, post-COVID, a lot of focus on social factors. So led by the supranationals, there were a lot of social labeled bonds that were issued by the supranationals. But in 2021, I think the environmental part of ESG is actually very much in focus. So we saw explosion of bond issuances. I think this is the year, 2021 was the year where national level commitments started cascading down into corporate issuer type of initiatives. So we saw a lot of issuances broadening out from the typical renewable names into the typical sectors that investors will be more familiar with. So in a way, you can say that investors actually have a lot more choices in what they want to invest in, the type of bonds they want to invest in, both IG, sub-IG, as well as across broad, diverse sectors in this region.
And I suppose more choices will always be good for investors, right? So ESG in fixed income has often been seen as a sort of little brother or less important compared to the equity space. So do you think these developments in 2021 has helped to close the gap?
Yeah, so I think over the last couple of years, there was this myth, I would say, that ESG investing for fixed income is probably not as relevant, not as applicable as equities, simply because fixed income investors do not have voting rights. I think this myth has already been debunked quite convincingly, in the sense that both bonds as well, both debt as well as equity, are important parts of the capital structure. Companies actually need both parts of this investor base, and we have clearly demonstrated that how we invest, whether to invest or not to invest, actually can play an important role in actually shaping and influencing the behavior of a firm, which is ultimately what's important, when it comes to environmental aspects of risk assessments.
That's very true. And Victor, as head of sustainability, have you noticed any other important or big changes in 2021 that you think investors would like to know?
I think one very important development that took place last year, I think, was the top-down push. You have heard us talk about the issuance of bonds, for example, but you need to take a step back and ask yourself, what was a big contributing factor to all this? And the fact that governments, policymakers are rolling out rules, regulations, policies, frameworks is very supportive of this, because when, say for example, a country issues a national target to reduce emissions, the policies will fall through to the companies in that country, across all the various sectors. And this provides an investment opportunity for investment managers, because there will be capex, there will be changes in business models, and if investment managers are fast enough to spot the companies that will transition and benefit in the future from these changes, then it makes a good investment opportunity. I think the second thing that has happened is the evolution of sustainable investing. We've started many years ago with ethical exclusion, for example, then we started moving to ESG integration. But I think the point now is that investors are beginning to discern, okay, it's good to be sustainable investing, but I want to go a little bit deeper. I want to look at, for example, thematic, and I want to look at impact investing. I want to know whether my strategies are delivering the purpose, the profit, the returns, and also what exactly is the good I'm doing. I think that's very important. So having put all that, I think the three takeaways that I have in this space is that, first of all, I think identify the theme or the strategy that you want to do this. Look at whether these themes and strategies are in line with your own personal values. And lastly, I think very importantly, once you've selected your strategy, look out for the results, the measurement of the impact your strategy has achieved. I think that's really come into the forefront last year, and I think this will continue going into this year as well. Okay,
I think you mentioned something about returns, and as investors, I think the most important thing for all investors is their returns, right? So the big question, does ESG investing affect returns?
Yep, so just a shameless plug here. I think the performance of the Asia Sustainable Bond Strategy from East Spring is proof of concept that the performance over the past 2 years, right, is reflection that our investment process, which incorporates, ESG risk considerations, in terms of the ESG risk exposure of an entity and whether the issuer actually is well prepared to deal with these risk exposures, right, has served us very well, right, in avoiding some of the pitfalls, right, that have been apparent over the last 1 year or so. And, fixed income investments is really about, focusing on downside risk and getting your capital back at maturity. And evaluating ESG risk factors, right, is actually part of this toolkit that we employ to ensure that we avoid all those downside risks that I mentioned to you about. And this has actually helped us significantly. So I would argue that by incorporating all these ESG risk considerations, it actually helps to enhance the performance of your fixed income investments.
I see. And since you mentioned that it helps protect against downside risk, I assume that the fund has gone up, right? So if it keeps going up, then there are some people that will always say like, we are in a bubble, right? The ESG assets have done very well over the past 2 years. So Victor, do you think we are in a bubble?
I think that's a naughty question you're asking, right? Okay, but I'm going to take this question on. I think I totally agree, right? The returns have been enhanced. So from our personal experience, we run an equity fund. So we were total agreement, fixed income and equity, you do see our performance. So what we have seen is at the initial stages, when funds were allocated to more sustainable investing, they were chasing the same few names. All right? This created, I think, some overvaluation in some names. But what we are beginning to see is that once you start to expand your investable universe to less well-researched mid-cap companies, for example, and this is where in Asia, I think it's very exciting because if you were to compare Asian ESG coverage, whether it's from your data providers, you compare it to what's happening in Europe, you're going to see it's a little bit imbalanced. I think it's a lot more developed in Europe. We're starting out in Asia, catching up, but still starting out. So once you move beyond the big cap names, you're going to find that, the mid caps, not even talking about the smaller caps, there's no coverage, or the methodologies of the ESG data providers are different, and therefore, where do you start, right? How do you do an ESG assessment? So it is a challenge, but I think once you can overcome this, and what we are doing at UOB Asset Management is that we work through our regional offices. So we go down, talk to the companies. Sometimes it can be something as simple as a language issue, or even a cultural issue, right? They hear ESG, they get frightened. Sometimes some of these companies are new to it. Once you talk to them, and they realize, actually, it's quite similar to fundamental investing, right? The investor now knows me a bit better. I'm happy to share you my policies on sustainable investing. And there, you start to unveil an opportunity, right? So the Sustainable Asia Top 50 Fund that I run, it's the same thing. That's what we've been doing. We work with our colleagues in Malaysia, Thailand. We identify companies that we think are good, that have a good ESG potential. And it's actually some years before a major ESG data provider actually comes out to do coverage. And by which time, I think hopefully we have really recognized the performance. And that's why I think it's something that it could be a challenge, but if you apply the right process and strategy, you could actually turn it into an opportunity.
I see. Funny that you should mention that you see the same few names, right? Because as an analyst, I look at funds a lot, and I found that a lot of sustainable funds tend to hold the same big names and a lot of them are the same big tech names like your Amazon, your Google, your Facebook. But just because they have a low carbon footprint by the basis of being tech firms. But then they don't acknowledge the fact that these companies have a lot of questions regarding social fairness and also their workplace conditions. So maybe you could help me with this. Tell me, why are these companies in these funds maybe?
I actually would not consider these technology funds you're referring to as ESG funds. And in fact, it might even be a big red flag. And regulators are taking notice and of such mislabeling of ESG funds. It comes down to how deliberate these tech companies are in conducting their businesses, addressing ESG matters, and what impact they have on this world through their operations, through the products and services they sell, and how they sell it. Right? So, if one were to apply ESG rigorously, I suspect some of these big tech companies might fall short of the social and governance issues you have rightly pointed out.
And is this possibly because of maybe a lack of equal standards across the board. That's why we are seeing people rating these companies differently in terms of the ESG scale.
Yeah, I think that's a good point, right? Because we mentioned red flags, and I think we're going to come to greenwashing, right? And also different methodologies. So I'll take up that point on greenwashing, right? I think we currently do not have a universally accepted definition of sustainable investing. It means different things to different people. I think generally we accept it, it's accepted to be different forms of strategies. But I think what's really important for the investment community is how the governments, the regulators are coming up with this. So we are seeing actually in Asia the rollout of a lot more labeling, certification guidelines. I think this will help to remove some of the uncertainty over funds. Earlier, I also talked about, from an investor's point of view, look at how the investment solution is delivering the purpose. I think that's very important, right? If something can be measured, something is being delivered as per what the investment manager had promised, then at least you have some comfort that, look, the regulator has labeled this fund under certain rules, the fund manager is performing and delivering what has been promised. I think that would be important. And I also take comfort from the fact that late last year, as part of the COP26, we had a lot of developments. There was an announcement of the setup of the International Sustainability Standards Board. And I think that's also another thing, right? Because companies say that, what am I supposed to disclose? It is different rules, different providers ask me for different things. So if I have a common framework and I know what I'm supposed to disclose, then I think from a company's point of view, it gets easier. From the investment manager's point of view, it's also very useful, right? Because now we can start to address the differences in methodologies. So I think standards are going to evolve, and I believe this year we're going to see a greater pace in the way standards evolve.
So you believe that Asia will start to emulate Europe when it comes to this?
Asia is going to be catching up very quickly.
Okay, excellent. So unfortunately, all good things must come to an end, and we seem to be running a little short on time moving forward. So let me just pick your guys' mind for a bit. So maybe going from Wing Kyong to Victor, maybe you could share with us in 1 or 2 sentences, why is ESG investing important?
ESG investing is about investing into sustainability and being good stewards of the environment and the community we live in without sacrificing long-term return. And the Nikko Impact Investing Multi-Asset Fund can help you to do that.
Yep, so I'll try to keep it very short. What we consider to be niche ESG investing right now, I think it's likely going to be mainstream very, very soon as a few years' time. So it's best that as investors, we create this awareness and catch up on all this knowledge so that we prepare ourselves for the future.
I think for me, I'll just lead on from what he has said. I think the mainstream, that's very, very important, because right now, I know the theme of this whole webinar is the show must go on, right? The movie theme. So I would, one of the George Clooney movies I like, The Perfect Storm. And I mean it in a very positive manner, because right now you have growing investor awareness, you have regulatory top-down push, you have an increase in suitable solutions. I think this is a perfect combination that will help to drive sustainable investing forward. So at this point in time, I really want to urge all of us to go onto this sustainable journey together. And again, one last link to the movie theme is that, as investment managers, we will make you an offer you can't refuse.
Wow. Okay. Well, that brings us to a big ending, I would say, a very impactful ending. So with this brings us to the end of the segment. So once again, thanks to Victor, Wing Kyong, and Rongren for joining me here today. And we hope that this session has been useful in answering some of these difficult questions for investors. So I'll now pass the time back to our MC, Gladys.
Thank you, panelists. Asia Pacific continues to lead the world in economic growth, with real estate as a key sector. With the increasing demand for sustainable buildings and practices, there is an expected increase in rents and capital gains for green buildings, giving rise to a unique investment opportunity. Up next, we present this unique investment opportunity. We have with us Edward Pai, Intermediary Sales from UOB Asset Management. Let's hear what they have to offer.
Good afternoon, everyone. I am Edward from UOB Asset Management. Before I go into the presentation, I just want to introduce who UOB Asset Management is. So UOB Asset Management is a leading Asia-based asset manager with its headquarters in Singapore and present in 9 markets across Asia. We have over 30 years of investment experience and have over 37 billion Sing dollars of asset under management. We also have strategic alliance with best-in-class external asset managers with the likes of Wellington Management, Ping An, T. Rowe Price, and many more to offer comprehensive suites of products ranging from retail unit trusts and ETFs. We are very active on the unit trust space where we have focus funds like United SGD Fund, a quasi-parking vehicle, United Global Quality Growth, global equity funds, and currently we are also expanding our ETF offerings given the opportunity presented for ETF in the Asian market. We are also highly focused on driving sustainability by putting environmental, social, and governance impact at the heart of our business. I'm also very proud to say that we are one of the signatories of a UN PRI as well. So that's why today I'll be talking about our UOB APAC Green REIT ETF. So over the next 15 minutes, I will be articulating the case of why APAC REITs, why the need for APAC REITs to be green, and how is this the investment opportunity for all of us for a sustainable future. So these are some of the key features of this ETF itself. This is the world's first APAC Green Real Estate Investment Trust REITs ETF developed by SGX, part of the SGX IH product suite in collaboration with UOB AM. And we aim to contribute greening of the real estate sector with a focus on Asia Pacific. And we do also have initial seeding from our parent company, UOB Group. And of course, we aim for a quarterly distribution of up to 4% per annum. And of course, at the same time, creating the positive green impact. Why? Why is it the case for REITs and sustainable REITs? Now, before I actually get in a little refresher on what REITs is, so REITs is a collective investment vehicle where your money is put together with other investor money to invest in a portfolio of professionally managed real estate properties or assets. Now, the REITs can definitely prove a valuable addition to a traditional stock and bond portfolio in many ways, as REITs can earn both long-term returns via appreciation as well as regular income through dividends. The underlying assets provide steady rental stream which flows through to investor as regular income distributions. And the dividends are generally prompt and consistent. So our strategy's focus is mainly on Asia Pacific, and why Asia Pacific as an allocation is attractive and convincing. If you look in terms of demographic, Asia Pacific is home to 4.4 billion people, about 57% of the global population, and in the UN Department of Economic Social Affairs projected, by 2030, the urban population in Asia will be more than 2.5 billion. By 2050, it will be 3 billion compared to other regions. Now, Asia has the highest growth potential. Now, with this, what does that actually translate to? So when we talk about urban areas are generally associated with greater productivity due to agglomeration economies, more opportunities, including in employment, as well as higher quality of life. So with the rise in urban population, we are already seeing a trend of growth in working age adults across Asia Pacific. Cushman & Wakefield, a global commercial real estate service firm, is projecting that this growth in working age adult is translating to a demand for an additional 1.35 billion square feet of office across Asia Pacific region between 2020 to 2030. Needless to say, Asia Pacific real estate is definitely set to grow rapidly. Now, if we couple the demographic aspect and add in the lenses to the investment opportunity of why Asia Pacific REITs, it will present itself a much more appealing case. Within equities, REITs are looked upon favorably as an asset class. It allows one to diversify beyond the standard sector allocation. Its REITs profile differs greatly, given that they are an equity with bond-like features. And when we compare Asia-Pacific REITs with the broader Asia-Pacific equity market, it outperforms over the long term, delivering a better annualized return. And in terms of yields, Asia-Pacific REITs generate much better absolute yields compared to equities and government bonds. Now, REITs also have dividend regulation where, the The REITs are required by law to distribute at least 90% of the income earned from their real estate investments directly to the investors through dividend distribution. In general, these dividends from REITs are not subjected to taxes in Singapore, unlike rental incomes from physical properties. Now, we have friendly taxation rules, steady dividend income, long-term capital appreciation has allowed REITs to deliver that competitive total return historically, as shown in the previous slide. Now, the comparatively low correlation with major asset class, especially the broader equity market, is also another compelling reason for investors to give key consideration when constructing one's portfolio. Now, usually, investors at the location of different asset classes and geographical region in their portfolio, maybe like Asia bonds and Asia equity, and by adding Asia Pacific REITs into the mix, it will actually make it a good investment to mitigate the portfolio risk. Now, one of the biggest concerns in 2020 will be that, on everyone's mind is that the rise in the interest rate. Will it affect the REITs market? Now, REITs is typically priced for its yields, and as a defensive asset class, it will potentially become less attractive when interest rate actually rises. However, this doesn't mean investors should avoid investing in REITs in the rising interest rate environment. In reality, rising interest rates are typically indicator of improving economy, which is generally favorable to overall real estate sector. It allows them to grow occupancy rate, build new properties, hike rents, and this actually helps to improve revenue and cash flows for REITs. The positive impact of strong economy outweighs the negative repercussion of higher interest rates in most cases. While we do expect interest rates to rise as global central banks start to taper, the good news is that we are potentially entering a sweet spot where we have small rises in interest rate, but not too much. And as long as interest rates move in a gradual manner, REITs are poised to enjoy optimal benefits of an inflationary environment through rental growth and capital appreciation. Now, from an investment standpoint, opportunities definitely do exist to leverage on rising interest rate. Overall, the current macro environment remains conducive for REITs. On a valuation standpoint, Asia Pacific REITs is still decent, and the valuation on a yield spread basis is not at an overstretched level. The yield spread over the 10 years government bond yield as of December 2021 is at 2.3%, and this is slightly below the mean. The current trend that we are seeing is similar to the ones that we have seen in the past cycle. We expect the yield spreads trend to narrow further with room for potential capital appreciation. The hunt for yields will continue as we are still in a low interest rate environment. Now, currently, APAC REITs is generating about 4 to 5% yields on average, and the dividends are expected to continue to grow at a robust pace of 5.8% per annum. Now, the fallout of COVID-19 crisis in 2020s, REITs were definitely hit. Tenants were hit badly by the restrictions and other preventive measures to combat the health crisis, and the acquisition appetite at the time waned as REIT operators seek to conserve cash. Now, if we look at it today, right now, it's a different story because the effective rollout of vaccination programs around the globe removed restrictions. We are seeing a growing business confidence, and as the post-COVID situation progressively recovered to some level of normality, we've seen an uptick in M&A activities in major Asia-Pacific REIT market, and this trend is likely to grow. Now, as countries start reopening the borders and emerge from the pandemic, we will gradually see a recovery in trade, travel, tourism, which in return result in strong growth prospect for Asia-Pacific REITs. The pandemic, though devastating, may well have proved timely as a wake-up call for all of us for environmental and social responsibility. As mentioned earlier, sustainability is currently the mainstream now, and governments are catalyzing the adoption of sustainability practices, and major corporates throughout the world are reassessing the business strategies to meet their sustainability targets and goals. And the world is waking up to the investment opportunity that this brings. And a recent survey on the sustainable real estate done by another global commercial real estate company, JLL, they found that, number one, sustainability is a third consideration for occupiers, and 7 out of 10 are now willing to pay rental premium to lease green buildings in the future. And second, the adoption of net zero carbon is also set to double in APAC by 2025. And lastly, 72% of the investors believe that the green certification of buildings drive higher occupancy, higher rents, higher tenant retention, and overall higher value to the assets. in many ways, ESG is not a new concept for REITs, but has become increasingly important in recent years. What we observe is that REITs nowadays have doubled their focus on ESG issues such as improving energy and water efficiency for their building operations, reducing their operational carbon footprints, obtaining green certification, improving tenant satisfaction scores, employee turnover, and the list go on. As you've come to realize, sustainable or green REITs are made out of more than just green building itself. But there's no doubt that buildings are still the centerpiece of what makes REITs. So what are green buildings? Green buildings reduce or eliminate negative impacts on the environment and climate. Now, definitions of green buildings may vary, but they can be tied to carbon and energy objectives such as net zero emission, consideration for their occupants' health and well-being. And if you can see, from here, based on the IFC report, green buildings are not just low-risk assets, but are able to provide higher value too. Green buildings definitely offer a number of economic or financial benefits, ranging from savings of additional costs, reduction in operational costs, higher rental income, and many more. Now, buildings and construction account for 39% of global CO2 emission, if you all don't know. And to make things worse, global building stock is also expected to double in area by 2016, causing an increase in carbon emission occurring right now. Now, that increase is creating an increase in pressure for real estate to be green, and that is creating actually a USD 17.8 trillion investment opportunity in green buildings by 2030 in the Asia-Pacific region. Now, that is the highest among the rest of the geographical area. As such, Asia-Pacific green REITs looks really attractive in terms of both investment and sustainability viewpoints. So I'll just go a little bit deeper into the REITs ETF. Now, this ETF tracks the IH UOB APAC Yield Focused Green REIT Index. Now, the index is actually comprised of a basket of 50 REITs which deliver high dividend yield to investors by investing in Asia Pacific, including Japan, and focus on green REITs, which I identified via high ESG quality. Now, the ESG quality is based on GRESB's real estate assessment. Now, what is GRESB? Now, GRESB is the Global Real Estate Sustainability Benchmark. Now, they are a mission-driven and investor-led organization providing standardized and validated environmental, social, and governance data or ESG data to the capital markets. They are established in 2009, and GRESB has become the leading ESG benchmark for real estate and infrastructure investment across the world. Now, when we talk about investing, a profit is always, what most in investing. And this ETF, of course, as mentioned earlier, aim for a regular dividend of 4% per annum based on the superior earnings of the potential of the green-focused real estate companies. And looking at the performance, the index performance has beaten the market average and offer attractive annualized return. Now, this ETF is also optimized for improved risk-adjusted performance via tree filtration process, dividend yield trap. Only REITs that meet the liquidity requirements are passed through the filter. Now, this is to actually avoid investing in poor quality REITs. Thereafter, REITs are also further segregated and ranked based on market capitalization. And lastly, the most important of green tilting. We rewarding greener REITs with a higher weightage based on the environmental attributes. And if you are thinking, does it affect the performance to adopt ESG? The answer is, it doesn't really. The table here shows the comparison of Asia-Pacific Green Tilt REITs Index versus non-green REITs Index. And in fact, it is quite evident that adding in the green tilt does not necessarily affect performance. Based on the one-year return, the green REITs Index outperformed the rest, and for the 3 years return, it was rather on par. And this is actually the key characteristics of the ETF by REIT sector as well as the country allocation. You have Japan, Australia, Singapore, and Hong Kong. And then lastly, this is the top 10 constituent of the ETF. I'm just going to go through a couple of names over here. So in Australia, the first one, we have Century Group, a retail real estate AUM. They have value at Australian $50 billion and shopping center ownership interest value at about 34 billion Australian dollars. And in terms of green aspect, they are targeting net zero emission by 2030 and reducing their energy use by 10% year on year. They also utilize green energy where their 6 megawatts of solar continues to generate between 8,000 and 9,000 megawatt of electricity per annum. And on the second, you have Texas. They have an AUM of about 42.5 billion Australian dollars, and they are also the top 50 entity on ASX, which is the Australian Stock Exchange. On the sustainability aspect, they are committed to achieve net zero emission by 2022. And on the third, you have Link REITs. One of the Asia's largest REITs is expected to grow modestly in the coming year. The portfolio of Link REITs largely comprise of non-discretionary focused retail offering daily necessities and essential service to local, which is expected to show resilience and generate steady income for the shareholders in this economic recovery phase. And their net zero strategy is by 2035. And of course, one of the main common characteristics that we see in the top 10 constituents that they do have a very strong focus on sustainability report. They have a very clear goal on how they want to achieve their net zero strategy. And of course, the next thing is that some of the key details of the ETF itself. So, yeah. And lastly, I would just like to summarize on 3 simple points. This is the first APAC green REIT solution. Second, why? Because this sustainable and green REITs are a key emerging trend. This is going to be the future. And lastly, the objective. We want to create an opportunity for you for profit and purpose. Thank you so much. And I will actually hand over to the MC. Thank you.
Thank you, Edward. As we wrap up What and Where to Invest 2022, our panelists will discuss how we can implement the insights and tips into our portfolio for the year ahead and beyond. We will also share some strategies that will stand the test of time. Please welcome Koh Yang Zhi, Team Director of Investment Advisory from iFast Global Markets, Catherine Chua, Assistant Manager of Investment Advisory from FSM1 Singapore, and Jean-Paul Wong, General Manager at FSM1 Singapore.
Hi everyone, thanks for joining us for our panel discussion. The topic is eternal investment strategies that will work for investors and why cryptocurrencies ain't one of them. My name is JP and I have with me today Catherine from our investment advisory team at FSM1.com, as well as Yang Zhi from iFast Global Markets. He's a team director at IGM in short. And some of you who may have been watching iFast TV, which is a newly launched TV channel that we have released just last week. You may have seen him in a number of the programs that he's hosting. So iFast TV, just a quick shout out. It's a TV channel that is available on a mobile app as well as on website, which brings together the best investment ideas from analysts, fund managers, financial advisors, as well as influencers in the finance world. And we try to bring all these people talking about finance, investments, and share the best ideas with you. So as we wrap up What and Where to Invest 2022, let's discuss how we can implement insights and listen to the tips from my panelists on what we can do for our portfolio for this year. We'll also look at strategies that have stood the test of time, which we call eternal strategies that will work for investors no matter the market outlook. Before we proceed, I just wanted to talk about something that more investors are talking about, and that's cryptocurrencies, and why I think they are not an eternal investment option. This morning, we did a poll with our investors, and about 35% of you mentioned that they are open to cryptocurrency investing because they believe that's the future of investing, and I think some of them have already started investing in cryptocurrencies. 1 week ago, at our first session of What and Where to Invest 2022, 48% of our investors in the audience said that never ever have they invested in cryptocurrencies, which also suggests that quite a large amount of people have already started investing in cryptocurrencies. And I think even anecdotally, like among ourselves, if we go, to catch up with friends, I think some of them may have already been telling us that, oh, I've started my cryptocurrency journey. So I think quite clearly, more and more people have been dabbling in cryptos, or at least they've been reading up on cryptos. So let me explain a few points as to why we think crypto is not the way to go when it comes to investing as an option. So first, the absence of fundamentals and the lack of intrinsic value for cryptos. So the inability to generate any form of a cash flow or income is one of the biggest drawbacks or flaws for cryptos. So when I look at, let's say, stock, there's the ability to see what's the kind of cash flows that lie ahead for a company or a stock. We are also able to measure its earnings growth potential for the next 1 year or 2 years. And we therefore can also then see from a valuation perspective, is it expensive or cheap or trading at a fair value? When it comes to fixed income assets like a bond, very similarly, we can look at its coupon payments, its price, its yield to maturity, and so on, to conclude whether this bond is trading at a certain attractive value or not. But all these measures or intrinsic value values don't come up when we look at cryptocurrencies, and I think that's a very major flaw because we cannot then tell whether it's an asset class that's looking cheap or expensive, and there's total lack of fundamentals in terms of even looking at the second point here, which is what are the economic fundamentals that would drive this cryptocurrency going forward. And of course, so when it comes to cryptos, I think a lot of people are debating, whether there are sufficient regulatory checks or frameworks that will make this grow bigger and bigger in future. Our view is that I think when we look at some of the central banks or governments around the world, they have already been very clear to say that they are not going to allow cryptocurrency or crypto exchanges. China is one of them. But if we look beyond China, by no means are they the only place which has banned cryptos and crypto exchanges. When we look at some of the jurisdictions, some of the countries like Switzerland or France, in fact, they have already been making very concrete steps to progress or make improvements in the central bank digital currency space. And what that says is that digital currency is already making concrete progress. And I think that is one area where, with the support of the central banks around the world, and with the kind of regulatory frameworks they have built to ensure that there's a proper cross-border settlement of forex or other investment types, it also shows that governments and central banks are already actively looking into digital currencies. So in this case, central bank digital currencies. So we can expect that central bank digital currencies will continue to grow in importance going forward. And that is something that is seriously lacking for cryptos as opposed to central bank digital currencies. My other point here is that cryptos are highly momentum driven. So a reversal in the momentum would signal that there's just no lack of fundamentals to drive this asset class going forward. And fading momentum, in fact, will be one of the biggest headwinds for cryptos. And I think we've seen a bit of that in the last few weeks when for example, Bitcoin hit a high in November, but then quickly, corrected. Two other points here. So higher risk of leverage bets imploding and wilder swings in volatility. I think when we look at a lot of the crypto exchanges, they offer dramatic leverage. And that means that, when there is a drawback or a correction, it also means that it's going to be a lot more severe than a lot of investors can expect. Last point here, I think a lot of the easy monetary policy that we have seen from central banks, especially like in the US, well, that's going to come to an end because that has helped a lot of asset classes to scale up and to rise up. But we already know that with a lot of concerns on inflation and the possibility of interest rates rising even sooner rather than later this year, well, that kind of easy monetary stance from the US Fed, for example, is going to come to an end, and that's going to, of course, be a problem for very speculative asset classes like cryptos. So I've shared my part on why I think cryptos are not a good investment option for investors. I will now invite my guests, Yang Zhi and Kat, starting with Yang Zhi. What do you tell your clients when they tell you that they are interested in cryptocurrency?
Well, thanks, JP. I think what you have shared are very valid points. And you have correctly pointed out that over the past few years, there has been increasing interest in cryptocurrencies. I mean, if we look at cryptocurrencies from the technology point of view, the blockchain technology, I think it's something that is worth exploring, something that can really spur a lot of innovation in the technology space. But as an investment option, it is not a wise choice. So let me give you some examples. I think I will be reiterating some of the points that you have mentioned earlier. So, for example, today if I'm an investor and I want to buy a farm, the farm produces crops which can be sold for cash flow, right? And then if today I decide to buy a business, right? Business sells its products, its services to again produce cash flow. So in this case, as an investor, whenever I buy a farm or a business, I know what price it's a good price to buy a farm or the business because it produces something. So there's something for me to measure. But in the case of cryptocurrency, what I tell my clients is that it is a digital asset. So which means that it has no physical properties. You cannot lie on it, you cannot sleep in it, and things like that. And unlike a farm or business, it does not produce anything. So how is the value of cryptocurrency derived? It's based on how much the next buyer is willing to buy from you. So in this sense, you're kind of like playing musical chairs. So the thing is that when there's a buyer, prices will continue going up. But when the music stops, people are going to get hurt really badly. So for that matter, I think that I advise my clients that cryptocurrency, it's more of a speculation than an investment.
Yeah. I agree with you.
Yes.
Kat, how about you?
I fully agree with both of your points. It's very valid. And in fact, this is also what I do tell my clients, that crypto is very, very speculative. Like we look at pre-COVID time versus the price now, crypto prices has rise. I mean, especially the bigger coins, more than double its value. So a lot of people look at it as a get-rich-quick scheme. And I would think it's a very lottery type of investment. So like when you are buying lottery, you don't put 5-digit kind of betting into it. If not, you'll just end up like the protagonist in the Squid Game. Yeah, so I do think that investing in crypto, they should also know that it's a 24-hour market so that the markets don't sleep. I do have friends, of course, invested in this asset class, and generally, I mean, even though they do get very juicy returns from all their investment because they bought it like many, many years back. But one thing they do tell me, and everything in common, is that they cannot sleep well. So, I mean, to what extent do you want to actually invest in, and is it worth that kind of uncertainty? I think this is really one valid point to consider. And also, Warren Buffett do have a very, a quote that I would think is very applicable here is that he says that do not test the depth of the river with both your feet. So I do think that even if they really do want to invest in it, better do your own due diligence. Not all the coins are the same. And of course, the different firms that are offering these trading platforms, some might not be as legit as it seems. Yeah, so I would highly, highly discourage it.
Yes, I agree with you, Kat. I mean, really a word of caution, because I think it's getting so prominent. It's so easy to see somewhere out there that, you can get started.
Yes.
And I think it's always a red flag or a danger signal when a lot of our friends start to tell us that, hey, you know what, I've started in crypto and it's doing very well for me, and so on and so forth. I think it's only one part of the story. I think when that volatility hits cryptos, then I think that's when a lot of them will start to feel the pain and realize that it's purely speculative in so many ways. And I'm looking at the examples of Elon Musk talking about his merchandise. You can use Dogecoin, but I mean every time he says that, then Dogecoin shoots up. Just sounds extremely dodgy.
When a tweet move the markets, right?
Yeah. So I'll just move to, let's say, concrete steps that our investors can take when it comes to investing. So which brings me to the next point here. So what tips do you have for a client looking to build an investment portfolio, Yang Zhi?
Yeah, so I think when it comes to building a portfolio, there's a lot of literature on asset allocation. So what I'm going to share today is something different, but I think it's the key step to building a portfolio, which is to understand your personal financial goal and what the portfolio is supposed to do. Right? So what happens is that, whenever people invest, they always want the highest returns. But the highest returns may not always be needed. Because what's important is what's your goal. So a goal could be things like your retirement, funding a house, preparing for your children's education, or even some money for a 1-year sabbatical. Right, so once you have determined that goal and what the portfolio is supposed to do for you, you actually have a ballpark figure of how much you need to achieve. So you, at that point in time, you'll be able to visualize, where you are now and where you want to be. Right, so for example, if you want to aim for $500,000 in X number of years, so what you can do is, when building this portfolio, you reverse engineer to determine how much money you need to invest, and what is the target ROI, return on investment, that your portfolio needs to achieve so that you can hit your goal. So having that in mind, you'll be able to tweak your portfolio in the suitable amount of risk. So you see, for example, a lot of people will be excited to be investing in very hype names, even like the Teslas and all. So I hear a lot of this. Yeah. But sometimes, if you look at it from a goal perspective, if it only takes 3% for you to hit your goal, 3% per annum, technically you don't have to be taking such big risks in more volatile stocks. You could just buy a bond and you will still hit your goal.
Yes.
So I think the key thing to building a good portfolio would be understanding what your goal and what is the purpose of this portfolio in your financial plan.
Yes, I hear what you're saying, because I think a lot of people may know about the plan and maybe what they should be doing, but then they start to get affected when they hear, let's say, their friends getting crazy returns, let's say. And that's the fear of missing out, really, because they're like, 8% a year, I used to be happy with that, but now I'm hearing my friend making 8% in a day.
Yeah.
So they start to get affected, and then they start to forget about the plan.
Yes,
and that's a problem, because 8% a day up could also be down the next day. So I think then the plan goes awry totally, right?
Yeah, actually, if I may even add, I actually thought about this for a while, and I figured that, to become wealthy through investing, there are two paths that I know of. The first one is that you have to be very lucky. So not everybody that invests into this very high growth stuff make money. If you look around, there are some people that make money, but a bulk of them actually not making money, right? So the first one is that you can be very lucky. The second possibility, the second path that you can take is to be very disciplined. Right, so I think luck is something that we cannot choose, but discipline is a choice that every investor can decide to make.
Yes, that's right. Kat, well, your views?
Agree. Yes, I think luck is totally out of our control. So something that we can control, and what FSM1 always do advocate our clients, is that to have a portfolio, you must look at the supplementary, something that's more tactical, like all your very interesting bets that you want to place in, and of course something that's not taking too large a portfolio, maybe 5-10% of it, in a sense that should any of these investments within this tactical asset classes get decimated overnight, it does not set back the investment goals. And there's like the core portfolio, be it amongst like global equities, US, regional ones, or even like in a bulk of just put it into bonds. Yeah, it doesn't mean that you can have a whole portfolio of bonds and zero tactical. Yeah, so I think it's always about balances. Yeah, so I think it's important to set that kind of ratio inside the portfolio.
Yes. Very good insights from both of you. So I'll move on to this part, which is about what's your favorite eternal investment strategy, and why does this strategy work, irrespective of whether markets go up or down or sideways? Yeah. So Yang-Zhi?
Yeah, I think this is a very interesting question. So I spent a while thinking, so what is my favorite strategy, right? The key thing over here is eternal, right?
Yes.
So I think if you ask Warren Buffett, he would say, buy the S&P 500 index, right?
Yes.
So that's what he would say. But my favorite eternal investment strategy would be global diversification, right? So the reason is this. I think if we look back in history for the past 100 years, we started off with the UK being one of the most powerful nations in the world in the earlier days, right? That's why they were called Great Britain. Thereafter, after the World War II, I think US accelerated to become the #1 economy today. And they still are. But as we are speaking today, I think there are a lot of nations that are, catching up at a very fast pace. For example, China. So the thing is that if I were to build an eternal strategy, it's very difficult for me to know who is going to be the winner in the next 10 years, 20 years, right? So because of that, what I'm going to do is that basically build a portfolio of globally diversified funds. So I basically buy the US, I buy the China, I buy Europe, etc. So of course in that basket there'll be winners and losers, right? But as long as the global economy grows, I will be making money. So that will be my favorite eternal investment strategy.
Yes, and stay disciplined to it, right?
Yes, correct.
Yes. Kat,
Yeah,
how about
I
you?
definitely agree with that. For personally, in fact, what I do also recommend, and I'm doing it myself, is doing a dollar cost averaging strategy, because I think, at different points in time, we might have a certain outlook on a certain industry, but we never know if it's too expensive or has it reached the bottom yet. So rather than to second guess, like when would be the next bottom be and try to pick it up from there, I think dollar cost averaging would be something that will work eternally, because since the beginning of stock markets, markets never go up in a straight line. They are bound to have falls and bulls and bears. Yeah, and also I do think that another very important aspect that we should not miss out is that we should not pay attention too much to the headline, like, inflation, transitory, or like, interest rates and so on like that, because I do think that bad news always amplifies, and this is what all media outlets do, bad news sells. So if you investors are too focused on looking at day-to-day headlines and being caught in the fear, uncertainty and doubt, they will definitely be not confident of their investment choice in the long run, because they will be swayed by the next headline. Yeah, so I do think it's very important to weed out all these market noise and focus on really what matters. Like what Yang Zhi say, if your portfolio only need a 3% return, don't take so much gamble onto something that's giving 8% a day. Yeah, so I just think that they have to stay true to their own portfolio intention and dollar cost average.
Yes, talking of dollar cost averaging, this morning in one of the polls we did with the audience, over 50%, I think roughly about 52% of you said that they have a dollar cost averaging plan in place. So that's excellent, because when you have dollar cost averaging plan, a regular savings plan essentially, so no matter what you see in the markets, you are still invested, and hopefully that slowly inches up closer to your eventual goal. And I think that is something very disciplined. So a lot of the points that you're bringing up just remind me of also my investment plan for myself and my wife for retirement, and also for my children, which is, I have a core and supplementary portfolio for them. And I do a dollar cost average every month into the various products across the whole world. Also some tactical ideas. So you brought up all the things that I really like. Yeah, so I hope that for our investors who are listening, you'll be able to catch, the other programs as well that we have been, doing for What and Where, because we also talked about our favorite markets for this year, how we can also build a globally diversified portfolio for this year as well. And I really hope that, you'll find all these ideas from What and Where to Invest 2022 very useful for you. So happy investing, and thank you so much for staying with us. And thank you to Yang Zhi and Kat for joining me today. So take care, everyone. Bye-bye.
Thank you, panelists. We will now move on to the Q&A section, where we take your top questions for today. Please welcome Tan Dejun, Senior Equity Analyst of Portfolio Management and Equities at IFAS Singapore, Dexter Tan, Senior Fixed Income Analyst of Bond Supermart at IFAS Singapore, and Catherine Chua, Assistant Manager of Investment Advisory at FSM1 Singapore.
Thank you for joining us for our Q&A session, and we would like to thank you for all your questions. I do hope that during this session here, we will be able to address some of these questions. So to get the ball rolling, I would just start with the most voted question. They are asking about what is the recommended bond to invest in 2022. For this question, can I get Dexter to answer?
Yeah, thanks, Catherine. So I'm actually quite honored that it's actually the most voted question. So, look, I think this is a good question. I mean, I can give a very long answer to this question. So, in fact, we have actually launched our recommended bonds report. So, you may actually access this bonds on this report on the website. So, we highlighted 26 issuers, and there were about 31 bonds from them. So then again, recommended bonds, I think we mentioned some during the presentation earlier this whole day. One of them is Olam 5.375 perpetual. So this is a commodity issuer, and it's actually one of the biggest companies listed on the Singapore Stock Exchange. And I think we have a positive outlook for commodities in general, specifically agricultural commodities, and that's because of these weather patterns that we're seeing. For example, like in Malaysia, we have the floods, and that has affected the outlook it's actually positive for palm oil and positive for commodity issuers, companies like Olam. So, which is why we're recommending the Olam 5.375. And then we're also looking at other patterns, weather patterns that are also happening like in South America. So these are actually supportive of, I think, agricultural commodities. So I think earlier in the day, Teng Chong also highlighted some bonds. I think the AA REIT 5.375 also perpetual. I think it's a perpetual note, so it's callable I think in 2026. And then AA REIT, and I think he also highlighted the MLT, which is Mapletree Logistics Trust 3.65% perpetual note, which is callable in 2023. So I think these two issuers, they are industrial REITs, and I think we are looking at, I think what we are seeing recently is that industrial REITs are doing quite well. That's because of COVID, more people are actually buying stuff from online. So e-commerce is actually is booming, and then that has somewhat boosted the demand for logistics spaces, because when you buy things online, you have to keep it in a warehouse, and then that has somewhat created a demand for these warehouses, and these warehouse landlords, which are Mapletree Logistics Trust and AA REIT, they tend to have better cash flows, which is why we think that the bonds, the notes, the perpetual notes have attractive yields at the current valuations. Yeah, so I think in the recommended bonds report, we also highlighted some other names like banks. So banks is obvious because given that we're going to see higher interest rates, and I think Jamie Dimon said yesterday during the call, during the fourth quarter results, so they said, we're going to hike rates by 6 to he predicts that they're going to hike rates by 6 to 7 times. So that's quite a lot. So obviously, banks would, because they have net interest related incomes, they will do well, and this will boost the total incomes for banks. And then at the same time, banks, their asset quality is also improving because of underlying healthier economic conditions, and they are able to have lower loan loss provisions. So I think within the banks, we like some European banks, some of the AT1s, which is the perpetual notes from these banks. So maybe Credit Suisse 5.625%, which is has a yield of about 4+%. So that's one example. And then there's also SocGen, which is another French bank, which is, and you can also consider the 6.125% perpetual note. Yeah.
Thank you so much for all the information. So just to summarize, the few issuers that we have mentioned are like Olam, AA REIT, SocGen, Credit Suisse, as well as Mapletree Logistics Trust. Some of these bonds can also be found inside the recommended bonds booklet. So if you have not already seen it, do go visit our website. Under the bonds, recommended bonds, you will be able to find them. And also, if you are available on the 25th of January, next Tuesday, do tune in to one of our bond webinar at 7 p.m. where our regional analysts will actually discuss more about their top investment ideas, as well as how to keep up with the rising interest rates environment. So, moving on from the bonds question, we can go to the next one, which is also highly voted. That is the, hold on. Yes. Yes, on this, one of the tech and Asian funds seems to be uncertain over the year, and also they did ask about the advice, especially on the asset allocation wise. Is there any insights on this? And also how would it be impacted by the ongoing Omicron virus? Maybe any of you have any input on this?
Okay, perhaps I'll take the question first, and maybe Dexter can follow up. So I think with regards to the Omicron variant on tech stocks and Asian stocks, I think despite the human cost of Omicron, which is definitely unfortunate, I think what COVID-19 has done to the global economy is actually to it actually sent a wake-up call to many of these businesses, companies, and to tell them that actually technology, the adoption of technology, digitalization is extremely important. And because of that, we are seeing rising demand from corporates to incorporate new technologies within their operations, such as cloud computing, artificial intelligence, so on and so forth. So I think COVID-19 is actually, despite being a negative thing, you can see in a positive light and in a way that it is actually spurring digitalization in our economy, and therefore stocks that are exposed, tech stocks that are exposed to digitalization, like software companies, hardware companies, cloud service providers, they are all primed to do well.
Yeah, I think you asked about asset allocation, right? Yeah, so I think asset allocation, it's always good to diversify. I mean, have some allocation to different kinds of assets, fixed income, and then tech and technology funds, and maybe global funds. And so it's always good. I mean, diversification is actually a very powerful concept in finance because you can weather different conditions, different kind of market environments, and then maybe the approach to diversification maybe is to adopt maybe dollar cost averaging, like what I think our earlier panel has mentioned, dollar cost averaging into diversified portfolios is actually a very powerful way to grow your wealth. So it is like like irregardless of the market environment, you still be. I think your value of your assets will still grow over time.
Okay, definitely, that's insightful. Moving on to another questions. We also do get this question a lot from our investors, especially not only just today's Q&A. It's asking about our outlook for China tech and also Chinese equity. I mean, there's so many rounds of crackdowns that we have seen last year, and actually a lot of our investors are also very concerned about moving forward with their investments. And if it helps, perhaps Sturgeon, you can help us to summarize like day one and day two, all the things that we have talked about Chinese tech and equities.
Sure. So I think 2021 is probably the toughest year for Chinese tech stocks because of the regulatory crackdown. So this entire regulatory crackdown, I think it started in late 2020 with Ant Group's IPO that was being shelved by the Chinese government. And from then on, it just snowballed into many different issues. So across 2021, we have seen escalating tighter regulations, such as on Alibaba, for instance. They were investigated for their anti-monopoly practices, particularly their use of two choose one. In Chinese, it's called 二选一, which means that merchants are only allowed to be tied to one platform. So if you're with Alibaba, you cannot go with JD, for instance. And aside from that, we have also seen crackdowns on the online educational sector, which caused a huge drop in share prices in somewhere in the middle of the year. So all these things have definitely rattled investors and, of course, caused the share prices of Chinese tech companies to plummet across 2021. However, I would like to say that despite the negatives, I think the Chinese government has also stated multiple times before that their intention behind this crackdown it is not to stifle the growth of Chinese tech companies, but rather to safeguard consumers and ensure healthy as well as sustainable long-term growth for the sector. So one reason for this is because Chinese tech companies, when they started in the early 2000s, they were very small. By that time, US internet giants, they were already up and running, and they were already dominating most of the internet space. And because of that, China had actually had to protect its own companies by barring some of these US companies from operating within China. And because of that, Chinese tech companies have managed to grow unencumbered by regulation for almost 20 years. But throughout these 20 years, right, they have also grown to a point where they have so much power over consumers and small businesses that it is almost impossible for a Chinese citizen or a small Chinese business owner to navigate their daily life without interacting with any of these apps or products and services that are run by these big tech companies. And because of that immense power that Chinese tech companies wield over consumers and small businesses, it has come to a point where I think the government thinks it is getting a little unfair for Chinese consumers in terms of these 2 choose 1 and data protection, things like that, which is why they are clamping down on the Chinese tech sector. And another reason I think why investors shouldn't be too worried is because China has also, the Chinese government has recognized the value that these tech companies have, especially during the early days of the pandemic, where their products and services has actually allowed businesses to continue operating, such as cloud computing, online food delivery, things like that. So they recognize the value of these Chinese tech companies. And on top of that, China is actually not the only country that is trying to regulate its big tech companies. So if you recall, over the past 5 to 7 years or so, many policymakers in the US and in Europe are increasingly calling for greater regulation on tech giants. I think Facebook has been embroiled in many data security, user privacy issues over the years. And the only difference between China and the West is that China can implement all these regulations with a lot more haste compared to the US. So I think in the essence of it, a healthy dose of regulation every now and then for Chinese tech companies, it shouldn't be seen as a huge negative, but I think it is actually a necessity. And to conclude, I think in the long term, the outlook for Chinese tech companies, it still remains bright. I don't think that the Chinese government would want to kill off their own tech companies, seeing that China has made a point about building up its technological capabilities to compete with the US.
Thank you.
Yeah, I think you made a good point. Yeah, so maybe I think the outlook is positive. I mean, I'm not an expert in Chinese tech, but I think from a common sense point of view, I mean, like if you look at China, it's a very big country, so it's growing and it's emerging. So in future, it'll definitely play a prominent role. So yeah, so it's always good to have a long-term perspective when it comes to China.
Yes, definitely. So there's also another question one of our investor asked is about the Evergrande contagion and also with other property developers. How does it impact other Chinese equity markets, like perhaps even Chinese banks, or would there be like a systematic risk? Do you think you can share more with us around that aspect?
So I think for the Chinese banking sector, like my colleague Feline shared earlier, right now I think that the risk surrounding Chinese banks is rather low, mainly because the big 4 banks, for instance, their total exposure to Chinese developers in terms of loans, it is about 6% of their loan book. And from what we understand, most of these loans are also collateralized. And on top of that, I think that the Chinese government will proactively take steps to ring-fence this whole situation about Evergrande as well as the property developers to ensure that it doesn't spill over to the broader economy. So one reason for this is that in some of the recent policy meetings that the government has had, right, they have mentioned the word stability multiple times before. And stability is basically the key word for China's economy going into 2022. The government is hoping or wants to ensure that the economy is stable. So I think one reason for this is also because the Chinese government, they are going to have their 20th National Congress, which is something like their elections next year. And going into that, they would want to, as much as possible, stabilize the economy, make sure that everything is smooth and sweet and no surprises.
Yeah, I think maybe just to add on to his point. So maybe I think Tochi addressed the point on equity outlook. So I think Chinese banks, equities, I think Feline also highlighted is positive. But I think if we look at maybe the big 4 banks, some of them are actually bond issuers. So if we look at their bond yields, I think China Construction Bank has a Sing dollar bond. If you look at the bond yield, it's actually very low. So it actually indicates that the banks are still healthy. So yeah, I think, and then there's these policy moves that's actually helping to support these Chinese banks. Yeah.
So I hope we will be looking at a light at the end of the tunnel very soon, hopefully.
Yeah, hopefully. Yes.
Yes, so there's another question that asks about the relevant charges for our Bond Express platform transaction. So for those who don't know, Bond Express is actually a platform whereby you can invest in wholesale corporate bonds, but in a smaller fractional lots of $5,000. And this is only available for accredited investors. So you do have to make a declaration as an AI first before you can actually head into this investment. And our bond charges is actually 0.35, 35 basis points to buy or to sell. And on an ongoing basis, there's a 5 basis points platform fee that's implemented every quarter. Yeah. So moving on to the next question, I do see it's a very, very popular question lately because ESG is like the talk of the town. So like, Dexter, could you just share with us, like, is there some ESG bonds or some related theme that investor can consider if they wish to invest?
Yeah, ESG is very popular because I mean climate change, and recently there's this COP26, and earlier we had a panel on this, and seems to be picking up momentum. So ESG bonds, I think within Sing dollar space there is maybe the Ascenders REIT 3%, PERP, there is I think it's a green bond, and then there's the Fraser's 2028 3% bond also. So those are some of the ESG bonds that you can buy. I think they're yielding around 3% also around there. So and then recently, in the past couple of days at the start of the year, we have seen a lot of ESG issuances. Yeah, so I think there's this social bond that was issued by Shriram Transport Finance. So it's social, so it's actually doing a social good so the company actually provides financing to people who cannot afford vehicles in India. So there's a social bond. There's an example of social bond. And then we have this green bond by Guangzhou Development Holdings. So there's LGFV, which is one of the Chinese state-owned entities. And then I think CIMB also launched a US dollar bond at T plus 100, which is around, I think around 3+%. There's a US dollar bond. So it's issued under their SDG framework. So it's a sustainable development global bond, I think, yeah. Yeah, so those are some of the examples of ESG bonds that they can consider, yeah, which is available on our platform, yeah.
Thank you so much for your input. Due to the time constraint that we have, we will just take one last question. And because Sachin is an analyst on the semiconductor stocks, so perhaps I thought this question would be very relevant for him to answer. It's about how oversupply might actually cause a dip in the profits of these companies. So what do you have to give us about this?
Okay, so first of all, right, the Singapore semiconductor industry, it is not like the US, Taiwan, or South Korea. So Singapore is mainly focused on packaging testing, which is considered services to the main semiconductor industry segments of chip design as well as chip fabrication. But nonetheless, I think that being on the semiconductor supply chain, Singapore companies will still be affected given if an oversupply situation does materialize, which would affect, first of all, the chip manufacturers. So when clients start to cut orders, then chip manufacturers have to roll back on production. And worst comes to worst, they have to lower prices even, and that causes demand to fall. And when demand does fall and the industry goes into a down cycle, I think demand for services like packaging and testing will also come down. Yeah, but given that I think most of the Singapore semiconductor industry is rather small, yeah, I think at the end of the day, they will still probably be affected. But I think most of the impact will come from the biggest chip manufacturers.
Okay, thank you. So with that question, we have come to the end of our Q&A. I would like to thank all of you for staying and watching our What and Where to Invest flagship event. And I do hope that we have answered most of your questions. So do let us know if you do have further questions. You can type them in the box and we will try to answer them as much as possible. So with this, I'll hand over the time now to Gladys.
Thank you, Dajin, Dexter, and Catherine for answering our questions today. Before we head to our quiz and lucky draw where many prizes are about to be won, let's talk about some of the upcoming happenings at fsm1.com. On the 26th of January at 7 p.m., fsm1.com is organizing a dedicated session specially catered for newer investors to get them up to speed with the basics. If you're new to investing yourself or know of someone who could benefit from a stronger basic foundation, definitely sign up for this at fsm1.com. Also, receive 3,000 rewards points by opening a new FSM1 account. If you already have an account, simply refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is WAWTI2022. And from now till December, FSM1.com is offering 0% processing fees on ETF RSP. You can pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. Finally, please check out this limited time promotion, Power to the Portfolio. From 8th of January 2022 to 31st of January 2022, receive $10 bonus units for every $10,000 invested in 17 unit trusts spanning across 10 different markets, sectors, and themes that you can consider incorporating into your portfolio in 2022. You can also enjoy 3 free trades into selected ETFs covered during our What and Where to Invest 2022. Of course, terms and conditions apply. You can refer to the fsm1.com homepage to browse the list of funds and ETFs on promotion. Now, let's begin our quiz for today. 6 winners with the correct answers will each win $100 worth of FSM1 cash account credits. This is sponsored by our gold sponsors BlackRock, Franklin Templeton, JP Morgan, and UOB Asset Management. To access the quiz, you'll need to be on Event Live. Click on Agenda and Activities on the left-hand side menu. Under the Agenda section, click on Quiz. Now click the Join Quiz button. The activity window will be displayed on the right. Once the quiz ends, a leaderboard will be displayed. You may check if you're one of the winners. Now let's start with a trial question, shall we? This will be a warm-up question, so the leaderboard won't be shown. If you're ready, warm-up question number 1. What does WAWTI stand for? Option 1, why and when to invest. Option 2, what and when to invest. Option 3, what and where to invest. Option 4, where and when to invest. Now I'm confused myself. What does WAWTI stand for? We have 4 options for you to choose from. Note that your results will be based on the speed as well as accuracy of your answers. Wow, looks like the majority of you got it right. The answer is what and where to invest. 63% of you got it. This is demarcated by the green tick on the right side of your screen. After this warm-up question will begin very shortly, so get your fingers ready. Your results will be based on how correct you are as well as how fast you are when answering. Get ready. There will be 5 questions for this round, and we will have 6 lucky winners. Question number 1. Which of these markets does FSM1 deem as most unattractive for investors? Could it be US, Japan, or Europe? Which of these markets does FSM1 deem as most unattractive for investors? No, we're looking for the unattractive market. We have 3 options for you to choose from. The leaderboard will show up very shortly. Let's see if you are able to climb up to our top 6 rankings. Alright, the result is out. Most of you have got it right. 57.3% guessed it correctly, the US market. It seems 30%, roughly 30% guessed Japan, while a small majority guessed Europe. However, the one deemed most unattractive by FSM1 is US. Alright, let's check out our leaderboard. We've got Jean, Julie, Bunny, Wikiet, IGS, and Philo in our top 6 rankings. And from rank 7 to 10, let's see, we have KK, Terry, Will, and Eileen. Let's see if they will be able to rise up to our top 6, shall we? Question number 2. Which of the following is FSM1's suggested portfolio positioning for bond investors in 2022? Which is the suggested portfolio positioning for bond investors? Could it be overweight emerging market bonds and underweight global bonds? Or could it be the second option, overweight global high yield bonds and underweight short duration bonds? Or could it be overweight Asian high yield bonds and underweight emerging market bonds? And let's see, we have the correct answer. It is the last option. Let's see, 21.69% guessed the first statement. About 13% chose our second statement. However, the majority of you got it right. Congratulations to all 65% of you. The answer is overweight Asian high yield bonds. And let's check out our leaderboard. Wow, I think some of the names have jumped. We've got Philo, Julie, Bunny, CMZ, IGS, and Chi-Ho in the top 6 rankings. And our rank 7 to 10 has changed as well. Good luck. Question number 3. Which are the 2 sectors that FSM1 believes investors should pay attention to with regard to sustainable investing? The 2 sectors, could it be China utilities and China renewables? Or could it be China technology and China real estate? The last option, China renewables and China electric vehicles. That's quite a lot of options. Which are the 2 sectors should investors pay attention to with regard to sustainable investing? Well, we've got amazing results for this. We've got a bigger majority getting the correct answer. About 87% chose China renewables and China electric vehicles, the correct answer. A very small percentage chose the first and the second option. So congratulations to all of you who got it right. For those of you who didn't, don't worry, we've got more questions to go. And once again, our top 6 rankers have some names switched. We've got now Julie, Bunny, IGS, CMZ, Jean, and Kwang. Congratulations! Alright, our next question is... Question number 4. Which of the following statements is true? Solar and wind are to form the backbones of China's renewable energy evolution. China is responsible for slightly less greenhouse gas emissions than the US and EU combined. The renewable energy sector will undergo a slow expansion as China progresses towards a sustainable future. Which of the following statements is true? Note that we're only going for one true statement only, and only our top 6 rankers will win. Alright, congratulations once again, a big majority have got the correct answer. It is the first statement that is true. Close to 74% got it right. Congratulations. 8% chose our second statement, whereas close to 20% chose the last statement. Alright, let's check out our leaderboard once again. And our names have switched again, but most of you have remained in the top 6 rankings. Congratulations. I see from rank 7 to 10, we've got some new names coming up or some names dropping down. Let's go, we can do this. Last question. Which of the following statement on tech investing is false? Internet of Things devices are part of the 5G thematic universe. Statement number 2. The pandemic has slowed down mobility innovation. Statement number 3. China is doubling down to build its semiconductor industry. Now we're looking for the false statement. Not the true statement, the false statement. This is the last question. Winners, rankers 1 to 6, make sure you take a screenshot later on showing the whole activity window. Congratulations once again. I see we have a lot of insightful audiences out there. You are right, 74% of you. You chose the second statement, and that is true. That was the false statement. To the rest of you who didn't manage to get it right, I hope you have understood now. Once again, the leaderboard is up. Our rank 1 to 6. Please take a screenshot showing the whole activity screen. Congratulations to Chiho, Bunny, Lily, IGS, CMZ, and Jean. Our rank 7 to 10 were really close, but it's okay until the next one. Now, for those 6 of you who are taking the screenshot, ensure that your rank, your score, as well as your nickname are captured clearly. You have to email the screenshot and include your name, FSM account number, and the daily quiz date to events@fundsupermart.com. Once again, the email is events@fundsupermart.com. You have to email by 31st of January to claim your prize. I hope you've got your screenshot done. And now for our lucky winners. We've talked about this a lot. 8 lucky winners will be awarded with $100 worth of FSM1 cash account credits, and 3 grand prize winners will each walk away with $1,000 of FSM1 cash account credits. And here are the 8 lucky winners. Congratulations, Andrew, Keith, Rainer, Ming, Andy, Nina, Authon, and Wing. If you see your name on the screen, please remember to use the same email address you've used to log into our event live and send it to events@fundsupermart.com. Email by the 31st of January to claim your prize. Once again, the email is events@fundsupermart.com. Alright, these are our 8 lucky draw winners. What about our grand lucky draw? Finally, here are the 3 winners of our grand lucky draw. Our winners are Daryl, Min, and Allison. Congratulations to all 3 of you. You have won yourself $1,000 FSM1 cash account credits. Once again, if you've seen your name on the screen, please use the same email address you've used to log into Event Live to send an email to events@fundsupermart.com by the 31st of January to claim your prize. We'll give you some time to take the screenshot. Alright, congratulations to all of our winners. And now we'd like to thank our sponsors, CSOP Asset Management, East Spring Investments and Nikko Asset Management, BlackRock, Franklin Templeton, JP Morgan, UOB Asset Management, Allianz Global Investors, BNY Mellon Investment Management, Neuberger Berman, and Schroders for sponsoring these prizes and contributing your investment knowledge. This now wraps up What and Where to Invest 2022. We hope you've both enjoyed and taken away useful lessons from the various segments and presentations. To catch up on any of these segments, you can head on over to fsm1.com or their YouTube channel, where a replay will be posted shortly. That is all for What and Where to Invest, but at fsm1.com, the show must go on, and we will go on to bring you profitable investing ideas from all around the world. Till next time, goodbye.